Hello, future CAs. Hoping all of you are geared up for the exam, bringing to you guys result oriented content from the CA classroom team for all of you guys. First, let me talk about DT marathon. No, DT marathons for September 25 and Jan 26. Like this, for all subject, we are going to present to you 3 marathons, guys, not just one. We are going to have DT concept marathon, DT workout marathon, and DT MCQ marathon, and expect the same in accounts, law, audit, and SM over the next coming few weeks. If you look at the duration of all of this put together, the 3 marathons is going to be for 25 hours from the expert Rahul Agarwal sir, who is the head of international taxation and direct tax of a huge listed company called Randstad, guys. I mean, you're only going to enjoy these lectures. Let me quickly give you a glimpse because it is 3 separate marathons. So first, quick revision you do in concepts, and then those who know the concepts, I want to practice questions, sir. Then 12 hours of practicing comprehensive questions, and for the first time in India, we are presenting to you MCQ marathon as well, not just for DT. Be ready for all the subjects, guys. I just have to tell you one thing as to how you can do well in exams in any subject. It all depends on learning the concepts, practicing those concepts in questions, sums, or anything. Workout is what we call them, and applying them in exams by solving or in MCQ. This is what we call as SPA, guys. I call it a SPA score, not the SPA you do in saloon, guys. Here we have to approach this in reverse. First thing you do is A, focus on accuracy, focus on concepts. That's where A comes in. Next, you focus on presentation of those concepts in exam. P comes in, and you have to present them fast. That's where speed comes in. If somebody can put a tick for all these 3, I'm able to do well, sir, then you are ready for exams. How do you improve them? For improving your speed and presentation, you need to write a lot of tests, or you have to practice a lot. For improving accuracy, you need to improve your conceptual understanding, and all of this is what we have in our Wow Pro classes, guys. And only a sample of this Wow Pro classes of DT subject is what I'm showing to you in form of these 3 marathons. Of course, we are going to give you, like I mentioned, similar concept, workout, and MCQ marathon for free for all the 4 other subjects: accounts, law, audit, and SM. And we are starting off now with DT, guys. Enjoy these 25 hours of learning from CA Rahul Agarwal sir, and that's about it. Over to Rahul Agarwal, who's going to immediately start the sums or start the MCQ or start the concepts instead of giving any intro. That's what I'm doing, guys. Enjoy the lectures. Anything you have, let us know in the comments. And lastly, sorry guys, just one more thing. Sir, where can we find these materials or other marathon links that you need? We have free resources in CA Classroom website. In that you will find the materials. And if you are watching the concept marathon now, or the workout or MCQ, the other marathons, the link will be there in the description of whichever video you are watching. And also I will pin it in the comments, guys. Enjoy. Any doubts you have, let us know in the comments. Thank you so much.
Hey warriors, I hope you're all doing well and the preparations are going in full swing. Now, just a few weeks ago, we launched the very new MCQ guide for all my students who are attempting the May 25, September 25 and Jan 2026 attempts. While the May 25 exams are already over, the September 25 and Jan 26 is still going through their exams, and therefore one small request which came up from a lot of students is what we want to discuss today. While the MCQ guide has covered all the questions which are there up to MTP number 2 of May 2025, the challenges which happens is that most of the questions only have solutions. The reasoning or the workout of the solutions are not readily available, and therefore it's probably taking a little more time for students to get to that point. While yes, the answers are there and you will be able to figure it out eventually, considering the time limit which is there at this point, I didn't want you people to spend too much time understanding every MCQ and spending too much time solving the MCQ when you don't know how to approach it. So therefore, we are doing one small thing. Starting today, we are going to be launching videos on the MCQ guide as such. we will be taking up all MCQ guides chapter wise, which means there will be 13 different videos coming in for all chapters where we'll be discussing all the MCQs which are there in the MCQ guide and the reasoning for all the same. So that all MCQs which are able to answer yourself and derive the answers, you should be able to do it on your own. But for those questions where you get stuck up and you don't know how to approach the answer, you can use these videos as a reference point for you to understand how the MCQs are. At the same time, during this session itself, we'll also try to cover some important things which ICI is probably making an assumption from their end and is not covering that in your study material, or I have not covered it in my concept as well, because those are wild assumptions which ICI makes. We will take a note of all those things, compile them all and send it across once again, so that if those questions come as a part of a descriptive going forward, you are already prepared for it. Yes, so that is what the intention is for this video. I hope you all like what we are doing in this upcoming sessions. The PDF of this document will be available in the description box for you all to use and refer. One thing I can assure you, for those people who have not watched videos of my MCQ guide earlier, this book covers all MCQs which has been released by ICI in any parameters, whether it is the BOS knowledge portal, whether it is your past exams RTPs, past exams MTPs, past exam papers itself until the May 2025 MTP number 2. The only thing which will probably be missing after this video gets completed is the May 2025 actual exam MCQs, which will be waited till the suggested answers come in. Once the suggested answers come in, those also will get incorporated, or probably that you can use as a paper for you to do as a mock, and you can prepare the answers yourself so that you can understand it. Yes, and therefore this video will cover all MCQs which is required for your exams. Having this book is fairly enough for you to prepare for your MCQs itself. Yes, great. On that understanding, people, let's start with the discussion on this MCQ guide. We're starting today's class with the first video of basics of income tax. Ready? Let's go. Basics of income tax, people. Fairly easy questions are there, not something complicated. You should be able to answer all questions on your own, but nevertheless, let me try it out from my end as well. The question number 1 says, the rate of income tax which is mentioned is as per what? They're asking, where does the rate of income tax in income tax gets mentioned? Is it only income tax? Probably no. Is it income first schedule of Annual Finance Act? Yes. Both Income Tax Act and first schedule to Annual Finance Act, and then both income tax and income tax rules. People, rates of taxes are not in income tax rules. Normally they are part of Finance Act, but if you notice, there are some special rates like capital gains rate, unexplained income rates, winnings rate, and also the newly amended 115 BAC, which is the new tax regime. They all form part of your Income Tax Act. So the answer would not just be only income tax, would not be only first schedule to Finance Act. They would be the both of those. So therefore the answer is option number C. Yes, the answer would be option number C. Next, Gupta's HUF in Maharashtra comprises of Mr. Harsh Gupta, his wife Mrs. Nidhi Gupta, his son Mr. Deepak Gupta, his daughter-in-law Mrs. Deepti Gupta, daughter Mrs. Preeti, and his unmarried brother Gautam Gupta. Which of the following members are eligible for co-parcenary rights? People, I'm in Maharashtra. In Maharashtra, the rules are very simple. Only those people who are born in the family can be created as co-parcenary rights. All people who are not part of the family but are brought into the family as wife or as a married individual, those people are not eligible for co-parcenary rights. So let's look at this. Only Mr. Harsha, Mr. Gupta, Mr. Gautam Gupta and Mr. Deepak Gupta, males are covered, so fairly yes. Next, only Mr. Harsh Gupta, Mr. Gautam Gupta, Mr. Deepak Gupta and Miss Preeti Gupta. Notice Miss Preeti Gupta, people. Miss Preeti Gupta is the daughter, which means she is also born into the family and therefore she is also eligible for co-parcenary rights. This would be the right answer. Only Mr. Harsh Gupta, Mr. Gautam Gupta, Mr. Deepak Gupta, Mrs. Nidhi Gupta. Mrs. Nidhi Gupta is the wife of Gupta. That is not eligible for co-parcenary rights, so therefore C is wrong. And finally, D is definitely wrong because you cannot take the people who are brought into the family, which means the answer is option number B. Yes, option number B becomes the right answer. That is what we will take. Easy? Yes, awesome. Let's look forward. We are moving on to question number 3. Unexhausted basic exemption limit of a resident individual can be adjusted against what? People, if you have an unexhausted basic exemption limit and you are a resident, this question comes and says the person is a resident, which means can you adjust? The answer is yes. To what against can you adjust? You can adjust it against capital gains incomes. So can we adjust only against 112A? No. Can you adjust only against 111A? No. Can you adjust against both A and B? Answer is yes. So C becomes the right answer. Casual income is definitely not eligible for unexhausted basic exemption limit. Question number 4. Unexhausted basic exemption limit of a non-resident individual can be adjusted against what? Can you adjust against LTCG? No. Against STCG, no. Both A and B is definitely not right, which means the answer becomes neither A nor B. This is something which I've already in the classes also told you to mark as important, people. When it comes to a resident, you can utilize your capital gains, but if it comes to non-resident, no adjustments can take place. Next, during the previous year 24-25, Mr. Ranjit has a short-term capital gains of 95 lakhs. Okay, I have a short-term capital gain of 95 lakhs. I have a long-term capital gain of 110 lakhs, and I have a business income of 90 lakhs. Which of the following statement is correct if Mr. Ranjit is paying tax under default tax regime? People, a question like this, first always step number one, total your incomes. Let me total my incomes. My incomes are 95 lakhs plus 110 lakhs plus 90 lakhs. My total comes to 2 crore 95 lakhs. People, with my income being 2 crore 95 lakhs, the rule is very simple. You will first have a split done. A split would come and say that all your capital gains and dividend income will be treated separately and your business income will be treated separately. Which means my capital gains of short term 95 lakhs, my capital gains of long term 110 lakhs will be both liable for a surcharge at the rate of 15%. Looking at the business income on a standalone basis, the rules will come and say minimum you have to charge 15% and maximum you can charge up to 25% because the person is under default tax regime. In this case, because the person's individual business income is not going more than 2 crores, can you charge 25%? No. Which means short term will also be liable for 15, long term will also be liable for 15, and business income will also be liable for 15. That is what should be the answer. So option number 1, surcharge at the rate of 15% is leviable on the income tax computed under 2.95 crores. Answer is yes. Option A becomes the right answer. Yes, this is my right answer. 25% is definitely not coming in. 15 and 25, no. 15 and 10 definitely is not coming in, people. Once the income goes beyond 2 crores, a minimum surcharge of 15 needs to be applied, and therefore 10 cannot be applied here. Option A is the right answer. Look at the next one. Raju has earned 25,000 from lotteries, 10,000 from betting, 50,000 from online games, and has lost 5,000 in card games. People, lottery income related question, the provisions come and say when it comes to taxation, you can only take the gross incomes. All losses will be completely ignored, all expenses will be completely ignored. So what is the answer? 30% of 25,000 plus 10,000 plus 20% of 50,000. No. People, online games is also liable for 30%, so that is not the right answer. Next, 30% of 25,000 plus 10,000 plus 50,000 minus 5,000. No, you cannot set off your losses in your lottery, so therefore not allowed. Then 30% of 25 plus 10 plus 5 will be taken, and adjustment of unexhausted basic exemption limit is not permitted. This is the right answer. When it comes to lottery, you are not getting any adjustment of unexhausted basic exemption limit as well, so C becomes the right answer. D, 30% of 25,000 minus 5,000. No, definitely not happening. You cannot claim that. Yes, so easy questions, people, nothing really complicated, but yes, let's pay attention. Question number 7. The BOS knowledge portal question says, Mr. Ashutosh is age 65 years. People, the person is age 65 years, which means the person is a resident and a senior citizen. Has a total income of 3.2 crores, which is comprising of long-term capital gains taxable under section 112, which is sold on 10th May 2024 for 57 lakhs. Long-term capital gain on 10th August, which is sold for 65 lakhs, and other income worth 1.98 crores. What would be the tax liability under default tax regime? People, default tax regime question, and if you notice the question, the income is more than 2 crores, which means I will now do a split. How do I take this into consideration? The taking into consideration will be to first come and report all my incomes. So which means I'm going to do a two-way split. My two-way split will come and say first, what is my incomes in normal scenario? My incomes in normal scenario has been given as 1.98 crores. So my normal income is 1.98 crores. Now on this 1.98 crores, I will be liable for a slab. If I am opting for default tax regime, people, I will get a slab of what? I will get for the first 15 lakhs taxation at the rate of 1.4 lakhs. Yes, shortcut method. I'm doing the shortcut method to get the answer, which means if I take the balance 1.98 crores, 1.98 crores minus 15 lakh rupees into 30% will give me the balance tax, which is 54 lakh 90,000. Yes, if I total both the things, I get 56 lakh 30,000. Now, this is my basic tax. This is my basic tax. Now, if you notice the question, people, the question has gone 3.95 crores, which means after 2 crores, you'll have to split. If I'm splitting, the normal income is showing 1.98 crores, which is more than 1 crore, but less than 2 crores, and therefore a surcharge at the rate of 15% will apply on this. Yes, so I'm applying a 15% surcharge, adding a 4% cess to the question. The final answer comes to 6,733,480. Correct? Correct. Looking at my special incomes. in my special incomes, what and all do I have? The question says the first special income I have is yeah, I have 112, which is 10th May. People, when it is 10th May, it is before 23rd July, which means you will be liable for a 20% taxation rate. So if I take 57 lakhs and I multiply with 20 percentage, I get the answer as 11,40,000. I'm putting this in M plus because I have one more question. The next question says I have 65 lakhs, but this is 10th August 2024. People, this is after 23rd July, so you'll be liable for 12.5%, but if it is after exemption of 1.25 lakhs. So I'm taking 65 lakhs. Yes, let me take 65 lakhs minus 1.25 lakhs. No, yes, minus 1.25 lakhs, multiply this with 12.5 percentage. I get it as 796,875. I put this in M plus as well, and then I press MRC. MRC gives you 1936,875. So my basic tax is 1936,875. On this, I will again add a 15 percentage surcharge. I will add a 4 percentage cess. My number comes to 2316,502. 2316,502. 2.5 is coming in, people, so I put it as 0.3. Adding these two numbers together, I get 6733480, totaling to 9049982. Yes, so I get 9049982. 2.5 is coming, people, which becomes 3, but I'm rounding it off and therefore it becomes 0. So I should get the answer as 9049980, which is option number A. Yes, so option number A becomes my right answer. Fairly easy question, people, such as related question, so therefore easy question. Yes, but please mark this as important. For your last day revisions, this is definitely an important question which you can look into. Next, Mr. Neckinson is aged 43 years and has provided you the following income details. The particulars are given to you where they're saying there is a capital gains transfer on the 29th September 2024, which means after 23rd July for 120 lakhs. I have 11 money for 25/11/2024, which is after 23rd July, therefore 110 lakhs. And then I have other incomes of 5.2 crores. The person is asking for tax liability under optional tax regime. People, I am asking for optional tax regime, which means now the same rules will apply, but I will check the 37% surcharge rate. With my income going more than 2 crores, these two will be liable for a surcharge at the rate of 15%. Yes, so these two are going to be liable for a surcharge at the rate of 15%, and this is going to be liable for a surcharge rate of 37%. Can I do it on the calculator quickly? Let's do it on the calculator itself. I'm having optional tax regime. Person is 43 years, which means normal citizen. Yes, so I'm taking 5.2 crores. So 5.2 crores. Yes, I'm taking I'm getting 5.2 crores minus 10 lakhs will be taken into 30% plus 1,12,500. My total basic tax comes to 15412500. I'm adding 37% surcharge on this. I'm adding 4% cess on this, which means the tax on this comes to 21959,730. Correct. Coming to the 120 people, the 120 lakhs will be 112A, and therefore I have to remove 1,25,000 basic exemption. So 120 lakhs, 120 lakhs, yes, 120 lakhs minus 1,25,000. No, 1,25,000 into 12.5%. I put this in M plus, and then I have 110 110 lakhs. Yes, 110 lakhs, 111A. After 23rd July, people, therefore will become 20% tax rate. The number comes to 220,000,000. I put this also in M plus and I get MRC. MRC number shows 36,84,375. Because this is special capital gains income, I will add a 15% surcharge. I'll add a 4% cess. The number comes to 440,651. 2.5 came, therefore I'm rounding it off to 13. Adding this to the total tax, so 21959,730. My total tax comes to 26366,242.5, which becomes 243. Therefore I round it off and I make it 26366,240. Yes, so I should get it as 26366,240. Therefore option number C is the right answer. Yes, this becomes my right answer, which means people, things can be done on calculator as well. You don't need to really put out notes for your MCQs. Next, May 24 RTP question says, Mr. Garg is age 45 years and a resident in India, having a total income of 5,70,000, comprising of long-term capital gains of 70,000, long-term capital gains of 1,50,000, short-term capital gains of 1 lakh and other income of 2,50,000. They are asking you to compute the tax liability under default tax regime. Notice carefully, people, this question is asking for default tax regime. Yes, and therefore you need to be careful on what you're doing. First of all, if you notice, my income under default tax regime is given as 5,70,000. 5,70,000. A person under default tax regime with an income of 5,70,000 simply means that he is eligible for rebate. He is eligible for rebate. So let's keep that first thought in mind. Second, they're coming and saying that my other income is only 2,50,000. My other income is 2,50,000, which means first I will adjust my basic exemption limit to my capital gains income in order to pay lesser tax. So let's adjust this appropriately, people. I have 112. Nothing is given, so I'm assuming 112 is after 23rd July. I'm having 112A also after 23rd July. I have 111A after 23rd July. 112 after 23rd July will be 12.5. 112A after 23rd July will be 12.5. But when it comes to capital gains, 111A is 1 lakh rupees, which is after 23rd July at the rate of 12.5%, at the rate of 20%. So my adjustment will be for the first 20% people, because I want to pay the least tax. So therefore, what will happen? I will now come and say that in my basic exemption limit of 2,50,000, in my basic exemption limit of 3 lakh rupees, 2,50,000 comes from the slab. Correct? I still have a pending balance, and therefore the 50,000 will be taken away from my 111A here. I will take it away from 111A here in order to pay the least tax, and therefore my slab gets exhausted. Coming to the balance, now I have the balance incomes. My balance incomes is 112. 112, I have a tax of 70, I have an income of 70,000 rupees, and that will be multiplied with 12.5%. 70,000 into 12.5% will be M plus. Next, I have capital gains of 1,50,000, 112A. People, this is post 23rd July, so 1,25,000 ka exemption. So 1,50,000 minus 1,25,000, I will get the income is 25,000, multiplying with 12.5%, I get 3,125. Yes, so 3,125 will be again done M plus. Then I have short-term capital gains, 1 lakh rupees. Now in that 1 lakh rupees, I have already utilized 50,000 rupees for my basic exemption limit. So I am left with 50,000 rupees. Multiplying this with 20% tax rate, number comes as 10,000 rupees. I am doing this also M plus. My total is 21,875. So my total special incomes are coming to 21,875. But notice this carefully, people, that when I come to my basic exemption limit, my incomes under default tax regime is eligible for a rebate. And therefore, because it is eligible for a rebate, I can set off my rebates here. Now, rebate rules, people, for a special income under default tax regime comes and says you can set off to the extent of total tax or 25,000, whichever is lower. But the condition is that you cannot set off against 112A incomes. Yes, so which means rebate can only be claimed to the extent of total tax, ignoring 112A tax. In this question, people, my 112A tax was how much? I had 1,50,000, in which 1,25,000 was exhausted. So 25,000 into 12.5% is 3,125. This 3,125 is something which I cannot claim rebate on, which means even after I claim my rebate, 3,125 should be the leftover income tax. Yes, this is something which I minimum have to pay, because I cannot claim rebate on this number. Which means simply adding 4% cess to this number comes as 3,250, and therefore that becomes the right answer. Yes, therefore your answer in this question will be 3,250. A very good question for you to practice and know, people, because there are 3 components being tested here. 1, the order of adjustment when it comes to basic exemption limit. Second, you need to know how to claim your rebates for all taxes except for 112A. Yes, so this is something which you need to pay attention to and keep in mind before you proceed forward. Option B would be the right answer here. Next comes question number 10. Question number 10 says, Mrs. Nisha is a non-resident individual for AY 25-26. People, if I'm paying attention, the person is a non-resident individual. Let's keep this in mind. Then the question says, for AY 25-26, she has earned a long-term capital gains of on 31st October post 23rd July on transfer of listed equity shares where STT is paid for 1,80,000, which means this is 112A. And they have another income of 2,75,000. They want you to compute tax of Mrs. Nisha under default tax regime. The same rules, people. The same rules will apply. When it comes to default tax regime, you have a slab of 7 lakh rupees for rebate. Notice my incomes. My incomes are 2,75,000 plus 1,80,000. And therefore, in the 2,75,000 plus 1,80,000, my total income comes to 4,55,000, which is less than 7 lakhs. Therefore, the person can claim a rebate. Yes or no? No. This is the one horrible mistake which most of the people will make. The reason why I highlighted non-resident people, when it comes to non-resident individual, can you claim the benefit of rebate is the question. No, you can't claim the rebate benefits. Second, even if you are under default tax regime, when you are a non-resident, can you adjust your unexhausted basic exemption limit against special incomes? No, nothing can be done, people. Nothing can be done, which means this 1,80,000 will become taxable as it is. The other income of 2,75,000, while yes, my basic exemption limit is 3 lakh rupees, the 25,000 rupees worth of the difference is lost. A non-resident is not getting the benefit of this, which means 1,80,000 will be my net taxable income. This 1,80,000 is 112A, therefore I reduce 1,25,000 out of this and I multiply this with 12.5%. This becomes my tax of 6,875. Person is a non-resident, so no rebate. Adding 4% cess on this, the number comes as 7,150. Therefore, option number D is the right answer. Yes, option number D becomes the right answer. That is what you need to look into. Clear? Yes, a beautiful question which you need to pay attention. Next, MTP number 1 question, people. This is, what would be the tax liability of Mrs. Savita, a resident who's attained the age of 60 years on 1st April 25 on a total income of 7,25,000 comprising of salary income and interest on fixed deposits under DTR? People, the problem with DTR is, in DTR residency does not matter and your age does not matter. Although the question says 1st April 25 and the person has become 60 years, the senior citizenship status is not relevant when it comes to DTR, and therefore you will apply the normal rules. The normal rules of 7,25,000, because the person is in DTR, understand this carefully. This is a hint for you. This person is under DTR with 7,25,000 as the number. A number so close to 7 lakhs itself means that the person is eligible for marginal rebate. Marginal rebate rules very simply come and say that if your income is a little bit more than 7 lakhs, you ignore all the tax which is eligible up to 7 lakhs. You simply offer to me the additional income which you've earned and I will ask you to pay cess on it. Yes, which means in that 7,25,000, I would simply come and say, surrender your 25,000 rupees to me, add a 4% cess on this, and that becomes your final tax liability. In this question, 25,000 plus 4% cess becomes 26,000. That is straightforward my answer. Yes, that is straightforward my answer. That is how my marginal rebate applies. That is how my marginal rebate applies. 1 second, why is it 23,400 here? Should it be 23,400, people? No, I don't think it should be 23,400, because for 7 lakh rupees your tax would be 0, and for 7,25,000 rupees I think you should get a tax of, let's check. Yeah, I guess it still doesn't matter. 25,000 rupees is still going to be more, but maybe let's just check. So 7,25,000 is my total income. In that 25,000, 7 lakh rupees will be taxable for 20,000. The balance 25,000 will be taxable at the rate of, for the first 3 lakhs it is 0, for 3 lakhs to 7 lakhs it is 5%. This is taxable at the rate of 10%, which means it comes to 2,500. Yes, so 25,000 into 10% will give me 2,500 plus 20,000. Therefore, answer comes to 22,500. Therefore, the answer comes to 22,500, which means people, if you notice, for 7,25,000 rupees, I'll pay 22,500, whereas for the differential, I will pay 0. For the differential, I'll pay 0, and therefore 22,500 is what I should report. Correct? 22,500 is what would be my tax liability. In that 22,500, I will add a 4% cess, and therefore the number comes to 23,400, which means for this one, I do not get a marginal rebate. Notice carefully, people, my additional income is what? My additional income is 25,000. My additional income is 25,000, whereas my tax liability only came to 22,500, which means I am still paying taxes lesser than what my marginal, lesser than what my additional income is, and therefore marginal rebate concept will not apply. You will pay tax as the rate of 22,500 plus a 4% cess, which means for 7,25,000 there is no marginal rebate. Probably marginal rebate will come when your income is slightly near 7,20,000 and forward. 7,20,000 and forward, that's when you will get your marginal rebate. Next, question number 12. Mr. X is a resident, age 47 years. The person has a salary income of 7,25,000 and an agricultural income of 1 lakh rupees. They're asking you to compute the tax if the person is opting out of default tax regime. Notice, people, the person is opting out of default tax regime, has income of 7,25,000 plus an agricultural income of 1 lakh. Now, with an agricultural income of 1 lakh comes in the concept of partial integration. Also, because my income is 7,25,000 and I'm under alternate tax regime, there is no rebate concept here, which means the computation will work as follows. So, solution number 1, I will first compute tax on 7,25,000 plus 1 lakh rupees. Yes, so step number 1 is to compute tax on 7,25,000 plus 1 lakh rupees, which is 8,25,000. Now on the 8,25,000 people, what is the person? The person is Mr. X, age 47 years, normal slab concept, which means for the first 5 lakh rupees, I am taxable for 12,500. For the differential 3.25 lakhs at the rate of 5 percentage, no, at the rate of 20 percentage. At the rate of 20 percentage, so 3,25,000 into 20 percentage will give me 65,000. Yes, adding both, I get 77,500 plus the cess will give me 80,600. Correct? This is step number 1. Then comes step number 2, where they'll say do one simple thing. Take your basic exemption limit and add the agricultural income to it. What is my basic exemption limit? My basic exemption limit is 2.5 lakhs. Plus an additional 1 lakh rupee here, giving me 3,50,000. Yes, for the first 2.5 lakhs, my tax is going to be 0. For the next 1 lakh, I'm going to be taxing at the rate of 5 percentage, which gives me 5,000 rupees. Yes, so 1 lakh into 5 percentage will give me 5,000. Adding a 4% cess on this, the number comes as 5,200. My partial integration will come and say difference of these two is my tax liability, which is 75,400, and therefore that's option number C. That is option number C. That is how simple it is, people. Nothing complicated about this question. Now, if my feeling is right, I would say that even if you had not done partial integration, you would get the same answer. Can you check it out, people? Even if I had taken just 7,25,000 here, for the first 5 lakhs, I would have taxed 12,500. For the 2,25,000, I would have taxed how much? I would have taxed 20 percentage plus 12,500 plus 4% will give me 17,680. No, so this means this is the right answer. Yes, this is the right answer. So 2,25,000, no, this is 22,500. Yeah, 2,25,000 into 20 percentage plus 12,500 plus 4%. Yeah, you're not getting the same number. Yes, so which means partial integration is mandatory in this question. Next, question number 13 says, Mr. Raja is age 64 years, was not able to provide satisfactory explanation to the assessing officer for the investment of 7 lakhs, which is not recorded in books of accounts. What would be the tax payable by him on such investments to be deemed as income? People, unexplained income, straightforward answer. Take the number and multiply by 78%, which means 7 lakhs is my 7 lakhs is my income into 78% will be my tax rate, and therefore the answer is 5,46,000. Therefore option number C is the right answer. Yes, easy question, nothing complicated about it. Next, which of the following is an agricultural income? Income from breeding of livestock? Yes, no. Breeding of livestock is not an agricultural income, that's poultry culture. Yes, next, when it comes to income from fisheries, no. Income from juice center, no. Juice center and all is definitely not. Income derived from seedling and sapling is necessary. Yes, this is the right answer. This is a specific circular which is clarified by income tax, where they've come and said if you're growing seedlings and saplings in nursery, it will be treated as agricultural income even if the basic operations are not carried out on a land. Then income derived from farm buildings situated in immediate vicinity of an agricultural land, not assessed to land revenue, would be treated as agricultural income in which of the following situations? In the situation number 1, they're coming and saying the distance is 3 lakh rupees and the municipality has a population of 80,000 people. If the difference is 3 lakh rupees, if the difference is within 3 kilometers, this will be treated as an agricultural land, because after 2 lakhs, after 2 kilometers up to 6 kilometers, the population should be below 1 lakh, and therefore this looks like the right answer. This looks like the right answer. Let's check the balance also to see if they are forming part of rural agricultural land. Next, an area within 1.5 kilometers. If it is less than 2 kilometers, you should have a population of 10,000. This is not 10,000. Therefore, B is not the right answer. An area within 2 kilometers. Again, within 2 kilometers, you should have a population of 10,000. This is 11 lakhs and therefore not the right answer. And fourth, area within 8 kilometers. Within 8 kilometers, people, you should have a population of 10 lakhs. And therefore, here it is 10 lakh 50. Again, not the right answer, which means option is the right answer. Next, 16. Mrs. Soumya has 3 farm buildings situated in the immediate vicinity of a rural agricultural land. In the previous year 24-25, the person has earned 3 lakh rupees from letting out of farm building 1 for storage of food grains, 10 lakhs from letting out of farm building 2 for storage of dairy products, and 15 lakhs from letting out of farm building 3 for residential purposes of Mr. Sumant, whose food grains is stored in farm building 1. What would be the agricultural income? If you notice this carefully, people, I have 3 assets. One is 3 lakhs for farm building number 1 for storage of food grains. People, if you're storing food grains, that definitely is an agricultural income. This is rightfully an agricultural income. I will take this into consideration. Next, 10 lakhs is for storing dairy products. People, this is not for agricultural operations, therefore this is not an agricultural income. And then 15 lakhs for letting out a farm building for residential purposes. People, this is used for residential purposes. This is not used for agricultural operations. Therefore, this will be taxable under HP and not an agricultural income. In simple words, the answer becomes option number B. Option number B is the right answer. Yes. Next. For the assessment year 25-26, Mr. Hari is a resident Indian and has earned an income of 10 lakh rupees from the sale of rubber manufactured from latex obtained from rubber plants grown by him in India, and 15 lakhs from rubber manufactured from latents obtained from rubber plants grown by him in Malaysia. What would be his business income which is chargeable to tax in India, assuming he has no other business? People, when it comes to rubber, this is a composite income. Composite income rules come and say that when the operations are done in India, you can do a 35-65 split, where 65 will go to agricultural income and 35 will go to business income. But if the whole operations are done outside India, example Malaysia, then that is not having any agricultural component, it is fully taxable as an income, which means in the first 10 lakh rupees, I am going to be taxing 35% of the number, and that's an M plus. In the second 15 lakh rupees, the whole 15 lakh rupees becomes taxable. Therefore, the answer becomes 18 lakh 50,000. Option number D is the right answer. Option number D is the right answer. Yes, easy question. Next, for assessment year 25-26, Mr. Rajesh is a resident Indian and has earned an income of 12 lakh rupees from a sale of coffee grown and cured in India. People, coffee with two words. Coffee with two words would become 25 and 75 split. Mr. Ganesh is a resident Indian and has earned an income of 25 lakh rupees from sale of coffee grown, cured, roasted and grounded. Coffee with 4 words will become 40 and 60, and this is also in India. What would be the business income chargeable to tax in the hands of Mr. Rajesh and Mr. Ganesh? Let's look at Rajesh first. Rajesh is earning 12 lakh rupees, and in that 12 lakh rupees, they are wanting the business income. Yes. So, in that 12 lakh rupees, I will tax how much? 25% of the number, which is 3 lakh rupees. Now, option A and option B looks like the right answer. So, let's check which one is the right answer using Mr. Ganesh. Mr. Ganesh is getting 25 lakh rupees. So, 25 lakh rupees into 40% will be the taxable income, which means 10 lakh rupees. And therefore, option B becomes the right answer. Option B becomes the right answer. We've discussed this earlier also, people. Coffee with 2 words becomes 25, 75 and coffee with 4 words becomes 40 and 60. Next, which of the following statements is true in respect of taxability of agricultural income under Income Tax Act? They're asking 4 statements, people, and they want to know which ones is the right answer. Yes, the right answer is being requested. First, any income derived from seedlings and saplings grown in a nursery is an agricultural income liable for agricultural exemption. Answer is yes, this is right. Next, 60% of the dividend received from shares held in tea company is agricultural income exempt. No, people, dividend has nothing to do with agricultural operations. The dividend income will be fully taxable as IFRS. Third, while computing the income tax liability of an assessee aged 50 years, the agricultural income is required to be added to the total income only if the net agricultural income for the previous year exceeds 5,000 rupees and the total income including net agricultural income exceeds basic exemption limit. No, people, it is not including net agricultural income, it is excluding agricultural income. If your normal income excluding agricultural income is more than basic exemption limit, only then partial integration as a rule will apply. If it is already below basic exemption limit, there is no point of applying partial integration because the answer will still be no tax payable, and therefore C is not the right answer. Look at point number 4. While computing income tax liability of an assessee aged 50 years, agricultural income is required to be added to the total income only if the net agricultural income exceeds 5,000. Yes. And the total income excluding net agricultural income exceeds basic exemption limit. This is the right answer, which means 1 and 4 looks like the right answer, and therefore that should be option number C. That should be option number C. Yes, yes, great. Let's look at the case scenario related questions. Now, this question, if my memory serves right, was Jan 25 and had a huge ruckus, people. A lot of concerns were raised in this question. Let's understand this question carefully. It says, the question is not having question itself, people. A, B and C is not having a question itself. So, we have no other option but to read the case scenario. Let's read the case scenario. It says, Mr. Anand is a traditional farmer who has inherited 35 acres of agricultural land, which is around 20 kilometers of nearest town. Good enough. He is cultivating in 15 acres paddy, which is taken directly from rice traders. Okay. Another 10 acres of land is used for growing sugarcane. As per the practice, sugarcane is purchased by sugar mills nearby the villages for which the payment was received by NEFT, RTGS or IMPS. Okay, so he is doing 2 operations. One is for paddy and one is for sugarcane. The remaining area is cultivated for mulberry leaves, and part of the mulberry leaves are used for being fed to silkworms and obtaining silk cocoons and selling these silk cocoons in the market. So which means now he has the rest of the land. In the rest of the land he is doing mulberry leaves and also some part of the mulberry leaves which is sent to factory for the purpose of creating silk. Next, where are we? Yes, during the previous year 23-24, Mr. Anant, no, people just change this one. This is not 23-24, this is 24-25. Yes, maybe a mistake from my side. I have to change this. So during the previous year 24-25, Anant has got a net income of 4 lakh rupees from sale of paddy, agricultural income. 3 lakh 50 from sale of sugarcane, agricultural income. 75,000 by selling mulberry leaves alone, agricultural income. He carried out mulberry silkworm production using his mulberry leaves worth 50,000 rupees and selling the silk cocoons by spending 2 lakh rupees to get a 3 lakh 75,000 on sale. People, that 50,000 rupees which he sent to his factory is also an agricultural income to that extent. Anything beyond that would not be an agricultural income is the answer. Based on the above information, you are requested to answer the following MCQs A to C. Option A, paddy income of 4 lakh rupees alone is agricultural income? No. Option number 2, sugarcane income of 3 lakh 50 and paddy income of 4 lakh will constitute agricultural income? Yes, this fairly looks right because they have not used the word only here. C, sale of mulberry leaves amounting to 75,000, paddy income of 4 lakh rupees, sugarcane income of 3 lakh 75,000 will constitute agricultural income. People, only 75,000 would not be the right answer because I have 50,000 worth of mulberry also. Option number D, paddy income of 4 lakh rupees, sugarcane income of 3 lakh 50 and sale of mulberry leaves of 1 lakh 25,000 will be agricultural income. This also looks right, people. 75,000 worth of mulberry leaves and 50,000 worth of mulberry leaves sent to the factory are both agricultural income. So I would say the answer is option number D. I would say the option number D. But if you notice on the bottom, people, you'll see on the bottom right, there is option called B or D. What happened is mulberry leaves is still under discussions. Mulberry leaves has not been clarified as being agricultural income. Persons can come and say mulberry leaves are not exactly agriculture because you're growing leaves. Leaves are not technically crops and therefore one can make a contention that it is not an agricultural income. Therefore, IC has given two alternatives. You can either assume mulberry as fully taxable as business income or you can assume mulberry leaves as agricultural income, whatever is the right answer. I would prefer option number D. Next, question number 2. The sale of mulberry leaves of 75,000 alone will not constitute agricultural income. 75,000 will not constitute agricultural income? No. The amount of 3,75,000 being sale proceeds of silk cocoons to silk cooperatives will constitute agricultural income? Definitely not. That's a factory income. Net income from proceeds of 1,75,000 is exempt from tax being agricultural income. What's 1,75,000? No, people, net income of 1,75,000 is also not an agricultural income because that's in business income. Net income from sale of silk cocoons amounting to 1,25,000 will not be treated as agricultural income and will either be taxed as business income or IFOS. Let's check, no people. I am telling my total sale value is 3,75,000. Yes, in that 3,75,000, my expenses are 2 lakh rupees. So my expenses are 2 lakh rupees and therefore the income becomes 1,75,000. In that 1,75,000 people, 50,000 is the worth of agricultural produce which I am sending across and therefore 1,25,000 should be business income. Option number D does make sense. Option D does make sense. Next, question number C. The entire amount of agricultural income of Anant will be 12 lakh rupees. Let's check, people. What is my entire income? My paddy is 4 lakh rupees. My 3 lakh 50 is from sugar canes. My 75,000 rupees is from mulberry and my 50,000 rupees is from another mulberry, which means 8,75,000 is my agricultural income here. So is it 12 lakh rupees? No. Agricultural income will be 8,25,000 and the sale of cocoon items for 1,25,000 will be non-agricultural income. This looks like the right answer. This looks like the right answer. Next, agricultural income will be 8,75,000 and net non-agricultural income will be 1,25,000. No, there is no split like that. Since Mr. Anant mixes agricultural activities with non-agricultural activities, the entire receipt of 12 lakh will be treated as non-agricultural income. People, this is kind of weird. I don't know for what reason ICA gave this as a right answer because they wrote it as B or D, but definitely D is not the right answer. Just because you're mixing agriculture and non-agricultural incomes, one can never contend that sugarcane and paddy will become a taxable income. That's definitely not the right answer. That is not going to be the way anywhere. Yes, composite income rules are very clear in income tax that even if you're doing agricultural and business, you will have to do a corresponding split. So D definitely does not make sense. That should not have been treated as the right answer. Not sure why it is given. Let's ignore that off. Question number 21. Case scenario question. Here, luckily, we have questions. Yes. Look at question number A. It says, what amount of income arising from activity A would constitute agricultural income? Okay. From activity A, what amount of agriculture is asked? Next, what amount of income from activity B with respect of sale of cotton would constitute agricultural income and business income? So from B also they want agricultural income. And C says, what amount of income from activity B in respect of sale of yarn would constitute agricultural income? So B there is cotton also, yarn also, we need to split and check. And question number D says, what is the amount of income arising from activity number C constituting agricultural income? So C also they want agricultural income. And finally, question number E wants the gross total income. Let's now read the case scenario to understand what is happening. The case scenario says, Mr. Kishan is engaged in the following activities on agricultural land which is situated in India. Total acres of land is 5 acres, which means the land is in India. I have no problems here. Activity A says, the growing of saplings and seedlings in a nursery spreading over 1 acre of land, the sale proceed of which is 5 lakh rupees. The cost of plantation is given as 1 lakh 40. The basic operations are not performed on lands. People, like I discussed just now, when you have a circular, the circular has come and clarified saying any kind of seedlings and saplings grown will be treated as full agricultural income and will be exempted from tax even if there is no basic operations carried out on the land. Which means in this, my 5 lakh rupees minus 1,40,000 will be my agricultural income. So 3,60,000 is the right answer. Yes, 3,60,000 will be my agricultural income. This was an easy question. Next, in activity number B, the person is growing cotton on 3 acres of land where 40% of the cotton is sold for 4 lakh rupees and the cost of the cultivation of the cotton is 2,25,000. Okay, the cost of cultivation of the balance 60% is 3,75,000 rupees and the market value of the same is 6 lakh rupees, which is used for manufacturing yarn. After incurring manufacture expenses of 1 lakh rupees, the yarn is sold for 8 lakh 50. So which means, people, the cotton has now been split. The 40% of the cotton has been directly sold and therefore whatever income you get from it will be fully agricultural income here. Which means in that 4 lakh rupees, the cost of cultivation is 2,25,000 and therefore my agricultural income for the first leg of it will be 1,75,000. Yes, so to the extent of this, the answer is 1,75,000. Coming to the next part of the cost of cultivation, the balance cost of cultivation is 3,37,500, which is in the market eligible to be sold for 6 lakh rupees. So therefore, the agricultural income here will be 6 lakh minus 337,500. The answer should come as 262,500. Yes, so my total agricultural income will become what? My total agricultural income is 1,75,000, which is 437,500. So that is what has been requested for. Yes. Now, what amount of income from activity B would constitute sale of cotton? With respect to sale of cotton would constitute agricultural income and business income. Which amount is my agricultural income? From the sale of cotton, the answer is 1,75,000. Yes, so they want only this piece of it. So the answer becomes option number A. Yes, then question number C. What amount with respect to the sale of yarn would be treated as agricultural income? We just discussed 1,75,000 plus 2,62,500 will become 437,500. So 437,500 would be, no. Oh, sorry, they only want the yarn part, right? Yeah, so sorry. So yarn part is 2,62,500 and therefore that would be the sale of agricultural income. So 262,500 would become option number B. Yes, I can also find out my business income, people. Notice the business income. My sale value is 8,50,000. In that 8,50,000, my agricultural cultivation cost is 1 lakh rupees and my purchase of cotton is 6,50,000 rupees. So therefore 1 lakh is the right, 1,50,000 is the right answer. Yes, so option number C becomes the right answer. Question number C. Activity number C says, land measuring 1 acre is let out to Mr. Ramesh on a monthly rental of 15,000 rupees, which is used by Ramesh as follows. 50% of the land is used for agricultural purposes and 50% of the land is used for non-agricultural purposes. People, the 50% of land which is used for agricultural purposes will be an agricultural income. So 15,000 rupees into 15% will give you 7,500 rupees. 7,500 into 12 will give me my agricultural income, which is 90,000 rupees. Yes, so 90,000 rupees would be treated as agricultural income and 90,000 rupees would be taxable as income from other sources. Income from other sources. Now, people, notice carefully that this 90,000 rupees which is used for non-agricultural purposes, can you treat it as income from house property? No, this is a land, not a house. Because it is not a house, it is treated as a taxable income under IFOS and not under HP. Question number D, I think we can fairly answer from here itself, people. My business income in activity number B is 1,50,000 rupees and my business income from activity number C is 90,000 rupees. Therefore, my gross total income will become 2,40,000. Therefore, the answer becomes option number A. Yes, the option becomes option number A. Simple, straightforward, easy answer. Clear? Yes, great. I think we're done with this on chapter number 1, people. Fairly some important questions which I want you to keep in mind and you want to practice in the past. You have to read question number 9. A very, very important question, people. Question number 9 should be focused upon. Yes, so please refer question number 9 before you go for your exams. Focus on question number 10 because it's a non-resident and a good question. And then you have question number 11. Your case of non-marginal rebate applicability even if your income is 7,25,000. Yes, that is what I would like you to pay attention on. Other than that, I would want you to pay attention on this question number 7 and question number 8 kind of things while you're talking about surcharge related questions. These are some important questions which you should focus for your exam purposes. A very, very good question can be answered from these kind of things. Yes, pay attention to yes, these are the 4 questions which I would really like you to pay attention to if you're going for your exams properly. Yes, apart from that, I think agricultural income questions should be fairly easy, people. You should not definitely not have a challenge in these kind of questions. So I don't pay much attention to it anyways. Yes, great. That's all I wanted to discuss in today's video, people. Thank you for spending time along with me. If any of these adjustments have made help to you, I'm really happy to do that. We will continue with this and discuss the balance chapters in the upcoming videos. So please watch out for the videos. If there is any of your friend who's facing difficulties in MCQ and needs an MCQ guide, the link of the book is there in the description box. Please share it with all of your friends as much as possible and spread the word everywhere. You can also watch these videos and inform them also to watch the videos if you are stuck on any MCQ and you want to understand what it is. But yes, apart from that, if you feel like you need to personally talk to me and reach out to me to understand it, feel free to always reach out to me. My WhatsApp number is also given in the description box for you all to refer to. That's all for today's video, people. I hope you all have a great learning. I will see you all soon with an upcoming video on the balance chapters. Take care. Bye bye. Hey boys, I hope you're all doing well. Welcome back to the series of the MCQ guide, where we are discussing the MCQs which are released by ICA for assessment year 25-26 and also the past MCQs which has been compiled in this MCQ guide which was shared across with all of you. In today's video, we are going to be discussing chapter number 2, the residential status and scope of total income. Fairly, the questions in MCQ are easy on this, but definitely important because you get a 4-mark question in this in your descriptive paper. So solving your MCQs will really help you do better in your descriptive as well. And therefore, without wasting any further time, we're going to be deep diving into these MCQs, trying to understand what exactly is ICA testing on these questions. Look at question number 1 from BOS portal. The question says, Mr. Sumit is an Indian citizen and a member of a crew of an American-bound Indian ship which is engaged in the carriage of freight and international traffic, which is deporting from Chennai on 25th April 2024. People, this question fairly resembles the descriptive question which is there in your study material already. Yes, the facts almost remain the same. From the following details of 24-25, they're asking you to find out the residential status of Mr. Sumit for 25-26, assuming that his stay in India for the last 4 years is 365, last 7 years is 730 days. They've also mentioned that the date entered into continuous discharge certificate for joining the ship is 25th April and for leaving the ship is 24th October. Mr. Sumit has been filing returns in India as a resident for the last 2 previous years. Yes. Now, people, when it comes to a citizen which is leaving India for crew member purposes, in that case, the second condition gets denied to you. You don't have the condition of 60 plus 365, you only have the condition of 182 days. So let's first check if 182 days get satisfied. For us to do that, the rules of 126 come and say that when it comes to a crew member, the date on which he joins the ship till the date on which he signs off from the ship will be assumed as outside India. So that's not part of India. On that understanding, if I make this out clearly, in the month of April, the person left on 25th April, which means for 24 days he was in India. May he is outside India, June he is outside India, July, August, September, October he is come back to India on 24th October, which means in the month of October, he will be there in India. He will be there in India from 25. So 25, 26, 27, 28, 29, 30, 31. That becomes 7 days. October is done. November becomes 30 days. December becomes 31 days, January becomes 31 days, Feb becomes 28 days and March becomes 31 days. Let's total this and check how much does it come to. 24 plus 7 plus 30 plus 31 plus 31 plus 28 plus 31. I get 182 exactly. My days becomes 182 exactly, which means the person is a resident. Now, with the person being a resident, the provisions come and say you need to tell me what exactly is happening for ROR or RNOR. The facts of the question come and say that the person has been in India for 730 days in the last 7 years. For you to be an RNOR, you should be 729 or lesser. This is exactly 730, so that condition satisfied. Second, for you to be an RNOR, you should be a non-resident in 9 out of 10 years. This one says that the person has been a resident in the last 2 previous years, which means that condition also did not get satisfied. When both conditions did not get satisfied, the answer is only one. The person is an ROR. So option A becomes the right answer. Yes, yes. The same study material question but with a twist. In the study material question, the answer will be non-resident. Here it's a ROR. So that's for the question. Look at question number 2. It says, if Anirudh, a citizen of India, has stayed in India in 24-25 for 181 days. So the person is staying in India for 181 days. And he is a non-resident in 9 out of 10 immediately preceding previous years and has stayed in India for 365 days in all of the last 4 preceding years and 420 days in the last 7 years. In the last 7 years, they want you to know his residential status. People, in the current year, a citizen of India with no condition satisfied, has stayed for less than 182 days, but has been staying for 60 plus 365. This is neither a person who's from outside India visiting India, not going for employment and anything. So basic conditions are applicable. With my basic conditions being applicable, 60 plus 365 becomes applicable. 181 satisfies 60, 365 satisfies the 365 condition, and therefore the person is a resident. With the person being a resident, the first condition I'm checking is that in the last 7 years, the person has been only for 420 days. With the person being here only for 420 days, the answer automatically becomes resident, but not ordinary resident. R and OR is the right answer here. Yes, easy question. Question number 3. There is a person called Mr. Rajesh, age 53 years, and his wife Mrs. Soumya, who's age 50 years, and both are citizen of country X, people foreign citizens. They are living in country X since birth, okay. They are not liable to tax in country X, okay. Both of them have keen interest in India culture, fair enough. Mr. Rajesh's parents and grandparents were born in country X, which means they are not having a person of Indian origin as well. Mrs. Soumya visits India along with Mr. Rajesh for 4 months every year to be with her parents who were born in Delhi. Now people, notice carefully, for Mrs. Soumya, they have come and clarified that Mrs. Soumya's parents are in Delhi, which means Mrs. Soumya is a person of Indian origin. During her stay in India, they organized cultural programs in Delhi NCR. The income of Mr. Rajesh and Mrs. Soumya from Indian sources for the previous year 24-25 is 18 lakhs and 16 lakhs. Mr. Rajesh is 18 lakhs, Mrs. Soumya is 16 lakhs. What is the residential status of Rajesh and Soumya? People, let's look at both of them individually. First, coming to Mr. Rajesh. In the case of Mr. Rajesh is a foreign citizen, neither a person of Indian origin. With that conditions being satisfied, the person has to check for both the conditions. 182 days also, 60 plus 365 also. In the current year, they are coming to India for 4 months every year. Yes, so they have visited India 4 months every year, including the current year, which means the current year Mr. Rajesh has been for 60 plus days. 4 months for the last 4 years becomes 120 days in every year, and therefore that becomes 480 days, which means Rajesh is a resident. But if I look at 4 months, 120 into 7 will give me 840 days. So to that extent, Rajesh is satisfying all the conditions. Rajesh should be a resident and ordinary resident. Yes. So let's check where the questions are resident and ordinary resident. For the person of Rajesh, both the cases are resident, probably. Both the cases are non-resident, no. This cannot happen. Mr. Rajesh is a resident but not ordinary, no. Mrs. Soumya is resident but not ordinary resident. Mr. Rajesh is resident and ordinary. So we'll have to check what is the condition for Soumya as well. Coming to Rajesh, Rajesh is clearly an ROR. Yes, Rajesh is ROR. I hope you all are getting this one. Now coming to Mrs. Soumya. Soumya is a person of Indian origin. Now, as a person of Indian origin, if you're outside India and visiting India, they will check your Indian incomes. Question says that the Indian income is 16 lakh rupees, which is more than 15 lakhs. With your Indian income being more than 15 lakhs, the condition is that you should stay in India for 120 plus 365 days. You have stayed for 120 days? Yes, because they're coming in for 4 months. Have you stayed for 365? Yes, because 4 months every year becomes 480 days, which means Mrs. Soumya would automatically become an RNOR. With that condition getting satisfied, the answer becomes option number D. The answer becomes option number D. So that is what you need to pay attention to. Yes? Sweet. Look at question number 4. Question number 4 says, who among the following will qualify as a non-resident is the question. Mr. Bob, who's an Italian dancer, foreign citizen, coming to India on a visit to explore Indian dance on 15th September 24 and has left India on 25th December 24. People, 15th September 24 means this day will also be considered a stay in India. This is not a crew member. So I will exclude 14 days in my September count. Yes. So therefore 31 minus 14 days will be excluded. 17 days is what he was there in September. October he was there for full 31 days. November he is there for 30 days. And December he is there for 25 days. So therefore he is totally staying in India for 103 days. 60 days condition satisfied. For the past 4 years, he has visited India for dance competition and stayed in India for 120 days. People, in the current year, he satisfied 103 days. In the current year, he satisfied 103 days. And in the last 4 years, he satisfied 480 days. Has he satisfied all the conditions? Yes. He's been in India for 60 days. He's been in India for 365 days. Therefore, this person is a resident. Therefore, Mr. Bob is not the resident and not a non-resident. Mr. Samrat is born and settled in USA, foreign citizen, visits India every year for 100 days to meet his parents and grandparents, born in India in 1946, living in Delhi. Indian income is 15 lakh 20,000. People, this person is born in USA, but the parents are from India, which means Mr. Samrat is a person of Indian origin. A person of Indian origin outside India visiting India needs to satisfy Indian income more than 15 lakhs. Indian income more than 15 lakhs, yes. After he satisfied Indian income more than 50 lakhs, he needs to be in India for 120 days plus 480 days. In the current year, he was there for only 100 days, which means Mr. Samrat is a non-resident. Mr. Samrat is a non-resident. Looking at Joseph. Mr. Joseph is an American scientist who has left India to his home country for fixed employment there. People, American scientists leaving India for employment has no exception to the rule. The exception to the rule is only for Indian citizen leaving India for employment purposes. He stayed in India for study and research in medicines from 1st January till 1st July 2024. Now people, I do not care what happened in January and all in 2019. I want to know what happened in the current year. In the current year, the guy was there from April, which means April he was there for 30 days. May he was there for 31 days, June he was there for 30 days, and July he will consider one extra day, which is 1st July, and therefore 92 days he was there in India. Now from 2019, if you check, 2019 to 2023 will become almost about 19, 20, 21, 22, 23, which means he's been in India for all 365 days in all the last 4 years, which means Mr. Joseph also becomes a resident, and therefore Joseph will also not be the right answer. There simply means that Mr. Samrat is the only non-resident in this question. Therefore, that's option number B. That is option number B. Make sense? Make sense? Yes. Yes. Look at question number 5. Question number 5 says there is a person called Mr. Square, an Indian citizen, and is currently residing in Dubai, which means an Indian citizen living outside India. He has come to India on a visit and his total stay in India was 135 days. In the current year, an Indian citizen is dropping into India and staying for a visit purposes, 135 days satisfied. Not liable to tax in any Dubai. The not liable to tax conditions will only come if the person becomes a non-resident. So let's wait and understand this. During the last preceding years, what is the stay given to you? 23-24 was 100 days, 22-23 was 125 days, 21-22 was 106 days, and 2021 was 83 days. If I add all the numbers, people, the last 4 years number, I get 100 plus 125 plus 106 plus 83 days, which becomes 414 days, which means last 4 years he has satisfied the 365 days condition. What shall be his residential status for the previous year 24-25 if his total income other than foreign sources is 10 lakhs? Now people, the Indian income is 10 lakh rupees. It is less than 15 lakhs. When an Indian citizen outside India is visiting India and the Indian income becomes less than 10 lakhs, the answer is automatically a non-resident if he does not satisfy 182 days. In the current year, the person was there only for 135 days, which means the answer is directly a non-resident. Now, will the deemed residency provision apply? The answer is no. Why will the deemed residency not apply? Because for deemed residency to apply as well, the person needs to have at least an Indian income more than 15 lakh rupees. Again, with an Indian income up to 10 lakh rupees, this also does not get satisfied. Look at question number 6. Determine the residential status of Sundaram HUF, which carries out its transactions in Malaysia. Its affairs are partly controlled from India. Now people, when you have an HUF and the affairs are partly controlled from India, the person HUF is a resident in India. The Karta of the HUF, Mr. Sundaram, who is from Chennai, visits India on 1st June 24 and has left Malaysia on 10th February 25. He has not visited India for the last 11 years. Now people, the HUF's Karta's stay in India is not very relevant for me in the current year because HUF will be determined based on control and management. The HUF control and management has been determined partly in India, which means HUF is a resident in India. For the purpose of checking ROR and RNOR, I will check Karta's past year's data, not current year's data. In the past 11 years, he has never visited India, which means his stay in the last 7 years is less than 730 days. Therefore, Karta, if at all he is a resident, would be RNOR, automatically making my HUF also RNOR. Option B is the right answer. Yes, this was a fairly easy question, people. Question number 7. Income from a business in Australia, controlled from Australia, is taxable in whose case? People, a business in Australia, controlled from Australia, with no control happening in India, RNOR will not be taxable. NR is definitely not taxable. There is only one person which can pay tax on this, which is ROR, because global income for him is taxable. So option A is the right answer. Yes. Question number 8. Question number 8 says, Mr. Raman, a citizen of India, was employed in Hindustan Lever Limited. He resigned on 27 September 24, which means he's left India on 27 September probably. Let's check. He received a salary of 40,000 rupees per month from 1st April to 27 September from Hindustan Lever Limited. Okay, Indian income. Thereafter, he left for Dubai for the first time on 1st October 24. So, he's not left on September, people, he's left on October. and got a salary equivalent of rupees 80,000 per month from October to 31st March 25. Now notice carefully people, this is an Indian citizen leaving India for employment purposes. If that has to be a resident, then he has to satisfy 182 days condition. His salary for October to December was credited in Dubai account and the salary for Jan to March 25 was credited in Mumbai account. He is liable to tax in what? To determine this, first of all, you need to know whether he is a resident or a non-resident. Let's understand this carefully. The person has left Dubai on 1st October 24. So let's check how many days he was in India. In April, he was there for 30 days. May, he was there for 31 days. June, he was there for 30 days. July, he was there for 31 days. August, he was there for 31 days. September, he was there for 30 days. And October, he was there for 1 day, which becomes 184 days. People, 184 days means the person has been in India for 182 days and more, and therefore the person is a resident. With the person becoming a resident, we now need to check whether he is an ROR or RNOR. The question has not mentioned about what is the status of the past years, but the question says the person is a citizen of India employed in Hindustan, which means the assumption is last 10 years or last 7 years he was always in India, which means Mr. Raman is an ROR. With Mr. Raman being determined as an ROR, people, the life becomes easier. Because Mr. Raman is ROR, the global income becomes taxable for him. Global income would mean all income from India and from Dubai, and therefore the answer is option number B. Answer becomes option number B. Yes, yes, yes. This is something you'll have to pay attention to, people, because if you had determined this as an RNOR, you would have taxed only Indian income. You would have not taxed Dubai income. So please pay attention. Question number 9. Ashish is earning the following incomes during previous year 24-25. Interest on UK development bonds 4 lakh rupees, in which 1/4 is received in India. Capital gains on sale of building located in India but received in Holland 6 lakh rupees. If Ashish is resident but not ordinary resident, so now Ashish has been determined as an RNOR. People, if Ashish is an RNOR, I will be taxing his income received in India, income deemed to receive in India, income accruing and arising in India, deemed to accrue and arise in India, accruing and arising outside India from a business controlled from India or profession set up in India. In this first case, interest on UK development bonds means bonds are outside India. But in that 4 lakh rupees, 1/4 is received in India, which means I am taxing 1 lakh rupees in India. Coming to the capital gains asset itself is located in India, people. With the asset being located in India, the whole income is accrued in India and therefore the full number is taxable in India, and therefore the final answer on this should be 7 lakh rupees. Yes, 7 lakh rupees is the right answer here. Easy question. Question number 10. It says Mr. Tejas is an Indian citizen and has left India permanently with his wife and 2 children for extending his retail trade business of toys in Canada for the year 2016. Now notice carefully, people, this person is leaving for a retail trade purposes. He is not leaving for employment purposes, he is leaving for business purposes. From Canada, he is managing his retail business of toys in India as well. For the purpose of his Indian business, he visits India every year from 1st September to 31st January. Let's check, people. 1st September would mean 30 days, October would mean 31 days, November would mean 30 days, December would mean 31 days, and January would mean 31 days. So he was there in India for 153 days. His business income is 23,50,000 and Indian income is 18 lakhs is from Canada. Oh, 23 lakhs is from Canada and 18 lakhs is from India. Nevertheless, Indian income is more than 15 lakhs. He has no other income during previous year 24-25. They are asking you to determine the residential status and the income taxable in his hands. Now, people notice carefully, because this is an Indian citizen who is outside India and is visiting India. Indian income more than 15 lakhs, you have to satisfy 120 days plus 365 days condition. The person has been in India for 153 days in the current year. So, 120 days satisfied. Also, the question is coming and saying he is doing this every year. So, 153 days into 4 will give me 612 days, which means in the last 4 years also he was there for more than 365 days. This automatically makes Mr. Tejas as an RNOR. With Mr. Tejas becoming an RNOR, one thing is clear, his Indian income is going to be taxable. Looking at his Canada business, his Canada business is not controlled from India. He is in fact sitting in Canada and controlling the business in India, which means technically only Indian income is going to be taxable. He is not going to be taxable for his foreign income. And therefore, the answer would be resident and ordinarily resident, no. Non-resident, no. Resident but not ordinarily resident, answer is yes. He will be taxable for RNOR and 18 lakhs from Indian business alone would be taxable in this case. Would be taxable in this case. Yes or no? Yes. So, this is what the fact pattern will look like. Question number 11. Mr. Sushant is a person of Indian origin and is residing in Canada. PIO and in Canada. During 24-25, he has visited India on several occasions and his period of stay in India is amounting to 129 days, and his period of stay in India during 23-24, 24-25, 23-24, 22-23, 21-22 and 20-21 is given as 135, 115, 95 and 125. Let's total this. 135 plus 115 plus 95 plus 125 more than 365 days, therefore 470 is coming in. He has earned the following incomes in the current year. Income received or deemed to be received in India, 2,50,000 people. Now, this is a peculiar question where they have not mentioned the Indian income. You will have to find the Indian income. How do you find an Indian income? You will assume that the person is R and OR and tell what his taxable incomes are. Looking at that understanding, income received or deemed to receive in India, is it taxable? Yes, this is fully taxable because he is an R and OR. Income accruing or arising in India, which is deemed to accrue or arise in India, definitely taxable. Income accruing and arising in India and received outside India from business controlled from India. If I am an R and OR, this also becomes taxable. Income accruing and arising outside India from business controlled outside India, no, this is not taxable, which means the above three alone will be taxable. So 2,50,000 plus 3,75,000 plus 5,50,000 becomes 11,75,000. 11,75,000 worth of Indian income means that the person is not satisfied 15 lakh condition. Which he is not satisfied 15 lakh condition, the only basic condition would be the 182 days. In the current year, he has been there for only 129 days and therefore he is a non-resident. So I can conclude that Mr. Sushant is a non-resident. I can conclude that Mr. Sushant is a non-resident. Now, with a person being a non-resident people, he is only taxable for income received in India, deemed to receive in India, accruing and arising in India and deemed to accrue and arise in India. Which means in my illustration, 2,50,000 and 3,75,000 will remain as it is, but the 5,50,000 will now become not taxable. With that understanding, my taxable incomes will become 2,50,000 plus 3,75,000 and therefore the answer becomes 6,25,000. Yes, 6,25,000 will be the answer and therefore that is option number A. Yes, 6 non-resident with the 6,25,000 worth of income is what is taxable. Clear? Clear? Yes, this makes life easier for all of us. Question number 12. Model test paper number 6. Question says, Mr. Sushil is a person of Indian origin and is residing in Canada. Again, foreign guy sitting outside India. During the 24-25, he visited India on several occasions and during this period, his stay was 129 days and the days was 135, 150, 95 and 125. Oh, looks like a repeat question, people. Yeah, this one looks like a repeat question. The name alone has changed. So therefore, can I conclude that the answer is A? Yes, the answer is A. This is a repeat question. You can probably ignore this question off. That's it. Yes, awesome. This is what the residential status looks like. I think we didn't have any case study questions. The case study questions is probably part of your comprehensive list because they didn't want to test a residential status standalone basis. So this is what the residential status looks like, people. I think the questions were fairly nice. I would prefer that if you all can please pay attention to question number 11 for your exam purposes. This is a very beautiful question which you should pay attention to. Apart from that, what are the questions? You can actually go through every other question also, people, just on a high level because things are interesting in these kind of questions. What you normally predict as the question being non-resident has been all taken as RORs in this cases and therefore this is a good question for all of you to practice. Keep residential status in check because that's an important chapter. Easy 4-mark question for your exam, people. Nothing complicated about this chapter. You should be able to pay attention to this chapter. Yes. That's it, people, for today's video. We'll be coming back with another video discussing the balance chapters and quickly completing this MCQ guide so that you can start preparing well for your exams. Happy learning to all of you and until we meet next time, see you, take care. Bye-bye. Hey boys, I hope you're all doing well. Welcome back to the MCQ series where we'll be discussing today one of the most important chapters of your CA inter syllabus, your income from salaries. Now this chapter has about 15 MCQs covering both your individual MCQs and case study MCQs. So therefore, yes, this chapter really becomes important. I also noticed that there are some places where the chapter questions are a little tricky and altering, because of which you may not have completed the whole MCQs from your side as well. So therefore, this video will probably help you answer those particular questions which you have in those particular MCQs. Let's deep dive into the topic and let's understand what kind of questions has been given by MCQs, given by ICA. For those people who are attending this for the first time, let me clarify this to you. The MCQ guides are already available in the description box. So please click on the link in the description box and you'll be able to get access to the MCQ guide. If any of your friends are also attempting September 25 or Jan 2026 inter exams, please share these MCQ guides with them as well so that everyone can maximum benefit from this. I can assure you the MCQ guide covers all MCQs which has been released by ICA in the past 2 years from the new syllabus incorporation, including the latest MTP number 2 of May 2025 as well. Yes, let's deep dive into the subject and let's understand what the topics are. First question in income from salaries. It says, Mr. Ramesh is a citizen of India and is employed in Indian embassy in Australia. People, the first thing I'm noticing, there is an Indian citizen and the person is employed in an Indian embassy sitting in Australia. The provisions of income tax would come and say that when a person, an Indian citizen who's going for a foreign country as an Indian ambassador, whatever salary he receives from government of India will be fully taxable. However, if he receives any allowances or perquisites, that will become exempt from taxes. I'm assuming that's what the question talks about. He's a non-resident for 25-26, really doesn't matter. He received salary and allowances in Australia from government of India, okay, for services rendered by him. In addition, he was allowed perquisites also by the government of India. Which of the following statements is right? Salary allowances and perquisites received outside India are not taxable? No. Salary allowances and received outside India are taxable? No. Salary received by Ramesh is taxable in India, but allowances and perquisites are exempt? Yes, this is the right answer. So option number C becomes the right answer. Yes, yes, easy question. Look at question number 2. Mr. Hari and Sujoy, resident and Indian citizens, have been appointed as a senior official of country A embassy and country B embassy respectively in India in October 2024. Where are we? Yes, Mr. Hari and Mr. Sujoy are subjects of country A and country B respectively and are not engaged in any other business or profession in India. The remuneration received by Indian officials working in Indian embassy in country A is exempt, whereas country B is taxable. The tax treatment of the remunerations received by Hari and Sujoy from embassies of country A and country B are what? Now people, this is coming from the exemptions chapter. The exemptions chapter comes and says that when a person who is working as an ambassador for a foreign government is generally exempt in India if he is not engaging in any business or profession in India and is only receiving salary. Second, if our employees are also exempt in their countries. Yes, however, the one trick point or the one catch point here is that this whole exemption only applies when the employees are not citizens of India, meaning they should be citizens of that respective countries and not citizens of our country. The one trick point here is that the question says the persons are Indian citizens. With the persons being Indian citizens, there is no exemption given anywhere. With no exemptions given anywhere, all monies which is received by these employees would be fully taxable in India because the monies are received in India. The answer would be option number B. The answer would be option number B. The catch point here is the Indian citizen part, people. You should have been a foreign citizen in order for this to be exempted for at least country A. Because country A was exempting our employees, we could have exempted country A provided the Mr. Hari was not Indian citizen, Mr. Hari was a foreign citizen. Yes, so the catch point here is that, which is why people would have made mistakes here. Pay attention. Question number 3. Mr. Roy is an Australian citizen and is employed in an Indian embassy in Australia. He is a non-resident, receives salary and perquisites. Now, same question as question 1, people, but the catch point here is in this question, the person is an Australian citizen. We just discussed that the exemption of allowances and perquisites are only rendered for Indian citizens and not for foreign citizens, which means in this case, I will not apply the normal rules. Normal rules here would be that you will check the person as a non-resident status. A person as a non-resident, people, is receiving salary outside India, therefore not taxable in India. Receiving allowances outside India, not taxable in India. Receiving perquisites outside India will not be taxable in India. Therefore, the option A will be the right answer here. Yes, the option A would be the right answer here. Please notice carefully that section 9, which is the deeming provisions, only apply when the government gives money to Indian citizens for working outside India. When government is giving any money to any foreign citizens, it is not taxable in India. It is taxable in that respective country. So 3A is the right answer. A very, very good question, people. 1 and 3 can be a combination question. You need to know which one is the difference. Question number 4. Mr. X is a foreign national and a citizen of USA and is working with M Inc., a US based company, came to India on 24-25 for rendering services on behalf of the employer. So a foreign national, citizen of USA. So foreign national working outside India. A US based company has come to India for 24-25 for rendering services on behalf of his employer. He wishes to claim a salary income earned during in India as exempt. Which of the following statements is not a condition to be fulfilled in order to claim such income as exempt? They want to know which one is not a condition, which means everything else should be a condition for it to be exempt. First one, M Inc. should not be engaged in any trade or business in India. Yes, this is a condition, people. A foreign national, if he is coming to India and rendering services for a foreign enterprise, the foreign enterprise should not be having any trade or business in India. Otherwise, it will be fully taxable because the PE will get established. Second, Mr. X should not be engaged in any trade or business in India. People, I don't think there is any such condition like this in India because he's a salaried employee. There is no such condition as such. Mr. X's stay in India should not exceed 90 days. Yes, this is a condition which is given in income tax. You should not stay for more than 90 days because after that, your employee PE will start triggering. Fourth one, remuneration received by Mr. X should not be liable to deducted from Ming's income chargeable under Income Tax Act. They should not be allowing this as an expense. This is also a condition, people. Option number B becomes the right answer. Yes, option number B becomes the right answer. You should not be, there is no such condition that you should not be engaged in any trade or business in India. That can be done by the employee. The employee is perfectly allowed to do so. Question number 5. Now, HRA paid to an employee residing in Patna is exempt up to the lower of actual HRA, excess of rent paid over 10% of salary, and what, people? When it comes to HRA provisions, least of the three is exempted. The actual HRA received 50 or 40% of salary and rent paid minus 10% of salary. Now, the middle condition says 50% of salary only when it is Chennai, Delhi, Mumbai and Kolkata. If it is any other location, it is 40% of salary. Because this person is in Patna, I will give the answer as 40% of salary. So, 40% of salary is the right answer. Yes, this one was an easy, straightforward question. Question number 6. Anirudh stays in New Delhi. His basic salary is 10,000 per month. DA 60% of which is forming part of pay is 6,000 rupees. HRA received is 5,000 per month and he is entitled to a commission of 1% on the turnover achieved by him. Anirudh pays a rent of 5,500 rupees per month. The turnover achieved by them in the last 12 months is 12 lakh rupees. The amount of HRA which will be exempted if he exercises the option of shifting out of default regime. Now, people, they want the HRA rules. HRA rules is very simple. You have to take the least of the three. Let's understand the least of the three. First one says actual HRA which I have received. How much HRA have I received? I have received a HRA of rupees 5,000 per month, which means I have totally received a HRA of rupees 60,000. In this, I am exempted for least of the three. Yes, I am exempted for least of the three. One is actual. What is my actual? I have received 60,000 rupees. So, that is fully exempt. Second one, I have received 50 or 40% of salary. People, the person is in Delhi. So, therefore, he will be eligible for 50% of the salary. Now, 50% of what is the question? I have my basic salary as rupees 10,000. I have my DA, which is 60% forming part. And therefore, I will take 10,000 plus 3,600, which is 60% of 6,000 plus my 12 lakhs is my total turnover and commission is 1% of it. So, therefore, this will become 12,000 rupees. Correct? Yes? Yes? No. 1 second. So, this is 12 lakh rupees into 1% will give me 12,000. Yes. So, 12,000 will be the commission which I am taxable for. 10,000 plus 3,600 will be my monthly salary, which means 13,600 into 12 will give me 1,63,200. M plus of this and MRC becomes my total salary of 175,200. So, which means it is 50% of 175,200. Half of this becomes what, people? It becomes 87,600. Yes, and the last one says rent paid minus 10% of salary. People, we just found out my salary is 175,200. So, 175,200 ka 10% will give me 17520, which I am putting in M minus. I have payment of salary of 5,500 into 12, which gives me 66,000 M plus, and I get the answer as 48,480. Yes, least of the three, people, I am seeing on the screen is 48,480. Therefore, the answer should be that. Answer is option number A. Yes, easy question, people. Nothing really complicated about the question. Question number 7. It says, Mr. Hari receives a voluntary retirement compensation of rupees 8 lakhs after 30 years, 2 months of service. He still have 5 years of service left. At the time of voluntary retirement, he was drawing a basic salary of 15,000 rupees per month, DA which is not forming part of pay of 3,000 rupees per month. You're required to compute his VRS, assuming that he does not claim any relief under 89. Now, people, when it comes to VRS, in my classes itself, at least I've told you, VRS is not the most important thing when it comes to exam because the provisions are a little complex. It is least of the 4, but from a practical standpoint, I'm not really going to worry about this. Yes, I'm not going to worry about this. My answer on VRS would be the least of the 4, where normally the limit in that is given as 3 lakh rupees. So, I would say the answer is rupees 3 lakhs directly. Yes, I would say the answer is rupees 3 lakhs directly. Let's take it with that and let's close it. Let's close it here. I don't really want to spend time on VRS when we're not reading it from exam perspective as well. Yes, question number 8. Mr. Anand is provided with the furniture of the value of 70,000 rupees along with his house from 1st April 24. The actual hire charges is given as 5,000 rupees per annum, the value of furniture to be included. Now, this is where I say normally tricks you, people. When it comes to furniture, the rules of furniture under salary is that you will only check for owned or hired. If it is hired, then you directly take the hire charges as the taxable perquisite. It doesn't matter what the cost of the asset is because you're doing hiring on this. The cost of the asset is only relevant when the asset is owned by the employer. So, which means the 70,000 rupees which is given to you is not really relevant. The question is talking about higher charges. So, higher charges becomes the right answer and therefore, I will take 5,000 rupees as the answer directly. Yes, this is a one way of ICI to trick you. Please pay attention to the fact that when it comes to furniture, hiring directly means higher charges. It is not higher charges or 10%, whichever is lower. That's not how it operates. Question number 9. For the purpose of determining the perquisite value of the loan at the concessional rate of employee, the lending SBI rate as on what date should be taken? People, it is SBI lending rate as on 1st April of the previous year, which means the answer is option number A. Yes, straightforward questions, people. XYZ Private Limited has provided a car below 1.6 litre cc along with a driver to Mr. Sanjay, employee of XYZ Private Limited, partly for official and partly for personal purposes. The expenses incurred by the company are running and maintenance 32,000, driver salary is 36,000. The taxable value of the car is asked. People, here when the car is also given by the employer, the running and maintenance is also borne by the employer, and the driver is also given by the employer. I will take the taxable perquisite as 1,800 for the car and the running and maintenance, and 900 rupees for the driver salary, which means totaling to 2,700 rupees. I gave him the car for the whole year, I am assuming. Yes, I've given the car for the whole year, therefore I multiply this with 12 and the answer becomes 32,400 rupees. Yes, that's simple this question is. Question number 11. Mr. Jagat is an employee in accounts department of Bharat Limited, a cellular company operating in regions of eastern India. Okay. It is engaged in manufacturing of cellular devices, and during the financial year 24-25, the following transactions were undertaken by Mr. Jagat. He has attended a seminar on perquisite valuation where the seminar fees is 12,500 and is paid by the company. People, educational facilities for an employee is fully exempt. It doesn't matter whether it is for what reasons, but educational facilities for an employee is fully exempt if it is paid by the employer. So this one should be fully exempt. Next, tuition fees of Mr. Himanshu, son of Mr. Jagat, paid to private coaching classes, not having any tie-up with Bharat Limited, was reimbursed by the company. The amount of fees is 25,000. Now, when it comes to tuition fees of Mr. Himanshu, people, when it comes to educational facilities of the child, there are two conditions to be satisfied. Condition number 1, there should be an employer-owned school or employer-tie-up school, and the total cost of the education should be less than 1,000 rupees per month. Yes, now in this case, both the conditions are not being satisfied because neither it's a tie-up school nor the cost is less than 1,000 rupees per month, which means this is fully taxable. Next, Mrs. Swapna, daughter of Mr. Jagat, studies in Bharat Public School, owned and maintained by Bharat Limited, where the tuition fees is 750 per month paid by Mr. Jagat. The cost of the education of similar education is 5250 per month. Now, people, when it comes to point number 3, it does not matter what Mrs. Swapna is paying. It matters what the actual cost of education is. Notice the cost of actual education, it is 5,250 per month, which means that is taxable. So I'm taking 5,250 and I'm minusing 750. My perquisite value is 4,500. Multiplying this with 12, I get the perquisite as 54,000. Adding to that my perquisite of 25,000, the answer becomes 79,000. The answer becomes 79,000. So option number D is the right answer. Option number D is the right answer. Yes, that simple this one is. Please pay attention to the fact that point number C, while Mrs. Swapna will be paying only 750, it is not the cost what the daughter is paying. It is the cost which the normal education would charge. Because the normal education is more than 1,000, it is fully taxable. Swapna's money is just a recovery. So to that extent, I will not tax it as a perquisite. That does not automatically make it less than 1,000 and therefore exempted. Please note that fact very, very carefully. Yes. Let's move on forward. Question number 12. It says, Mr. Kashyap is receiving a basic salary of rupees 20,000 per month. He is also receiving child education allowance of 3,000 for 3 children and transport allowance of 1,800 per month. You are required to assume that he is exercising the option of shifting out of default regime and the salary chargeable to tax is requested for. Notice some couple of things carefully, people. First, you have child education allowance of 3,000 rupees given to you. Now, under income tax, child education allowance is exempted for 1,000 per month, but it is restricted for 2 children. If I am receiving 3,000 for 3 children, that totally means that I am receiving 1,000 per children. Now, I am exempted up to 100 per month, which automatically means 1,200 per month can be exempted. In the 3,000, 2,000 pertains to 2 children and therefore that becomes fully exempted from tax. So which means, can I come and say that in my basic salary, I am fully taxable for my basic for 2,40,000. In my child education allowance, out of the 3,000 rupees, 2,000 rupees is pertaining to children and I can claim an exemption up to 2,400, which means only 1,000 rupees will be remaining and that will become fully taxable. This leaves me with transport allowance of 1,800. Now, transport allowance is only exempted if you are a disabled person. This question does not mention anything about disability and therefore I will assume that the 1,800 is fully taxable and therefore that becomes 21,600. This gives me my total gross salary. My total gross salary will become 2,41,000. Total becomes 2,62,600. notice carefully, the question is not asking for gross salary. The question is asking for income from salary, and therefore I will have to grant a 50,000 standard deduction, giving me the answer as 2,12,600 rupees. Therefore, answer B. Therefore, answer B. That is what the question is. Simple question. Let's look at question number 13. The question says, Mr. Karan has completed his MBA in April 2024 and has joined XYZ Limited from 1st May 2024. Notice carefully, people, the person is joining from May 24, which means he's there only for 11 months in the company. His basic salary is 2,25,000 per month. He is paid 12% of basic salary as DA, forming part of retirement benefits, and has also contributed 11% of his pay and DA towards recognized provident fund, with company contributing the same number. So I've been given the basic salary. DA is 11%, which is DA is 12%, which is forming part of retirement benefits. The total of this is taken, and then 11% of this is contributed by employee also, employer also. The accumulated interest on the provident fund is given as 49,325. Okay. What would be the income chargeable to tax under the head salaries of Mr. Karan for assessment year 25-26 if you exercise the option of shifting out of default regime? Now, most of you people should have got the answer as option number C, which, if you honestly come and ask me, is the right answer. But for some reason, IC has made a difference of opinion. Let me tell you what is happening. First, let's put out the facts. If I understand this question carefully, the question is coming and saying my basic salary is 2,25,000 per month. So if I take that 2,25,000 into 11 months, will give me the answer as 24,75,000. Yes. Then comes my DA, which is forming part, which is 12% of the salary, and therefore that becomes 2,97,000. Here comes the interesting part. First, I will look at my employer's contribution. If I look at my employer's contribution should be about 11%, which is 304,920. Yes. Now, when it comes to employer's contribution on PF, people, the provisions come and say that if the contribution is less than 7.5 lakhs for the annum, you are exempted for 12% of basic salary plus DA forming part plus turnover commission. In my question, I have done basic plus DA forming part as 11%, and therefore employer's contribution has become fully exempt. Yes. So I will treat this whole employer's contribution as exempt from taxes, and I will proceed forward. Here comes the interesting part, the issue on the employee's contribution. Now, income tax says when it comes to employee's contribution, an employee cannot contribute more than 2.5 lakhs. If an employee contributes more than 2.5 lakhs, whatever excess contribution he makes will still not be taxable, but the interest on that employee's contribution will become taxable here. In this case, normally I would come and say when the employee's contribution is more than 2.5 lakhs, the interest should ideally be taxable under IFOS, not under salaries. But here is a case where ICI has made an assumption that this will also become taxable under salaries. So on the assumption that it is taxable under salaries, how does it operate? Understand, people, employee is contributing 3,04,920. Employer is also contributing 3,04,920, and this whole thing is giving you an interest of 49,325. Yes, I want to know what is happening for the employee's contribution. Now, if employee is contributing 3,04,920, his taxable component is minus 2,50,000, which is 54,920. So what will happen if I contribute 54,920 is the question. I will do a cross multiplication, people. A simple cross multiplication will give me the answer. So 304,920 into 2 will give me 609,840. Put this in M plus 49,325 divided by this number will give me my interest rate, which is about 8%. 8% is my interest rate. Multiply this with 54920 divided by 100 will give me the answer as 4442. Yes, and therefore my taxable interest is 4442. This is what I will take into consideration, and I will put it here. My taxable interest will become 4442. My total salary is how much, people? It is 2,475,000 plus 2,97,000 plus 4442. Why? Because the employer's contribution is anyway exempted, and therefore 2,776,442 becomes the answer. But in that 2,776,442, people, I have standard deduction to be granted of rupees 50,000. So granting the standard deduction, I get the answer as 2,726,442, which is what my answer to option A looks like. Yes. Now, if you honestly come and ask me as a faculty, I would say you option C is the right answer. I would tell you option C is the right answer and not option A, people, because technically speaking, the interest on employee should be taxable under IFOS and not under salaries. So to that extent, yes, the answer is definitely wrong. I would not agree to option A as the right answer, but just to match the answer with what ICI has given you, I'm giving you option number A. So please note that from an exam perspective, if at all a question comes where they're asking you employees contribution exceeding 2.5 lakhs, the interest on that will also be taxable under salaries as per ICI's understanding. Keep that thought in mind. Moving forward, I have question number 14. Two case study questions, people. Case study question number 1. It says, Mr. Anshul is age 54 years and is an Indian citizen working as assistant manager in ABC Limited. He is getting a basic salary of rupees 58,000 per month. Good enough. He used to frequently travel out of India for his work, and therefore he left India from Delhi airport on 5th October 24 to return to India on 2nd April 25. First things to note, people, is that the return is on 2nd April 25. I don't care when the return is, if it is happening after financial year end. If the return is happening after financial year end, I will stop at 31st March itself. Which means if I have to understand how many days he was in India. He was in India for April 30 days, May 31 days, June 30 days, July 31 days, August 31 days, September 30 days, and October he was there for 5 days, which means he was there for 188 days. The guy is a resident. No problems here. Resident and an ordinary resident would be the answer. For 24-25, the following information is relevant. They have given him a DNS allowance, which is 10% of basic pay, and that is also forming part of retirement benefits. Bonus is 98,000. Medical allowance paid during the year is 60,000. People, medical allowances are actually fully taxable. This is fully taxable. This is fully taxable. This is fully taxable. This is also fully taxable. He was also reimbursed medical bill of his mother amounting to 15,000. People, when it comes to medical treatments, it is still taxable unless and until it is for government visits, if it is for a employer's own hospital, specified disease, or if it is COVID related disease. Pure reimbursements are always fully taxable. He was also reimbursed salary of his house servant of 4,000 per month. No doubts here, people. Again, servant charges will be fully taxable for him as well. Professional tax, which is paid by the employer amounting to 2,400. People, this is paid by the employer and therefore fully taxable as a perquisite and then granted as a deduction. 400 equity shares were allotted to him by ABC Limited at a rate of 250 against the market value of 350. People, I have been given a benefit of employee stock option and therefore 100 rupees per share will also be taxable here at the price of 400 shares. Mr. Anshul has exercised the option of shifting out of default regime. The person is going for alternate regime. Good enough facts. Based on the facts, you are required to give the most appropriate option. What is the Anshul's residential status? Now, people, Anshul's residential status for the current year, I know that the person is a resident. But the problem in this question is, question does not mention what happens in the past years. It just says he frequently travels outside India. That does not change any facts, which means I am not really sure whether the person is ROR or RNOR. I would keep the answer as a simple resident and close the answer. Therefore, the answer is resident. Therefore, the answer is resident. Do not make assumptions of the past years, people, unless the question comes and talks to you about it. Next, the question comes and says, tell me what the taxable perquisite is. Now, people, for me to do taxable perquisite, I need to know first which one is perquisite and which one is allowance. Point number 3 is still an allowance. Point number 4 is a perquisite, so point number 4 gets added, so 15,000 rupees. Point number 5 is also an allowance, a perquisite, and therefore that will also get added. 4,000 into 12 will become 48,000. Professional tax is also a perquisite, so that also gets added. Then 100 rupees and 400, so 40,000 will also get added for my employee stock option. Therefore, the answer should come as 1,05,400 rupees. Yes, the answer should come as 1,05,400 rupees. What and all have I considered, people? I have considered the medical bill. I have considered the medical bill. I have considered the servant charges. Yes, I have considered medical bill, servant charges, professional tax, and also what is called as your ESOPs. This is what I have taken for the purpose of computing this taxable perquisite. Keep that in mind. What is the income chargeable to tax under the head salaries has been requested, people. Now, I have to compute the whole data. So, which means 58,000 into 12 is my taxable basic, which is 6,96,000, putting it in M plus. I have 10% of basic on this, which is 69,600, again M plus. I have bonus of 98,000, which is going to M plus. I have medical allowance of 60,000 rupees, which is also going in M plus. I just found out what is my taxable perk, people. My taxable perk is 1,05,400, which also goes to my M plus. I have nothing else. Yes. So my total MRC will give me my gross salary. My gross salary will come as 10,29,000, people. With my gross salary as 10,29,000, I will now claim two things. One is my professional tax of 2,400 and I will claim a standard deduction of 50,000. Therefore, my answer should come as 9,76,600 rupees. Yes. Therefore, option A is the right answer. Option A is the right answer. Fairly simple question, people. If you add everything, you'll get the right answer. So therefore, there is no problem here. Yes, question number 15, the last case scenario question. It says, Mr. Hardik is age 45 years and is appointed as a senior executive officer in Sky Limited. So which means I have a senior executive officer in Sky Limited, the Mumbai, on 1st February 24. People notice this is 1st Feb 24. 1st Feb 24 does not form part of my financial year. I am only bothered about things which is forming part of my financial year. But when he joined at a pay scale of 35,000 per month, 3,500 of increment and 65,000 is my end salary per month. He's been paid a DNS allowance of 40% of his retirement benefits. The person has been given a rent-free accommodation on 1st October 2024. Current financial year, only from October I've received RFA. The company pays him a lease rent of 5,000 rupees per month, which means the house is not owned, the house is hired. He has been provided a car with the CC of 1.6 liters, which is used by him for private purposes only. A pure private purpose car, people, has been given to him. Actual cost of the car will be 8 lakh rupees. When a car is fully used for personal purposes, the cost per visit will be 10% of the cost of the car. The monthly expenditure of the car is 5,000, which is fully met by the employer. Because it is personal, people, the whole 5,000 will be treated as a perquisite value, and the car is owned by the employer, so good enough for me. He is also paying a lump sum premium of 1,20,000 towards health insurance of the self and his wife for 48 months on 1st October 24 by account paycheck. People, he is paying it himself, nothing to do with salaries. This is 80C. He is also contributing 1,50,000 towards PP. No, sorry, this is 80D, not 80C. This is 80D. Health insurance is 80D. He also contributes 1,50,000 towards PPF, which is 80C. The person wants to pay tax under default tax regime. People, the person is going for DTR here. If the person is going for DTR, my chapter 6A has no relevance here. Let's keep that in mind. What would be the value of rent-free accommodation to be taxable in the hands of Mr. Hardik? People, to do rent-free accommodation, I need to first know what his salary is. If you understand this carefully, the person has joined on February, which means in the month of April 24, the person would have been receiving a salary of 35,000. Now this will continue until Jan 25, people. Until Jan 25, the person is receiving 35,000 rupees, because after February, what is going to happen? Feb and March, he is going to get an increment. The increment is going to be 3,500 additionally added. So 35,000 plus 3,500 will get added, which means 38,500 will become his salary for the next 2 months. Yes, let's understand this piece first. With this understanding, people, I can very clearly come and say my basic salary is what? My basic salary is going to be 35,000 for 10 months plus 38,500 for 2 months. Agreed? Let's keep that thought in mind, people. So which means 38,500 into 2 will give me 77,000. 35,000 into 10 will give me 3,50,000. Adding both, I get my total basic salary is 4,27,000. Yes, then the question comes and says he's paying DS also, which is 10% of the basic salary, sorry, 40% of the salary, and therefore 4,27,000 into 40% will give me 170,800. 800. Is there any other allowances first in the question? No, there is no other allowances, which means I'm going to stop here. This is my salary for the purpose of RFA as well. For the purpose of RFA, my salary becomes 5,97,800. Yes, now RFA rules come and say that for the purpose of taxing RFA, it is 10% of salary or the higher charges, whichever is lower. But notice carefully, people, this perquisite is only provided from October, which means I'll take 10% of salary only for October months. So I have to take the relevant period here. The relevant period becomes critical here. My relevant period will be what, people? It will be October, November, December, January, 4 months for 35,000. Plus, I will have Feb and March, which is 38,500. Into 2. Yes, and the whole thing will be added for a DA as well, which is 40%. So let's do this first. So I'm getting 35,000 into 4 M plus 38,500 into 2 M plus I get my MRC as 2,17,000. Adding a 40% on this, I get the number as 3,03,800. 10% of this is my taxable perk, which is 30,380. So the RFA here comes as 30,380. But this one also has a hiring charge. Hiring charge is 5,000 into 6 people, I think. Yes, 5,000 into 6 will give me 30,000 rupees, which means my taxable perk will be lower of these two, which is 30,000. So this should be option number A. Yes, this should be option number D. Option number D is 30,000 rupees. This is what the right answer is. Clear? Clear? Yes, next. What is the amount of health insurance premium paid during 24-25 by Mr. Hardik can be claimed as deduction while computing total income if he exercises the option of shifting out of default regime? People, the person, if he shifts out of default regime, notice what his age is. His age is 45 years, which means his maximum limit is only 25,000 rupees. Now, he is paid 1,20,000 for himself and his wife. Wife is also 43 years, but the payment is made for 48 months on 1st October 2024 by account paycheck. People, if the payment is not made in the starting of the year on 1st April, you will split this over one additional year, which means even though it is 48 months, it will get split over 3 years. It will get split over 3 years, and therefore it will be 1,20,000 divided by 3, which is 40,000, but the problem is this person only has a amount of sorry, give me 1 second. So 1,20,000 divided by 48 will give me per month salary, per month insurance, which is 2,500. In that 2,500, people, I've taken only from October. So October, November, December, Jan, Feb and March into 6 will give me 15,000 rupees. Am I right? Yes. So I should get that as my answer. But for some reason it is showing 24,000, is it? Let's check. 48, oh sorry, I'm sorry, 48 months means 12 into 4 years, which means I have to do it for 5 years, people. I'm so sorry. So therefore it is 1,20,000 divided by 5 years. Yeah, now I get it right. So therefore the answer is option number C. Please notice, people, when it comes to medical insurance has no condition of your monthly deduction. Medical insurance works on a annual deduction, and the annual deduction means every financial year which is in line. In my years, I have 48 months, which means 4 financial years. But because it is not paid on 1st April, I'll have to add one additional year, which means 5 years is what I will take into consideration. 1,20,000 divided by 5 will give me 24,000 as the right answer. That is what the right answer is. What would be the perquisite value of the car which is chargeable to tax? People, if it is car, I have to check. Car is 8 lakhs into 10%, which is 80,000. Plus monthly expenditure is 5,000, and therefore 5,000 into 12 will be taken, which is 60,000. Therefore the total cost of the car is 1,40,000. That is what my taxable perk will be. Yes. What would be your advice to Mr. Adik to exercise the option of shifting out of default regime? Should he exercise this option or should he not exercise this option is the question. People, we will have to do the whole thing. No other options here. Yes. So let's check my whole computation. What my whole computation will be, I will now take my RFA into consideration. So my RFA is 30,000 rupees. What other perks am I getting? I am getting another perk of my what is this, car. Yes, I am getting a perk of my car. We just computed the number. It is 1,40,000. Is there anything else that this person is getting? No, nothing else has been given to this person. This is what the answer is, which means what is my gross salary? My gross salary is 5,97,800 plus 30,000 rupees plus 1,40,000 rupees. So my taxable gross salary is 7,67,800. Now from here, people, I'm going to do a two-way split. Because in DTR the provisions are different, in ATR the provisions are different. If I am doing DTR, I will get a standard deduction of rupees 75,000. I'll get a standard deduction of rupees 75,000 for my salary. Is there anything else I can claim? No, I cannot claim anything else. So therefore 7,67,800 minus 75,000 will give me the answer as 6,92,800. 6,92,800. Now people, with my person being an income less than 7 lakhs, ideally he is going to be eligible for rebate. Yes, he is already going to become eligible for rebate, and therefore I honestly speaking don't care if he goes for alternate regime or not. So I'm going to look at a question, people, where what is the option? So first one says yes, Mr. Hardik should exercise the option since he would pay tax under normal provisions and his tax liability would be 53. No, I am going to get 0 in default. Second one says yes, because Mr. Hardik should shift out and his tax liability will be 22. No. Third one says no, Mr. Hardik should not exercise the option of shifting out as per default tax regime his liability will be 1850. No, this is also not the right answer. Option number D says Mr. Hardik should not exercise the option of shifting out as he will have a tax liability of nil. This is my right answer, which means people, sometimes when it comes to MCQ questions, you don't need to solve the whole question. This itself will give you the answer, because default tax regime is showing 6,90,800, which means my tax liability becomes nil. With my tax liability becoming nil, I would rather prefer to go for default tax regime than waste my time in alternate tax regime. While in alternate tax regime also probably you may have a less tax liability, people, because 767,800 minus 50,000 of standard deduction minus 24,000 of my 80D minus 1,50,000 of my ATC will give me an income of 543,800. People with 543,800, ATR is definitely going to have a tax liability, whereas DTR will have a rebate provisions, and therefore DTR becomes the right answer. A person would not prefer to go for ATR in this scenario. D is the right answer. Yes, so I would prefer option D, and I would close with that. Great, not a very complicated question, people. And yes, with this we are done with what is called as income from salaries as well. Some interesting questions, people. One question which I want you to pay attention to would be this question number 13. A wrong question, but somehow ICA prefers to do it this way, so please focus on that question. Other than that, what would I prefer? I would yeah, I guess I would honestly prefer no other questions. Every other question seems right. What questions I would prefer is question 1, question 2 and question 3, people. These are not your salary related question, these are your exemption related question. So 1, 2, 3 and 4 is something which I would really want you to look into before your exams as well, so that you can pay attention to. Everything else fairly I think you can easily solve, people. There is nothing complicated about this chapter of salaries, so that is what it is. Great. With this, I would like to close this video as well, and I would like to take a leave. I will come back with the further videos on the balance topics as well, people. So please stay tuned to the channel. Again, I'm small request that if you have any of your friends who are writing September 25 and Jan 26 and are looking out for MCQ books, MCQ guide is already there in the description box. So please share it across with them. And these videos are available with you for you to go through and understand what exactly would be the right answers and how to approach a question. That's it, people, for today's video. Let's meet up in the upcoming videos and discuss something better. Until then, happy learning and have a great day ahead. See you. Take care. Hey boys, welcome back to the MCQ series. Today we are discussing chapter number 4, the chapter of income from house property. A fairly easy chapter both from study perspective, MCQ perspective as well as exam perspective. But yes, one of the cases you will see income from house property also being tested in exam, and therefore equally important. You may either see income from house property coming in as a part of your MCQ questions, because of late ICI is testing a lot of case study questions relating to house property, or it may come as a part of question number 3B, which is your head related question of 4 marks, or sometimes ICM may test you this in your compulsory question as well as 1 or 2 small adjustments. Yes, so let's pay attention to this MCQs. I think there are a set of 10 and odd MCQs which you should be able to answer very quickly and easily. So we're discussing this together. Question number 1 of your MCQ paper. It says, Mr. Raghav has 3 houses for self-occupation. What would be the tax treatment of assessment year 25-26 in respect of house properties? People, we already know that when it comes to house property, you are eligible only to claim 2 SOPs and everything else becomes in DLOP. So keeping that in mind, let's keep the answers. It says, what would be the tax treatment? 1 house at the option of Mr. Raghav would be treated as SOP. Answer is no. You have to have 2 houses. 2 houses at the option of Mr. Raghav would be treated as SOP. The other houses would be LOPs. Yes, this is what the right answer should be. This is what the right answer should be. Third one says 1 house, so no. Fourth one says 2 houses at the option of assessing officer. No. People, the houses are eligible for SOP based on the assessee's wish. It's not the assessing officer's wish here. Question number 2. It says Mr. Vikas took a loan of 15 lakh rupees at the rate of 10% per annum on 1st April 21 for the construction of a residential house. The construction of the house began in June 21 and it was completed on 30th June 2024. People, I am seeing that the house is completed only on 30th June 2024, whereas the loan is of 21, which means technically there is pre-construction interest. He has not repaid any amount of the loan so far. The amount of interest deduction eligible under 24B if exercise the option of shifting out of default regime is requested for you. Now, couple of things which you need to pay attention to. First of all, the construction when it begins is not the relevant here. It is relevant as to when the loan is taken, because you're only talking about how much interest you're going to pay. So interest is going to be paid from April 21 itself. It doesn't matter even if the house is started from June 21, because at the end of the day it doesn't matter, right? So let's first figure out what is my pre-construction period. My pre-construction period in this case would start from 1st April 21 and will go on till what? The house was completed on 30th June 24, people. The provisions of Income Tax Act come and say the year in which the house is completed is assumed as a current year interest, which means all years prior to this alone is considered as pre-construction period. So therefore, my pre-construction period will end on 31st March 2024. Yes, this is what my pre-construction period would be, which means April 22, April 23 and March 22, March 23 and March 24. So 3 years there is my pre-construction period. Yes, now let's check the pre-construction interest. My pre-construction interest would be 15 lakhs at the rate of 10% for 3 years. So therefore that will be 1,50,000 per year, and therefore that is 4,50,000 for the 3 years. Now pre-construction interest provisions come and say that whatever pre-construction interest you have, you can claim it over the next 5 years. So which means I'll take 4,50,000 and I'll divide it over 5 years, which means every year I can claim 90,000 rupees as a deduction. Agreed? I'm sure everyone is aware until here. The problem comes when you read the question carefully. The question says they want the amount of interest deduction under 25-26. Now, for those people who understand this carefully, they are asking the amount of interest eligible for deduction, not the amount of pre-construction interest eligible for deduction. So therefore, you have to pay attention to the fact that you also have current year interest into picture. Yes, so my current year interest will also come into picture because the question says that the amount of loan has not been repaid so far. With no loan repaid so far, the current year interest would also become 1,50,000. So totaling these two, the answer should come as 2,40,000. Yes, now comes the big question, whether the house is SOP or LOP. If the house is SOP, I will restrict this off. If the house is LOP, I will get the full deduction. What does the question say? Mr. Vikas has taken a loan for construction of residential house for self-occupation. The question itself says there is self-occupation. The moment there is self-occupation, people, there is an overall restriction of 2 lakh rupees, and therefore the answer becomes option number C. Therefore, the answer becomes option number C. Yes, a kind of an easy question, but at the same time, you have to pay attention to everything which is happening around you, and therefore you can get the right answer. So pay attention to that. Question number 3. It says Mr. Virat has a house property in Chennai which he has let out to Mr. Sumit. So which means this property is an LOP property. For the acquisition of this house, Virat had taken a loan of 30 lakhs at the rate of 10% per annum on 1st April 2017. Yes, I am assuming a pre-acquisition interest is also going to come here. He has further taken a loan of 5 lakhs at the rate of 12% per annum on 1st July towards repair of this house. So he has taken a loan for repairs as well. He has not paid any amount of loan so far. Further, he opts out of default tax regime, the amount of interest eligible. No. Wait, I don't see any case where the house is under completion. No, nothing is mentioned about the completion, people, which means I am assuming there is no pre-construction period. There is only current year interest. Now, keeping that in mind, in the current year, how much interest am I eligible for? First of all, 30 lakhs into 10% will give me 3 lakh rupees worth of interest. Yes, so this will give me almost about 3 lakhs worth of interest. So this is what the first interest I will take into consideration. Yeah, so my current year interest would be 3 lakhs. Plus, notice carefully that they are coming and saying they've taken a second loan and the loan is for repairs. Now, does it really matter? Answer is no. When the house is let out to another person, whatever the loan is taken for is not really criteria important. So, I'm not going to make a restriction of 30,000 on this, people, because this is a let out property. In a let out scenario also, I can claim the full deduction, which means I'll take the full 5 lakhs, multiply it with 12% and take it for how many months? April, May, June alone, the loan was not there. So, into 9 by 12. The answer should come as 45,000. Therefore, this is the total amount of interest which I can claim, which is 3,45,000. Therefore, option number C is the right answer. Yes, an easy question, people, if you understand the fact that LOP is eligible for full interests. Next, Ganesh and Rajesh are co-owners of a self-occupied property. So, there is a self-occupied property with co-ownership status. They own 50% share in each. Okay. The interest paid by co-owner during the previous year 24-25 for the purpose of acquisition of the house is 2,05,000. Each has paid 2,05,000, people. Pay attention here. It says each has paid 2,05,000 rupees. The amount of interest which is allowable for each co-owner if they exercise the option of shifting out. People, when it comes to co-ownership, the rules come and say it is 2 lakh per person. Yes. So 2 lakh per person can be claimed as deduction. Each has paid 2,05,000, which means each person is claiming 2 lakh rupees. Therefore, the answer becomes option number C. Yes, the answer becomes option number C. Fairly easy question. Next. Vidya is receiving 90,000 in May 2024 towards recovery of the unrealized rent, which was deducted from her actual rent in 2022 for determining annual value. Legal expenses incurred for the unrealized rent is 20,000. They are asking the taxable amount. People, when it comes to unrealized rent, there are certain rules to follow. Rule number 1 is that if it is already claimed as deduction earlier, it will be taxable right now. 2, it will be taxable only under that house property, even if the house is not your ownership. 3, you can't claim any expenses against this. And 4th, and the most crucial thing, you have to grant a 30% ka standard deduction, which means in this case 90,000 rupees is my taxable interest, taxable rent, in which I am going to grant 30% deduction, therefore making it 63,000. So 63,000 is straightforward my answer. I do not care whatever amount of tax I am paying. Yes, so it doesn't matter as to what amount of expenses I am incurring for this. I will directly take only 63,000 as my right answer because I cannot claim any deductions. Yes, that is what the rule is. Next, question number 6. It says, Mr. Sundaram is owning 2 residential house properties in Chennai, one of which is used by him and his family for residential purposes. Both the houses were exactly identical and their expected rent or municipal value etc. are also the same. He let out the other house for a rent of 1,15,000 per month and has taken two similar loans for the purchase of these houses on 1st April 23. The stamp duty value of these houses as on that date is 30 lakh rupees each. During the financial year 24-25, he paid 4 lakh rupees as interest for each house. Does not have any other incomes or investments during the year. He did not file return of income during within the due date under section 139(1). What will be the income tax chargeable to tax? This is one of the most beautiful questions which came in September 2024 exams, and most of the people make blatant errors here. The first thing which you need to pay attention, and a silent adjustment which is given here, is this fact. The fact that he did not file his return of income. When a person does not file his return of income, it is automatically assumed that the person has not filed his relevant form. What form are you talking about, Rahul? The form in order to claim ATR provisions, which means by not filing his return, and with the ICI question being a little silent on this, the primary assumption is that the person can only opt for what we call as DTR. The person can only opt for what is called as DTR. Yes. Now in this question, I know a lot of people made this error where what they did is they computed both under DTR and ATR and checked whichever is lower. You are unfortunately not supposed to do that. When the question itself says that the person is not filing a return of income, it is so assumed that the person is only claiming DTR provisions. That makes a big difference now, because now if you notice, I have two properties, one of which is SOP and one of which is LOP. I don't care about the SOP property anymore because the house becomes a DTR house. With the house becoming DTR, my LOP property becomes taxable. So I take 1,15,000 per month and I multiply it with 12. I get my total rent, which is 13,80,000. In this 13,80,000, I am eligible for nothing is given otherwise, so I am taking minus 30% standard deduction, and I am claiming 4 lakh rupees worth of interest, thereby making my income as 5,66,000 directly. Thereby making my income as 5,66,000 directly. This is a very good question which you all should be practicing, people. In this question, if you technically try an SOP property, you will get better answers. You will get an income lower than this, but the default is on the side of the assessee. Because the assessee did not file his return of income, he cannot claim the provisions of ATR. He has to go for DTR provisions here. This is one question which you need to keep in mind. Question number 7. It says, oh, we are starting with case scenario questions. Good. It says Mrs. Prerna is having a residential house property in Nagpur, one of which is of which 1/3 is self-occupied and 2/3 is let out. Okay, the 2/3 property is let out for a monthly rent of 12,000 rupees. The fair rent for the let out property only is 30,000, which means there itself coming and clarifying what is the fair rent for the let out piece, people. Yes, pay attention. Municipal value of the property is 2,40,000. People, when they say municipal value of the property is 2,40,000, it means it is not just for the let out piece, it is also for the whole house. Standard rent is for 3 lakh, again for the entire property. Municipal taxes is 10% of the municipal value, which is paid on 30th July 2024. It does matter, people, when you pay the municipal taxes, because you only can claim the deduction when it is actually paid. She took a loan of 45 lakhs for the construction of this house from a scheduled bank. She paid the entire loan along with interest on 30th June 24, which means 30th June 24, the entire payments have been made. There is no further payments of this. The interest will stop then. The interest rate for this loan is 10% per annum. Good enough. The construction was completed on 30th June 23, which means I have to now pay attention to this fact, people. When did she take the loan? She took the loan on 1st June 22 and she has completed the construction on 30th June 23, which means there is a pre-construction period from 1st April 22. From 1st April 22 till 31st March 2023, at least is a pre-construction period. While the house is completed on 30th June 23, there is at least 1 year of pre-construction period in this. She has earned other income of 2 lakh rupees during the year. She wishes to pay tax under default tax regime. So the person is going for DTR provisions, people. Let's pay attention to that. When it says DTR provisions, it automatically means SOP property is not irrelevant to me. Based on the facts of the scenario, they're asking you to choose the most appropriate option. The first question says, tell me what the NAV of the property is. Now, if I'm looking at the NAV of the property, people, I'm only looking at the LOP piece. Looking at the LOP portion. In the LOP portion, what is my municipal rent? The question says municipal rent is 2,40,000, but that's for full property. I'm taking 2,40,000 into 2 by 3. Therefore, the answer comes to 1,60,000. Then I have standard rent. The standard rent in the question is given as rupees. I first will take the fair rent. I have fair rent also in this question. Yes. So I take the fair rent, and the fair rent in the question is given as 30,000 per month. So 30,000 per month. So 30,000 into 12 will give me 3,60,000. Then I have standard rent. The standard rent in the question is given as 3 lakh rupees, but the 3 lakh rupees is for full property. So I'll take it for 2/3 of the property, which is 2 lakhs. Yes. So municipal rent or fair rent, whichever is higher, therefore 3,60,000 versus standard rent, whichever is lower. Therefore my expected rent becomes 2 lakh rupees. With my expected rent becoming 2 lakh rupees, let's check what my actual rent is. My actual rent is 12,000 into 12. So 12,000 into 12 will give me 1,44,000, and therefore my expected rent my GAV becomes 2 lakh rupees. Yes, with my GAV becoming 2 lakh rupees, people, now I can claim my municipal taxes as a deduction. Look at the municipal taxes. The question says the municipal taxes is 10% of municipal value. Now my municipal value in this question is given as 2,40,000 into 10% will give me the municipal tax. But this municipal tax again is for the whole property, people. Therefore, I do into 2 by 3, and therefore the answer comes as 16,000 rupees. Yes, so my ending up NAV is 1,84,000. That should be the right answer. So option number C is the right answer. 1,84,000 becomes the right option. Yes, this one was easy. Next, the deduction in respect of interest on loan. This is where you have to pay attention to, people. What happens to the interest on loan? Now notice carefully that the question says the person is opting for DTR. So I only need to do it for the LOPPs. In the LOPPs, people, what is happening? I first taken a loan. The loan has taken for 45 lakhs for construction of the house. She repaid the entire loan along with interest on 30th June. So therefore, when it comes to loan, I need to first check what is my total interest being paid. Now, in the current year, in my interest on loan, I have a current year interest. For what period? My period relevant will be only April to June, because 30th June 2024 the loan has been repaid off. So for 3 months alone I have the loan. The rate of interest in this question is 10%. So therefore that becomes 45 lakhs into 10% into 3 by 12. Correct? So I take it as 4,50,000 into 3 divided by 12. Therefore the answer comes to 1,12,500. Correct? Now comes my pre-construction interest. In my pre-construction interest, what is happening? I've taken the loan on 1st April 22 and I've repaid it on 30th June 2024. So which means, oh, no, sorry, my house was completed on 30th June 23. That is more relevant, people. 30th June 23 would mean 31st March 23. So therefore 1 year of pre-construction interest is also there. So therefore it will be 4,50,000. Now this 4,50,000 will get divided by 5 because I am eligible for 5 years, and therefore that becomes 90,000. Correct? Totaling this to each other, 1,12,500 plus 90,000 gives me 2,02,500. So that should be the right answer, which is option number B. Interesting. Let's check this once again. Current year interest is 45 lakhs. 45 lakhs into 3 by 12. So 4,50,000 into 3 divided by 12 will give me 1,12,500, right? When it comes to okay. My mistake, people. My mistake. Let's first understand this. So I have 1,12,500 plus 90,000. So therefore it becomes 2,02,500. Yes, but the one mistake which I also made, and I think most of the people end up doing, is that this is for the whole property. This is for the whole property. We just discussed, people, we need to do it only for the LOPPs. Therefore, into 2 divided by 3 is the answer. Yes, and therefore 1,35,000 becomes the right answer. Yes, that is option number B. That is option number B. Yes, so one small mistake which you have to pay attention to, people, that when it comes to loan also, loan is also for the whole house, and therefore you have to allocate it accordingly. Finally, the question comes and says compute the total income. I think we already have all the information, people. If I find out what is my NAV was 2 lakhs minus 16,000. Therefore, the answer was 1,84,000. I reduced 30% standard deduction on this, so 1,28,800. On this, I am claiming a deduction of 1,35,000. Therefore, the answer becomes 6,200 negative. Yes, so 6,02,000 negative is my income from loss from house property. Now the problem with default tax regime, people, is that if you have a loss from house property, you cannot set off against other heads, which means to the extent of this loss, I'm going to completely ignore it off. The loss completely gets ignored off, which means I'm only looking at my other incomes. What is my other incomes? The question says my other incomes is 2 lakh as such. Therefore, the total income becomes 2 lakh as it is, and that's my option number B. That's my option number B. Yes, if my memory serves right, I think MTP number 8 would mean yes. This was also September 24 question. Yes, so September 24 question, one of the toughest papers which came in exams. But now that you know the answers, you are able to handle it properly. So please pay attention. Question number 8. It says Mr. Mayank has bought a residential house worth 2.5 crores at South Extension, Delhi in 2018 and has let out the house on rent to Mr. Rihan. The property was funded through a loan from PNB. The interest due on this loan for 24-25 is 25 lakhs, out of which he only paid 20 lakhs during the year. People, just because I pay only 20 lakhs during the year does not make a difference. When it comes to interest only, you can claim the whole deductions. Next, Mr. Mayank then took a loan of 1.5 crores from SBI on 1st July 24 current year for the construction of the first floor of the house for self-occupation. So first house he had let out, and then he is creating a second premises. Second premises is going to be self-occupied. The construction is in progress as on 31st March 25, which means today also, people, the house is not completed. The construction is still undergoing. Mr. Mayank started repaying EMIs due to SBI. Okay. During the financial year 24-25, he repaid principal amount of 25 lakh rupees and 5 lakh rupees to PNB and SBI respectively. Now, people, there is one thing which is a catch point here. Notice carefully that there are two houses. One is an LOP piece and one is a SOP piece. Now, on the LOP piece, he is having interest also, which can be claimed as deduction, no restriction. He has loan repayments also, which can also be claimed as deduction under 80C. But when it comes to the other house, people, the SOP piece, the question clearly comes and says that the house is in construction. When the house is in construction, the interest whichever is accumulating on this will automatically become a pre-construction interest, which means is it getting claimed in the current year? No. Second, the 80C provisions also come and say that you can only claim 80C principal repayments when the house is completed. Here is also the case where the house is not completed, and therefore whatever loan or interest which is there from the SOP piece is technically ignored for this question. We do not take that into consideration itself. He has also paid an interest of 8 lakhs to SBI out of 10 lakhs during the interest due for 1st July to 31st March. Am I bothered about this? No, I am not bothered about this. Next, Mr. Mayank owns another house in Haryana. Okay. He transferred that house to his minor daughter, Mrs. Sia, on her birthday as her birthday gift. People, any kind of house property transferred to the minor daughter will be clubbed in the hands of the original owner. Keep that in mind. Where am I? Yes. Mrs. Sia gave the said house to the local panchayat from September 24 to the rent of 5,000 rupees per month, fully taxable in the hands of the owner. Mrs. Mayank's total income for the assessment year 25-26 is higher than Mr. Mayank. People, Mrs. Mayank's income has been confirmed as being higher than Mr. Mayank. So let's keep that in mind. Now, first of all, is that really relevant in this question? Here is a silent head. No. People, when you come to house property chapter, the house property chapter comes and says when you transfer any property to your spouse or to your minor children deemed ownership concept will apply. Clubbing does not apply. When deemed ownership concept applies, the owner, which is the original owner, is taxable, even if it is Mrs. Mayank, who is actually having higher income. So here is the case where you need to be careful about the fact that this is not a clubbing chapter. This is a deemed ownership chapter. Keep that in mind. This is the first year where Mrs. Sia has any source of income. Okay, doesn't matter. Mr. Mayank bought electrical vehicles worth 50 lakhs on loan from BSM Bank, which is sanctioned on 1st April 22. People, this is talking about 80 EEB, interest on electric vehicles. BSM Bank charged interest of 7 lakh rupees on electric vehicle for 24-25. Mr. Mayank has also taken loan from ABC Bank for his daughter's higher education. ATE is coming in picture. He paid 50,000 as interest to ABC Bank. He has also paid medical claim of 20,000 rupees to New India Insurance Scheme for insuring his health. People, this is all chapter 6 related deduction. So yes, if you have done the chapter already, you should be able to answer all this. If not, you can wait until you complete the chapter off. First question, what is the amount of interest allowable under section 24 to Mr. Mayank? People, I am only allowing interest to the extent which is incurred for the let out property. Let's check the let out property. The let out property comes and says the total interest due is 25 lakhs, out of which only 20 lakhs is paid during the year. Yes, which means that is the only interest which I can claim as deduction. So that is what the answer should be. The answer should be 25 lakhs as it is. Yes, I will not claim any interest pertaining to my SOP property. Keep that in mind. Next, what is the amount of deduction permissible to Mr. Mayank under chapter 6A for any assessment year 25-26 if he opts out of default tax regime? They're asking the total deductions under chapter 6A. First, people, if I have to compute, I will first have an ATC of 1,50,000 because I have repaid some loan for the bank. Let's check how much have I repaid. Started repaying EMIs to SBI. He repaid 25 lakhs and 5 lakhs to PNB. Yes, he has repaid 25 lakhs, people. I can claim 1,50,000 worth of deduction. No challenges here. Next, Mr. Mayank brought an electrical vehicle worth 50 lakhs, sanction loan, BMS is charged 7 lakhs. Here also, people, I can claim 80 EEB. I get an 80 EEB for 1,50,000 again. Next, Mr. Mayank has taken a loan from ABC Bank for daughter's higher education, 50,000 paid for that. So therefore, 50,000 of ATE comes into picture. Next, paid 50,000 as interest on bank, mediclaim policy of 20,000 taken, so therefore that is ATD. How much was that? Number was 20,000. Yes, the total deduction should become 3,50,000 and 3,70,000. I have a fair guess. Yes, 3,70,000 is the right answer. Yes, this one was easy, people. In whose hands would Sia's rental income from house property at Haryana be taxable and how much? People, again, I told you, this is a deemed ownership concept. In a deemed ownership concept, Mr. Mayank, who's the original transferor, will be taxable. It is not going to be taxable in the hands of wife. So therefore, the answer will be option number B. The answer would be option number B. If you notice, people, I'm taxing 24,500 and not 23,000. Why am I taxing 24,500? Because if you notice the rent was given as rupees 5,000 per month. So 5,000 into 12 will give me 60,000 minus 30% standard deduction I get. So therefore 42,000 comes into picture. But in that 42,000 also, no, 1 second. This house was let out only from September. So it is 5,000 into September, October, November, December, Jan, Feb and March. So therefore 3, 6 and 7. So I get 35,000. 35,000 I get 30% standard deduction. Number becomes 24,500. For those people who are noticing, people, 23,000 is also showing somewhere. Yes, now 23,000 would have been right if you had opted for clubbing provisions, because clubbing provisions would have granted you 1,500 rupees exemption for clubbing minor child's income. But because this is deemed ownership concept, your 24,500 will be taxable as it is. No clubbing exemption is granted to you. So this is something which I want you to pay special attention to. This is very important. Yes. Question number 9. It says Ananya Gupta, a citizen of India, lives with her family in New York since 2000. She visited India from 21st March 24 to 28th September 24 to take care of her ailing mother. People, look at the dates very, very carefully. I am seeing 21st March 24. Now, if I am starting from 21st March 24, that is not relevant. It is from 1st April 24, that is the relevant beat. In the last 4 years, she has been visiting India for the 100 days every year with her mother. Okay. She owns an apartment at New York, which is used as a residence. The expected rent of the house is $32,000, where the US dollars can be taken as 75. Municipal taxes paid in New York in January 2025 is 2,000. People, here is where I'll have to pay attention to the fact that whether I am first a resident or not, because if I am a resident only, I can be taxing this income. So let's first check that. I am a citizen of India who's living outside and is visiting India. If I am outside India and I am visiting India, I need to check for my Indian income. But before that, let's check if my 182 days get satisfied. People, April is 30 days, May is 31 days, June is 30 days, July is 31 days, August is 31 days, and September is 28 days. I am at 181, exactly 181 days, people, which means I am not a resident as per the first condition. I will have to check for my second condition, where Indian income should be more than 15 lakhs for me to call a resident. Otherwise, I am going to become a non-resident. She took ownership and possession of her house in New Delhi on 25th March 2024 for self-occupation while she was in India. The municipal value of this house is 4,20,000. The fair rent is 4,50,000. She paid property tax of 22,000. People, all this are not relevant because the property is an SOP property. She had taken a loan of 16 lakhs at the rate of 10% per annum on 1st April 2020 for constructing the house, and the construction of the house completed on 20th March 2024. I now have a pre-construction interest. No amount has been paid in repayment of principals so far. The house is vacant for the rest of the year. It doesn't matter, people. At the end of the day, the house is a self-occupied property. Whether you keep it vacant or not, it doesn't really matter. She had a house property in Mumbai which was sold on 28th March 2024. In respect of this house, she received arrears of rent of 3 lakh rupees. Is this income going to be taxable? Yes. 3 lakh rupees worth of income is going to be taxable. Minus 30% is going to be taxable. So 2,10,000 is what I'm going to tax in the current year. This amount has not been charged to tax earlier. Yes, she does not have any other income source. Now, people, with this, I am at least clear to the fact that 3 lakh rupees is the only number she has received. With the 3 lakh rupees being the only number she has received, her Indian income is less than 15 lakhs. With her Indian income being less than 15 lakhs, she is now a non-resident. Yes, a non-resident is what the answer is, which means, can I be taxing the Delhi property? Answer is no. A strict no will be given. Sorry, can I be taxing the New York property? No. The New York property will also not be taxable because this is income received outside India. Yes, that is what the facts would be. What would be the resident status of the person? I would directly say the person is a non-resident. Yes, one mistake which most of the people can end up making is that if you start the period consideration from 21st March, you will end up getting more than 182 days. Please notice 21st March is not the starting point, it is 1st April as a starting point. So that one thing you have to keep in mind. Next, Mrs. Ananya can claim benefit of nil annual value in respect of which property? People, which property can she claim? She is anyway not going to tax the New York property, so therefore that is not considered. You have a Delhi property, you have a Haryana property. You have a Delhi and you have a Mumbai property. Yes, you have a Delhi and a Mumbai property. Mumbai property is anyway going to be treated as a taxable LOP, so therefore there is nothing there. Your Delhi property is the only right answer which I can think of. So the answer is option number A. Yes. Next, what is the income chargeable to tax under the head income from house property of Ananya for 25-26? Now, this would take a little bit of an effort, people. Let's understand. My arrears of rent is going to be taxable for 2,10,000. Yes, my arrears of rent is going to be taxable for 2,10,000, which is on my Mumbai property. But if you notice carefully, people, my Delhi property is also there. My Delhi property is having some losses, which I need to keep in mind. Looking at my Delhi property, she's taken possession of the property on 25th March. The municipal value is not relevant. The property tax is not relevant. But she's taken a loan of 16 lakhs on 1st April 2020, which means I have a pre-construction period. My pre-construction period is going to be from 1st April 2020 to 31st March 2023. People, this is 20th March 24, which means the period of 23-24 will also be considered as my current year interest. Will be considered as my current year interest. So, which means I'll take it on 31st March 2023. So, I have a pre-construction period of 2020 to 31st March 23. Oh, it's not for Mumbai, it's for Delhi. So, let's move it here. Yes. Now, what is my interest? My interest is going to be 16 lakhs at the rate of 10% per annum. So, which means I'm going to take 1.6 lakhs into 21, 22, 23, 3 years. So, therefore, that becomes 4.8 lakhs. Now, in this 4.8 lakhs, I'm going to divide this by 5. So, therefore, the number becomes 96,000. Yes, the question also comes and mentions that the current year also the person has not paid any interest. If you notice carefully, the house was completed on 20th March 24. No amount has been paid towards principal so far. The house is vacant for the rest of the year, which means current year also I have an interest, people. Yes, so my current year interest becomes 1,60,000. Adding both the numbers, I get the answer as 2,56,000. 2,56,000. Now, 2,56,000 is my total interest. But can I be taking the whole 2,56,000? The answer is no. I can only claim a deduction of rupees 2 lakhs because this is my SOP property, which means I'm going to now set off 2 lakhs against my 2,10,000, giving me a taxable income of only 10,000 rupees. So, 10,000 rupees becomes my right answer. Yes, 10,000 rupees becomes my right answer. Now, assuming that for the purpose of this question alone, Ananya had let out her flat in New York during the 6 months when she was in India for a sum of $6,000. Such rent was received in a bank account in New York and then remitted to India through approved banking channels. What would be the income from house property? People, attentive to the fact that just because she is letting out the house from India does not mean anything. She has to be either receiving the money in India or the income should accrue in India. The income is not getting received in India because the income is getting received in New York. Yes, so this is the first part. Second part is that they are coming and saying even though the money is received in New York, they are later on remitting it to India. Now, as a non-resident, just because you remit the money to India does not automatically make it taxable in India because this is merely a remittance. It's not an income. Section 5 comes and clearly clarifies that when a remittance takes place, remittance is never going to be taxable, which means by this facts, this answer is not going to change. The income is still not going to be taxable for New York in India, and therefore my answer still sticks to 10,000 rupees. My answer still sticks to 10,000 rupees. That is how this question will look like. Yes, a good question, people, which you should keep in mind. This is an important question which you can pay attention to. I am bringing up my last 10th question. I think this is the last question. Yes, look at the last 10th question. Case scenario question says, for the assessment year 25-26, Mr. Sonu is submitting the following information. He has some building in Chennai, he has some building in Kochi. If I notice the last line comes and says, the first building was let out for residence purposes and the second building was let out for business purposes. From my perspective, people, whether I let it out for business or I let it out for residence, it really doesn't matter. I am going to call the houses as LOP houses. Yes, so that is something to be kept in mind. Next, I've been given municipal rent, standard rent, fair rent, expected rent received has also been given to me. For the first one, they say municipal tax is paid by the tenant Ramu for building in Chennai. People, when the Ramu as a tenant pays the tax, that is not eligible for deduction because municipal tax can only be claimed as deduction when owner pays this money and paid by Sonu. So, Sonu is the one who is the owner. So, therefore, this can be claimed as a deduction. Repairs paid by tenant Ramu for Chennai building and Sonu paid for Kochi building. People, repairs and all is not even a thing in HP chapter. Therefore, repairs get ignored. Land revenue paid is also getting ignored. Insurance premium paid is also getting ignored. What else? Interest on loan borrowed for repayment of municipal tax. Hey, what is this? It says interest on loan borrowed for payment of municipal tax of the house. People, can you take a loan for paying municipal tax and all? No. No loans can be taken for paying municipal tax. This does not really make sense. There is no such criteria here. Yes. So, this is not even relevant. I am going to ignore this as well. Next, date of completion of construction is given to you, which is fairly very old, therefore it doesn't matter. First one, Mr. Sonu is constructing one more building in Mumbai during 24-25. Mr. Raju is a film director, took on rent the building under construction in Mumbai at 5,000 rupees per month on rent for his film shooting. The construction of the building would be completed by April 25, which is next year. Mr. Sonu is a real estate developer and letting out properties is not the business of Sonu. With this clarification, they're giving you a hint that this is not going to be taxable under PGBP because I'm not in the business of letting out properties. I'm in the business of I'm in the business of selling properties. When I'm in the business of selling properties, all rent out properties will be taxable under HP. However, look at this part, people. Look at the part of Mr. Raju. The part of Mr. Raju comes and says that the building is under construction. And this is the most important part. When the building is under construction, this is not considered a house property. Any income coming from an under constructed building can only be taxable under IFOS and not under HP chapter, which means this rent is going to be taxed under IFOS and not under HP. Which of the building's income is chargeable to tax under the income house property? Ignoring Mumbai, everything else will be given, people. So Chennai and Kochi should be the answer. Building at Chennai only? No. Building at Kochi only? No. Both buildings at Chennai and Kochi is the right answer. So option number C is the right answer. Yes. Which of the following payments and expenditure is allowed as deduction while computing the income from the house property in respect of the buildings at Chennai and Kochi? Can you claim municipal taxes paid by Sonu and Ramu? No. You have to pay municipal taxes only by the owner. Municipal tax, land revenue? No. Only municipal tax paid by Sonu is the right answer. Yes. Only what Mr. Owner has paid can be claimed as deduction. Otherwise, you're not getting any other deductions. Under which head of income the amount received from Raju would be taxable? Like we discussed, people, it is going to be taxable under other sources because this is not the ownership of the property. What is the amount chargeable to tax under the head income from house property in respect of Mr. Sonu? Let's compute this. When it comes to your properties, municipal value or standard rent, municipal value or fair rent, whichever is higher, versus standard rent, whichever is lower. So therefore it is 35 versus 36, so therefore 35. 35 will then be compared with 38 and therefore the answer would become 38,000. Yes. Next, municipal taxes are not claimable as deduction and therefore this is what I would take. Now, I have a peculiar question. Is this per month? It doesn't mention anywhere. So I'm going to assume this is the full year, people. When nothing is mentioned, I'm going to assume this is the full year. So 38,000 is my rent received. In that 38,000, I'm going to claim 30% standard deduction, which means my taxable income is going to be 26,600. Yes. Is there any interest on loan in the question? No interest on loan. Also in the question? Yes, no interest on loan. Next, for the right side, people, it is 80,000 or 82,000, whichever is higher, therefore 82,000. 82,000 versus 70, whichever is lower, therefore 70,000. 70,000 versus 68,000, whichever is higher, therefore 70,000 is the right answer. But in the 70,000 people, this person has paid a municipal tax, therefore 4,000 can be claimed as deduction. So therefore the taxable income becomes 66,000. On the 66,000, I will claim 30% standard deduction, therefore the number becomes 46,200. My total income on 46,200 plus 26,600 will be 72,800 as the answer. Yes, so 72,800 is what I'm going to claim as income, that for option number A. Therefore, option number A. Pay attention to the fact, people, that when it comes to the Raju film director, that income was under IFOS. The question very specifically wants income from house property and therefore I am not taking that into consideration. So 72,800 would be the right answer in this question. Yes? Awesome. That's it, which is for house property, people. I think the house property questions were really nice. The last case study questions at least were really nice. And if you notice carefully, people, by the judge of it itself, your MTP number 8 is your past exam paper. Yes, your MTP number 3, your MTP number 8, these are all your past exam papers, people, which means house property as an MCQ question is one of ICI's favorite. So therefore, you should be paying attention to this. I think fairly, if you complete all these questions, you should have a good grip on the house property chapter. So yes, please go through all these questions very carefully so that you can do the exams properly. That's it, people. Let's come back with another video discussing the other chapters. I think we're already done with house property as well. So which means the next chapter should be the important one, which is your PGBP chapter. We'll come back with the PGBP chapter, try to solve those questions as well. Until I come up with the next video, please continue your learning and have a great learning journey ahead. If you have any doubts, like I always say, please feel free to reach out to me on my WhatsApp number, which is given in the description box. And yes, the PDF copy of this document is already available in the description box as well. So you can download the document from there. Thank you, people. Have a great day ahead and I'll see you soon. Bye. Take care. Hey boys, I hope you're all doing well. So yes, let's continue with our discussion on the MCQ series. Today we're doing the most important chapter for your CA inter syllabus, the one chapter which carries almost about 14 marks in your compulsory question. At the same time comes in various places, either in question number 3 or it comes in your MCQ pattern as well. We're looking at the chapter number 5 called as PGP. PP. Yes, we're going to be discussing about the chapter number 5, people. Let's understand all the questions which IC has given in PGBP, and then we'll take it from there. Now, before I start, let me give you a caveat. This chapter of MCQ guide will predominantly cover only those questions where most of the adjustments were relating to PGBP, which means there are questions which have PGBP plus other heads as well. Those parts of the topics will actually be covered in the last chapter called as comprehensive questions, so they may not be part of the discussion here. In this video, we have almost about 16 or 17 kind of questions which will be specifically dedicated PGBP questions which ICA has asked in the past. So we're looking at only those questions from today's class. Yes, let's understand that and let's take it forward from there. We're starting with the question number 1, people, which is on your PGBP related question. Question number 1 says, Mr. X is a retailer and has acquired furniture on 10th May 2024 for 10,000 rupees in cash and on 15th May 2024 for 15,000 rupees and 20,000 rupees by bearer check and account paycheck respectively. The depreciation allowable has been requested. Now, notice carefully, people, when it comes to a question of assets, income tax comes and says that you cannot purchase an asset more than 10,000 rupees in a single day by a single person. But here is a case where I've paid 10,000 rupees by cash, which means this is perfectly allowed. More than 10,000 is where the issue is. Up to 10,000 is perfectly permitted. 15,000 by on 15th May, 15,000 by bearer check. No, bearer check is not a permissible mode. You cannot take that as a deduction. And then 20,000 comes by account paycheck, which is perfectly permitted. So if I add both the numbers, I get 30,000 rupees. Furniture is taxable at the rate of 10% depreciation, and therefore 3,000 rupees becomes the right answer. So option number B is the right answer. Yes, fairly an easy question with a good adjustment coming up. Question number 2. The WDV of the block of plant and machinery, which is rate of depreciation of 15% as on 1st April 2024 is 3,20,000. A second-hand machinery costing 50,000 was acquired on 1st September 24 through account paycheck and was put to use only on 1st November 24. During January 25, part of this block was sold for 2 lakh rupees. They're requesting for the depreciation on this asset. Now, if it comes to depreciation, people, the first thing which you need to keep in mind is what exactly is the mode of computation. Now, I have an asset worth 3,20,000 already in my hands, and then 50,000 worth of asset has been acquired. So, totally my cost of the asset becomes 3,70,000. In this 3,70,000, 2 lakhs worth of asset has already been disposed of. So I have 1,70,000 worth of asset. Now in this 1,70,000 worth of asset, people, I will allocate the whole 50,000 pertaining to asset which is put to use for less than 180 days, which means 1,20,000 remains in the opening block. This 1,20,000 worth of asset in the opening block will be depreciated at the rate of 15%, so the number comes as 18,000, and then 50,000 worth of asset will also be depreciated at 7.5% because it is put to use for less than 180 days, and therefore that should come to around 3,750. Adding both, I should get 2,1750 as the right answer. That is option number A. Yes, easy question, people. Notice carefully, the question says it's a second-hand machinery, which means I'm not eligible for additional depreciation. That has been restricted off as it is. Question number 3. An electricity company charging depreciation on straight line method on each asset separately sells one of its machineries in April 2024 for 1,20,000 rupees. Okay, the WDV of the machinery at the beginning of the year as on 1st April 24 is given as 1,35,000 rupees. No new machinery was purchased during the year. The shortfall will be termed as, people, this is a theoretical question. The shortfall when it comes to straight line method depreciation is called as terminal depreciation. It's called as terminal depreciation. That is what you grant as deduction. Next, question number 4. It says Mr. X is acquiring an asset in the year 1718 for the use for scientific research for 2,75,000. He claimed a deduction under section 3514 for 1718. The asset was brought into business in the business of Mr. X in 24-25 after the research was completed. The actual cost of the asset to be included. People, when it comes to scientific research, the provisions come and say that either you can transfer the asset to a third party or you can bring it to your business. If you end up bringing it to your business, the cost of acquisition will be taken as nil, and therefore that is what the answer is. Yes, so option number A becomes the right answer. Simple question. Great. Question number 5. It says Mr. Raja is a proprietor and has commenced operations of the business of a new 3-star hotel on 1st July 24. People, a new 3-star hotel automatically means that the person is claiming 35 AD. He has made a total investment of 7.58 crores till 30th June. Out of the total investment, 1.58 crores pertains to purchase of land. People, purchase of land is not eligible for 35 AD, and therefore I will exclude that, which means I have 6 crores worth of asset which I am eligible for. 4.7 crores was used for constructing hotel, and the balance 1.3 crores was used for purchasing furniture in 24-25. Fairly doesn't matter. He wants to avail the benefit of 35AD as he satisfied all the conditions prescribed in the 35AD and has exercised the option of shifting out of default regime. The profit and gains of the business is 50 lakh rupees before claiming the reduction under section 35AD. He wants to file his income tax return on 15th July 2025. How much deduction can Raja claim on 25-26 and the losses that he can carry forward? Now people, when it comes to 35AD, 35AD simply comes and says whatever cost of the asset you purchase will be fully allowed as deduction except for land. It doesn't matter whether it is furniture or it is building, the whole cost is eligible for deduction, which means 6 lakhs is the deduction which I can totally claim. Now the profit of the person is 50 lakh rupees, which means I am totally eligible for a carry forward loss of 5.5 crores. Therefore, first option does not make sense. The second option does make sense. The second option says he can claim a deduction of 6 crores and can carry forward business loss of 5.5 crores, which is what the right answer should be. Yes, so that is what the answer is. Question number 6. Mr. Kumar is engaged in the wholesale business of clothes and speculative business and has discontinued its operations on 19th October 24 and 30th September 2024 respectively. So he has a cloth business, he has a speculative business. The cloth business loss up to 19th October for 24-25 was 8,000 and the speculative business loss up to 24-25 is 40,000 rupees. Out of the total bad debts of 1 lakh rupees that were claimed by Mr. Kumar in respect of a particular debtor, 60,000 was allowed by the assessing officer in the past. On 29th January 2025, Mr. Kumar received a sum of 68,000 from the debtor in full and final settlement. How much would be the amount taxable in the hands of Mr. Kumar? Now, one thing which you need to pay attention to, people, is the fact that when it comes to bad debts recovery basically comes and says that if at all your assessing officer is not allowing certain claim, that amount of income need not be offered in the subsequent future. So which means if I wanted to make a claim of 1 lakh and the officer only allows 60,000, 40,000 worth of claim has been already paid a tax on, which means in the subsequent year when I received 68,000, I will not be taxing the whole 68,000. I would tell the officer that, sir, out of the 68,000, 40,000 rupees worth of income have already been offered to tax in the past when you disallowed the claim, which means I am only ready to offer the income worth 48,000. I am only ready to offer the income worth 28,000. Yes. So the claim which will be allowed, which will be claimed by the assessing, which will be claimed by the assessee would be 28,000. Now coming to the facts of the losses, I have two kinds of losses. One is normal business loss, one is speculative business loss. You all know speculative business loss can only be set off against speculative business income, which means this 40,000 worth of loss is going to get carried forward. Yes, that leaves me with only 8,000 worth of loss, which I can set off. Even though the business is shut down, the losses is mine and therefore I can still set off the losses. Therefore, 68,000 would be the total claim. In that 68,000, I am not going to offer 40,000 worth of claim because that is already offered to tax, and I am not going to offer 8,000 worth because that is a business loss. This gives me the number as 20,000 and therefore option number B makes the most sense. Yes, so option B is the right answer here. Easy question. Question number 7. Mr. Anil is starting a business of manufacturing of tables in February 2025. He has followed mercantile system of accounting in the past. He purchased wood from Mr. A, Mr. B and Mr. C. The details of this are given to you. Now people, this looks like a section 43B question, so let's pay attention. Section 43B question says Mr. A is a micro enterprise. People, when it comes to 43B, the 43B only allows for micro and small. Medium enterprises has no restrictions. You can still claim the expense even if the payment had not been made. Micro enterprise, 15th February 25 is the date of purchase. Purchase amount is rupees 5 lakhs. The payment has been agreed within 30 days. Which means 15th February within 13 days will become 15th March and the payment is made on 29th March. Now, if you understand this carefully, people, on 15th March, the payment will get disallowed. The payment will get disallowed for not making the payment on time. But the problem is the payment subsequently has been made on 29th March, which is also in the previous year. Because the payment is getting disallowed in the same year and allowed in the same year, it net effect becomes 0, which means I don't have to make any disallowance for Mr. A. Yes, so Mr. A will not be made any disallowance. Mr. A will remain as it is. Make sense? Yes. Move forward. Now comes Mr. B, a small enterprise who's having 17th March 2025, purchase amount is 7 lakh rupees and does not have a return agreement. Now people, when you don't have a return agreement, the rule comes and says you have to make the payment within 15 days. Start from 17th March. If I make 15 days, how much does it come to? I get the days as 32, which means basically on 2nd April, I should have made the payment of. Because I have not made the payment on 2nd April, I have made the payment on 15th April. I am technically making this disallowance on 17th March, which means on 17th March, Mr. B will get a disallowance of the payment and he can only claim this in the next financial year, which is 15th April. And therefore, 7 lakh rupees will get disallowed. Coming to medium enterprise, like we just discussed, I don't care about what is happening for medium enterprise. Even if I make the payment late, I'm still eligible for deduction. How much deduction would be eligible for Mr. Anil in 25-26 in respect of purchases made? Notice the question, people. The question does not want how much disallowance to make. They want how much deduction can you claim. Deductions which I can claim is rupees 5 lakhs and rupees 8 lakhs, which totals to 13 lakh rupees, and therefore the answer is option number C. Yes, sometimes reading the question is also important, people. While we were focusing on disallowance, the ICI question wanted the deduction claimable. So therefore, please pay attention to that fact. Next, I have BOS knowledge portal question. The question says, K is a working partner in a firm on behalf of his HUF, and the HUF has contributed 3 lakh rupees as capital to its contribution. So there is a K of working partner which is working on behalf of HUF, and the HUF is making some contributions as capital for 3 lakh rupees. Apart from this, K has also given a loan of 50,000 rupees to the firm in his individual capacity. The firm pays interest as per the market rate of 15% per annum on the capital as well as loan. Compute the amount of interest that shall be allowed to the firm while calculating its business income, assuming the interest is authorized by partnership deed. Now, people, this is a question where partnership level questions come and say that when it comes to two people, when it comes to an HUF and when it comes to its representative, the HUF, if it is a partner, the representative will not be objected for 12% of interest. Only the HUF will be restricted, and the vice versa. In this case, the HUF is the partner of the firm, and therefore the HUF will have a restriction of 12% of the contribution. 3 lakh rupees is his contribution, and therefore he can only pay up to 12%. Yes, so 12% will be claimable, which is 36,000. Coming to 50,000 worth of payment, the 50,000 worth of payment is eligible for the whole 15% because this is done by K in his own capacity and not in the capacity as a partner, which is perfectly permitted. And therefore, I will take this number as well, which is 7,500, totaling to becoming 43,500. So 43,500 is my right answer. Yes, yes. So 3 lakh into 12% plus 50,000 into 15% is the right computation. Question number 9. It says Mr. C is age 35 years and is a working partner in BCD, a partnership firm with equal profit sharing ratio. During the financial year 24-25, the firm has paid remuneration to B, C and Mr. D being the working partners of the firm, where the payment is 2 lakh rupees each. The firm has paid interest on capital of 1,20,000 in total to all the three partners, and the same is within the prescribed limit of 12%. Now people, what does TOTO mean? TOTO means all together, which means all together I've made a payment of 1,20,000, which means each partner would have got based on their capital contributions. The firm had a loss of 1,12,000 after debiting in remuneration and interest on capital. The remuneration and interest on capital is authorized by the deed. You are the CA of Mr. C and are in the process of computing his total income. What would be his taxable remuneration for the firm? Now people, pay attention to the fact that they are asking the taxable computation for C, not for the firm. But to compute C, we need the computation of the firm. So let's compute what is happening for the firm. First of all, if I start with the net profit of the firm, the net profit of the firm has been reported as 1,12,000. In this 1,12,000, people are debited two items, one is interest and one is remuneration. If you notice carefully, the interest says that the interest is done within the prescribed limit of 12%, which is what the right interest is, which means, do I have to make a disallowance for interest? No. I don't have to make any disallowance of interest, people. I only have to make a disallowance for the partnership salary. So therefore, I will be adding back the salary, which will be totaling to 6 lakh rupees. Now, what is my book profit? My book profit should be 6 lakhs minus 1,12,000. Is it 1,12,000? Yes, it is 1,12,000. Therefore, the number becomes 4,88,000. Yeah. Now, the new rules of partnership firm, people, the new rules of partnership firm comes and says, for the first 6 lakh rupees, you're eligible for 90% of the book profits or 3 lakh rupees, whichever is lower. Here is a case of 4,88,000. So let's check what 4,88,000 9% becomes. 90% becomes 4,88,000 into 90% shows 4,39,200, which means I can totally pay 439,200 to all partners. Now, if I'm paying 439,200 to all partners, I want to know what is C's share in this. Now, C's share is an equal contributor, and therefore C will be divided by 3, which means 1,46,400 is what I can give to Mr. C. Yes, 1,46,400 is what I can give to Mr. C. But apart from that, people, Mr. C would have also got interest on capital. Therefore, the 1,20,000 divided by 3 will also be taken into consideration, which is 40,000 rupees. Yes, so 1,46,400 plus 40,000 rupees will give me 1,86,400. That is what should be the answer. Oh, I'm sorry. If the question is only asking for taxable remuneration, people. Yeah, it's not asking for the interest, so therefore I don't really care about the interest. If that is understanding, then I just want the first number, which is 1,46,400 I got. Yes, so that becomes option number C. Yes, that becomes option number C. Question number 10. Mr. A is an eligible assessee and is following mercantile system of accounting. The person is carrying on eligible business under section 44AD and is providing you the following information. The total turnover of the financial year 24-25 has been given as 130 lakhs. Out of the above, 25 lakhs pertains to account pay check, 50 lakhs pertains to cash, 25 lakhs pertains to account paid draft before the due date of return filing, whereas 30 lakhs has not been received. What is the amount of deemed profit? People, section 44AD would simply come and say that whatever money has been received by permissible modes before the due date of return filing will be taxable for 6%. Anything other than that will be taxable for 8%. Now, if I am looking at 25 lakhs is received by permissible modes, therefore this number becomes 6%. 50 lakhs is received by cash, so this becomes 8%. 25 lakhs is received by account pay check, this also goes for 6%, and 30 lakhs is not even received and therefore that goes for 8%. So if I add this up, people, what would be the answers? My 25 lakhs plus 25 lakhs will be taxable for 6%, and 50 lakhs plus 30 lakhs would be taxable for 8%. Therefore, the total becomes 9.4 lakhs, which is answer D. Yes, sweet. Question number 11. This one says, Mr. Shahid is a wholesale supplier of dyes and is providing you with the following details of cash payments during the year. People were looking at section 48.3, so let's pay attention. The question says, on 12th June 2024, they have a loan repayment of 27,000 taken for business purpose from his friend Kunal. The repayment also includes an interest of 5,000 rupees. Now, people, this is a loan repayment, would not have been debited to P&L, so therefore I really don't care about this. Yes, next. 19th August, I have a portable dye machinery purchase for 15,000. The payment was made in cash in 3 weekly installments. People, 3 weekly installments would mean 15,000 by 3, which is 5,000 rupees. Again, no disallowance under section 48.3. Third one says the payment of 10,000 rupees is made to an electrician due to unforeseen circumstances of electrical shop at shop. People, this is up to 10,000 rupees, therefore allowed as deduction. And fourth one says purchase made from unregistered dealer for 13,500. Now, this would be a disallowance of 13,500 because this payment has exceeded 10,000 rupees. What will be the disallowance under section 48.3 if any, if Shahid declares his income under the provisions of 44AD? People, this is what you have to pay attention to. This one says they want the payment disallowance if it is as per 44AD. People, 44AD means presumptive income, and presumptive income simply comes and says when you do presumptive taxation, the income will be taxable, the turnover will be taxable for a flat 6 or 8%. I do not care about any other disallowances, which means no disallowance will be made by the person if the person is opting for 44AD. So reading the question itself was kind of useless. The answer is option number D. Yes, question number 12. It says Mrs. Ridhima is age 32 years, an interior decorator, his professional receipts of 25,60,000 for 24-25. She's also earned an income of 1,25,000 as dividends, 4,65,000 as interest income on fixed deposits, and has incurred 13 lakhs for a profession and 30,000 as interest on loan for making investment in shares for which she received dividends. What would be a total income assuming she wishes to make maximum tax saving without getting her books audited? People, the moment a person says that the books are not getting audited, it's fairly clear that the person has to opt for presumptive taxation. You don't have an option. With the presumptive taxation coming into picture, people, how does this work? The 25,60,000 will become taxable for 50%. Yes, so I take 25,60,000 and I take 50% of this. So this becomes my M plus. Then I have 1,25,000 worth of dividends. I have 4,65,000 worth of interest income. In this, if I take the total, people, I am right now getting my gross revenue total as 18,70,000. Yes, apart from this, the question comes and says the person has incurred 30,000 rupees as interest on loan. Now, when it comes to interest on loan, I can only claim up to 20% of the dividend income as a deduction. So, into 20% of 1,25,000 gives me 25,000 only, which means maximum deduction I can claim is 25,000, not 30,000 rupees. Yes, so if I remove 25,000 out of 18,70,000, tell me what the answer comes to. So it is 18,70,000 minus 25,000. The answer comes as 18,45,000. Therefore, option number A is the right answer. Yes, I think more than PGBP in this, the dividend part was more critical. So therefore, you have to pay attention to that one. Yes, great. We're starting with case scenario questions, people. Let's see what it is. Question number 13 says Lux Enterprise is a proprietorship firm of Lucifer Morningstar. I think they are very big fans of Netflix here. Lucifer is being quoted. A resident individual in Maharashtra. Maharashtra for Lucifer Morningstar kind of seems like a weird name. Engaged in the business of printing and publishing. Okay. The following details are pertaining to the assets of the business. The person has office building superstructure constructed on leased land 30 September. 30th December is what the put to use is, and 1 crore 85 is the cost of the asset. A BMW M4 convertible car has been bought on 23rd August 2019 and was put to use on 25th August 2019. Now people, this one is a peculiar asset. There was a specific provision which was introduced for a very brief time, which was between 23rd August 2019 to 31st March 2020, that if you purchased any asset of a motor vehicle during that period, the rate of depreciation was double, which means normally you would claim 15, here you will claim 30%. So this is a 30% related question. So we need to pay attention to this one. Yes, on the contrary, the office building is going to be for 10%. So that's fine enough. Machinery is used in printing and publishing process, where I have purchased it on 25th September 24 and I have put to use on 15th October 24, 9,12,500 rupees. The written down value of the machinery, plant and machinery on 1st April 24 is given as 1 crore 45 lakhs. Yes, so they've told you what the plant and machinery written down value is also given to you. Based on the above facts and scenarios, you're required to compute the most appropriate answer for the following questions. Assuming that all payments are made through account paycheck. They have clarified that all payments are through account paycheck, so therefore the payments are perfectly allowed. What would be the amount of depreciation allowable on plant and machinery at the rate of 15% for the previous year 24-25? Now people, for the percentage of 15%, I will only consider this machinery, because that is the only machinery which I am eligible for. The BMW car, while normally would have been 15%, but because it is a car, it has gone to 30%, so I can't take that into consideration. Yes, so what is my asset purchase? I have 1 crore 45 lakhs. Yes, 145,000,000 into 15% is one of the answers. The second answer is 912,500 into 15%. The total comes to 2133,875. But notice carefully people, the person is in printing and publishing, which means this is the manufacturing operations. With this being a manufacturing operations, I should be eligible for additional depreciation. But one second, I guess I'm missing something. If I notice this question, the question says the put to use is on 15th October. So while this is not eligible for 15% people, this is eligible for 7.5% plus 10% of additional depreciation. Yes, so let's recompute this. So I have 145,000,000 into 15% is one answer. Then I have 912,500 into 17.5% as another answer. So totaling up to 2334687.5. Yes, so 2334688 is the answer. That is option number B. Yes, option number B becomes the right answer, because I am eligible for not just 15%, I am eligible for 7.5% plus 10% of additional depreciation on this. Are we clear? Great. What would be the WDV of the plant and machinery? WDV depreciable at 15%. I think this is fairly easy people. You just have to add both the numbers. So let's take both the numbers. I'm getting, I already got the depreciation value, right? I can just simply reduce the cost of acquisitions. The answer should come as 130,77,813. Yes, 130,77,812,813 is the right answer. Therefore, option number C is the right answer. Yes, third one. What would be the WDV of office building superstructure constructed on leased land as on 1st April 25? They want to know what is the WDV of the office building superstructure constructed on the leased land. Now people, this is office building and therefore it is 10%, but I've put to use on 30th December, and therefore this will also go for half of it, which is 5%. So it is 185,000,000 into 5%. The answer comes as 9,25,000 as depreciation, but they want the WDV people, so therefore I will reduce the cost of acquisition as well. The answer comes as 175,75,000. Yes, so 175,75,000 is the right answer. So therefore option number C. Interesting enough that they didn't want to ask about the motor car, because yeah, that could have been a good question to ask for, but nevertheless. Question number 14. It says Mr. Kashyap is a manufacturer and has disclosed a net profit of 40 lakhs for the year ended 31st March 2025. He has claimed a depreciation of 12,20,000 in the books of accounts. Expenditure in profit and loss includes interest payable to Raj, a non-resident, without taxation of deduction of source, 1,50,000. Such tax was however deducted on 15th April 25 and remitted on 17th May 25. Now people, when it comes to TDS rules, two rules have to be satisfied. One, you should deduct before 31st March, and two, you should pay before due date of return filing. Although the payment has happened before due date of return filing, the deduction happened only in the month of April, and therefore this payment will get disallowed for 100%. Mr. Kashyap is engaged in in-house scientific research and development and has incurred expenditure of 1,50,000 on purchase of research equipments, 100% allowance reduction, 1 lakh rupees for remuneration of scientist, again 100% allowance reduction. Mr. Kashyap purchased a new plant and machinery for 45 lakhs on 2nd August 2024 and put to use the same on 1st November 24, less than 180 days. For this purpose, he borrowed 25 lakh rupees on 1st August 24 and paid interest at the rate of 10% per annum, which was debited in books of accounts on P&L. The return on value of the block of machinery as on 1st April 24 is 95 lakhs. The total turnover of 23-24 and 24-25 have given to you. The question is asking what would be the depreciation allowable in the respect of plant and machinery for 15%. People, a very good question. If you pay attention to this, there is a lot of good facts which needs to be considered. The first one is about the plant and machinery. If you notice the plant and machinery, the cost of acquisition of the plant and machinery is given to you for 45 lakhs. Yes, now for those people who start hurrying and starting to charge depreciation on this, you will end up going wrong, because if you notice, the question comes and says the asset was purchased by taking a loan. When you take a loan for the purchase of an asset, people, borrowing cost standard comes into picture, and borrowing cost comes and says until the asset has been put to use, the interest will be capitalized. Now if you notice, the loan was taken on 1st August 24 and the asset was put to use on November 24, which means August, September and October, 3 months worth of interest has to be capitalized on this. So 25 lakhs worth of asset multiplied by 10% interest into 3 divided by 12 is also getting capitalized. So 60 to 500 also gets capitalized. Yes, adding this to my 45 lakhs, my answer comes to 45, 60 to 500. Now I can compute my depreciation. First of all, the person is a manufacturer, people, and therefore I should be eligible for an additional depreciation as well. And I have put to use asset only in November, so therefore I'll get in 10% plus 7.5. So I can directly multiply this with 17.5%. The answer should come as 7984375. Oh, is there any other asset which I have? Oh yeah, I have a block also, right? So I have 798,437.5 as one of the asset for the new purchases. I also have a new asset, old asset, which is 95 lakhs. So on that 95 lakhs also, people, I will give 15% depreciation. That number comes to 1425000, which means the total comes to 2223438. 2223438 is my option number A. Yes, this one is a good question. Borrowing cost standard question which should be kept in mind. What is the amount of disallowance, if any, attracted for the non-deduction of tax at source on interest payable? People, there will be a disallowance because the person had not made the payment on time. The person had not made the deduction on time, but because this is a resident case, I will be disallowing only 30% of the expense. So 1,15,000 into 30% will give me 45,000. So 45,000 is the total disallowance. Yes. Next, what would be the income under the head PGBP for the Mr. Kashyap under normal provisions of the Act? People, we will have to recompute this whole thing. So let's recompute this whole thing. First of all, if I have to put out my PGBP statement, what is my PGBP statement? Let's put it out. If my PGBP statement starts with net profit. Yes, the question says I have a net profit of rupees 40 lakhs. Let's start making my disallowances to see what is happening. First, he claimed a depreciation of 12,20,000 in the books of accounts. This is getting disallowed because I have depreciation as per the new computation. Next, expenditure includes 1,50,000 for TDS, so therefore that gets disallowed. So I have 45,000 worth of disallowance for 40 IA. Next, Kashyap has engaged in now scientific research and development, incurs expenditure of 1,50,000, 1 lakh recommendation to partners. This is fully allowed as reduction. It's already debited to P&L, people, so no further adjustment to be made. Kashyap has purchased new plant and machinery. The return on value of plant and machinery has already been discussed. We have the depreciation already in our hands, people, which is 2223438. Yes, so I'm going to make a claim of 2223438 as a claim deduction. Let's check what is my taxable income. My 40 lakhs plus 12,20,000 plus 45,000 minus 2223438 is my answer. So therefore 3041562 should be the right answer. Yes. Oh, I'm getting 3104. Oh, I'm sorry. Okay, there is a disallowance of interest also, right, people? I have disallowed certain amount of interest which I had to capitalize. Yes, so let's add that interest as well. How much did I capitalize? I had 25 lakhs into 10 percentage into 3 divided by 12. So 62,500 also gets added here. Yes, so 62,500 will also get added. So how much is my total income now? I have 30, 41, 562 plus 62, 500 as my disallowance. So therefore 3104,062. Yes, option number A is the right answer. Option number A is the right answer. Yes, coming to the next question. What would be the income chargeable under the head PGBP for Kashyap if he pays tax under default tax regime? Let's check what changes we need to make for default tax regime. Am I changing my net profit? No. Am I changing my depreciation? No. Am I changing my disallowance? No. Kashyap as in-house research expenses, people are fully allowed as deduction even under default tax regime. I'm not making any changes there. What exactly am I going to change? The one thing which I'm going to change is my additional depreciation. The additional depreciation alone is something which is not allowed under default tax regime, people. So whatever additional depreciation I claimed alone has to be removed off. Yes. So if I notice this question carefully, I had 45 lakhs worth of asset plus 62,500 worth of asset. I had 45, 62,500 in which I have to claim only 10% depreciation right now. No, I have to claim only 7.5% depreciation right now. Yes, so that is one number plus 95 lakhs into 15% depreciation has to be claimed right now. So therefore total depreciation I should claim is 17671,875, but I ended up claiming 2223,438, and therefore the excess depreciation I claimed is 456250. That number is what I'm going to add to my normal income. My normal income we already computed in normal provisions is 3104,062. So let's add this number there. 3104,062 will get added there, and therefore the answer will become 35,60,313. 35,60,312 or 313. Option number C is the right answer. Yes, so the only thing to be disallowed is the additional depreciation piece, people. If you do that, you will get the answer. I think this is the last question. No, I have two more questions. Let's check question number 15. This question says, ABC & Co is a partnership firm and is engaged in the business of sale of footwear. The partnership firm consists of three partners, A, B and C. A and B are working partners, C is a sleeping partner. C does not get any remuneration, C will only get interest on capital. The firm is liable for tax audit, good enough. Firm has a book profit of 11,50,000. Question already has mentioned you what the book profit is. The following payments were made to partners as authorized by the partnership deed. Remuneration to partners to A and B is 32,000 per month paid to each partner, perfectly allowed, people, no problems. Remuneration to C is 10,000, not allowed as reduction. Remuneration, interest on capital at 19.5% is given as 18,500. I cannot pay 19.5%, I can only pay 12%. And interest on capital of 17% again will get restricted to 12%. The firm has the following brought forward past losses. You have business loss, you have unabsorbed depreciation, you have long-term capital loss. People, while computing book profits, you will actually take into consideration the unabsorbed depreciation alone. You will not take into consideration the brought forward loss. The brought forward loss will be taken into consideration only for the purposes of PGBP. Now, the problem in this question is the question comes and says book profit is 11,50,000, which means my assumption is the 11,50,000 already has the unabsorbed depreciation. That is how the computation of book profit will happen. Yes, so the book profit already has made the adjustments for the remunerations, for the interest on capital and for the unabsorbed depreciation. So I'm not making those changes here, people. Based on the facts of the scenario, they are asking for the most appropriate option. What is the amount of interest allowable as deduction in the hands of firm while computing income from PGBP? Let's compute this and check. If you notice carefully, people, 18,500 is interest at the rate of 19.5%, in which I can only claim interest of 12%, and therefore I am only eligible for 11,385 into 2 for two partners, and therefore I am eligible for 227,770. Yes, so I can claim a total interest of only 22,770. 770. Coming to the capital of C. C is getting 10,540, which is at the rate of 17%. If I multiply this with 12%, I get 7,440. Which means the total deduction I can claim is 22,770 here. The number becomes 3210. 3210 is the right answer. That is option number D. Yes. Yes. What is the amount of remuneration not allowable as deduction in the hands of firm while computing business PGBP? Now people, when you have to compute the remuneration, I need to first check how much remuneration I have already paid off. 11 lakh 50 is my book profits, people. So 11 lakh 50 I will compute for the first 6 lakh rupees. For the first 6 lakh rupees, I am going to give 5.4 lakhs. And for the balance, which is 5 lakh 50,000, I am going to grant 60%, which means the answer is 3 lakh 30,000. 3 lakh 30,000. So total I can grant is 8.7 lakhs. Now let's check how much is partners getting. Partner A and B together is getting 32,000 into 2 into 12, which means the partners are getting 7 lakh 68. Now can I pay 7 lakh 68? The answer is yes. No restrictions here, fully allowed as deduction. Yes, what is not allowed is the remuneration to C, which is 10,000, because even though this would be within the limits, but this is a non-working partner, and a non-working partner cannot be granted any remuneration, which means this number will get fully disallowed. So 1,20,000 is what I'm going to make a disallowance for. That's option A. Yes, see, simple question. What is the due date of filing of return for A and C, people? A and C due date of return filing would be the same as what the firm's due date is. Firm's due date is tax or a due date, therefore 31st October. So the partners will also become 31st October. It doesn't matter whether the partners are sleeping partners or working partners. All partners are liable for 31st October. Then comes the question as to what would be the income chargeable under the head PGBP in the hands of ABC and Co. Now people, if I have to compute PGBP, I only need to be very careful here. I will start with my book profits. My book profit is 11 lakh 50,000. In this book profits, what would have not been given to you would be the salary. The salary is 7 lakh 68,000. So that alone will be reduced, which is 3 lakh 82,000. Do not claim any interest on capital because that is already part of book profit. Then coming to unabsorbed depreciation, I am again making an assumption that UD is also part of book profit because book profit is after computing UD, and therefore the only thing which I can claim is the business loss. Now business loss of 22-23, 23-24 and 24-25 will be reduced. So that is 26,000 reduced minus 78,000 reduced minus 105,760 is reduced, and therefore the answer should come as 172,240. Yeah, so therefore 172,330. I think I may have made some calculation error, but yeah, fairly almost the same number. So this is what the answer is. Yes, great. This brings me to the last question, people, question number 16. Let's see what this question looks like. This question says, Mr. Naveen is aged 40 years and is engaged in the manufacturing business. The person is following mercantile system of accounting. The details pertaining to his business for the year ending 31st March is given to you. I have a capital receipt of 1.2 crores. I have a turnover of 2.8 crores. The amount received in cash out of turnover is 8 lakhs. The amount received in cash out of capital receipts is 2 lakhs. Amount received through account, paycheck and other prescribed modes is 2.5 crores on or before the due date of return filing. The total payment is 1.6 crores. The total cash payment is 9 lakhs and the net profit of the books is given as 10.50. The analysis of the books are given to you. The salary includes wages of 15,000 paid to one security guard, 2 housekeeping staff in cash. Now people, I've paid 15,000 per month each to one security guard and 2 housekeepings, which means there are 3 people. So 45,000 worth of payments have happened and each person has got more than 10,000 rupees. Other administrative expenses include 70,000 which is paid in cash. Payment in a day is less than 8,000 rupees, which means this is not a problem because each payment is less than 10,000. Interest charges includes interest payable on loan to Kamal of 70,000 on which TDS has not been deducted. Loan was taken for the purpose of business. Now, who is Kamal is something which even I am not sure. Does it mention who's Kamal? No. With no mention on this, people, I can make an assumption Kamal is probably a resident and therefore 30% of this payment would be disallowed. On the basis of the above facts, they are asking you questions A to E below. The question number A is, what is Mr. Naveen's declaration? Is Mr. Naveen eligible to declare income on presumptive basis under the provisions of Income Tax Act? Can he declare presumptive basis? You have to check. If you check his turnover, people, the turnover is 2.8 crores. But the amendment of last year comes and clarifies that if your cash payments in the turnover is less than 5% of the total payments, then I can make the turnover as 3 crores for presumptive taxation. So let's check what my cash turnover is. My total turnover is 2.8, in which 8 lakhs is my cash turnover. So therefore, if I take 8 lakhs and I divide this by 2.8 crores, I get the answer as 2.8%. Yes, if my answer is coming as 2.8%, people, I am perfectly allowed to do presumptive income. There is no problem here. So presumptive income can be declared. So the answer is option number C. Yes, next. What would be the answer to MCQ A? Assuming for the purpose of this question and MCQ C that Mr. Naveen has additionally received 10 lakhs by way of cross check out of the turnover. Now people, if I check my total turnover, 2 crores 80 lakhs. So this is 28 lakhs, 2.8 crores into 5% is what I can maximum pay. 5% would be about 14 lakhs people. Now already 8 lakhs was paid in cash. If I take an additional 10 lakh rupees by way of cross check, that would make more than 5%, which means my presumptive will be denied to me. So can I take presumptive? The answer would be no. The answer would be no due to both A and B. Yes, check. No, since the turnover of Mr. Of Naveen exceeds 2 crores, yes, that is the case. And no, since the aggregate receipts exceed 5%. Because it exceeds 5%, the turnover should be taken as 2 crores and 2 crores, the turnover is 2.8 crores. Therefore, I am not eligible for presumptive taxation. Option number D is the right answer. Question number C. Is Mr. Naveen required to get his books of accounts audited during 24-25? Now people, read this very carefully. The question in B is coming and saying that for answering MCQ A and C, you need to take that into consideration. Which means for the purpose of C also, you have to take the turnover of 18 lakhs received by cash payment. If the turnover of 18 lakhs is received by cash payment, 10 crores is not a condition. 1 crore becomes the condition and therefore I will be liable for tax audit. I will be liable for tax audit. Yes, so C would be the right answer. Oh, why would it say MCQ C then? Let's check what my cash payments are. My cash payments is 1.6 crores. Into 5% gives me 8 lakh rupees. I've made the payment of 9 lakh rupees. So yeah, because of cash also people, I am actually not liable for, I'm liable for tax audit. So the answer should have been B or C. Ideally, it should be B or C because the question number B is coming and saying for C alone that for C also you need to take 10 lakh rupees extra for cross check. So I would say answer B and C both are right here. Yes, while ICI has only made the option of C and not for B. I'm not sure why. Yeah, anyway, what is the amount of PGBP chargeable to tax in the hands of Mr. Naveen as per books of accounts? Now people, as per books of accounts is the question asked and therefore as per books of accounts is what I need to check. As per books of accounts would mean my net profit is 10 lakh 50,000. So 10 lakh 50,000 would be taken as it is. In that I've made cash payments of 15,000 per month each to 3 people and therefore that needs to get added. So 45,000 will get added plus I will add the 70,000 into 30% which is 21,000. So therefore the answer should come as 11 lakh 16,000. But that's not given. Yeah, in which case let's try to make an assumption that the 70,000 will be fully disallowed. In which case I will take 10 lakh 50,000 plus, oh, I'm so sorry, 1 second. It is 15,000 per month, right? So that is 45,000 into 12. That is 5 lakh 40,000. So if I take 10 lakh 50,000 plus 70,000 worth of payment, that is 16 lakh 60,000. No, they still want 16 lakh 11,000 here. What's going wrong? So 10 lakh 50,000 and plus 15,000 into 3 into 12. I get 1590 plus 21,000 is what I need to disallow. Oh yeah, I'm getting the right answer. Maybe calculator error people, I'm sorry about that. Yes, so calculator mistake, so 16 lakh 11 is the right answer. Yes, so what are you doing? You're taking 10 lakh 50,000, you're disallowing 45,000 for all the 3 people per month into 12 will give you 5 lakh 40,000, so disallow that. Point number 2 gets allowed as reduction, 70,000 will be disallowed to the extent of 30%, which is 21,000. You should get the answer as 16 lakh 11,000. That is what the right answer is. Next, what is the amount of profit and gains of business or profession chargeable to tax in the hands of Naveen if he does not want to get his books audited? People, he does not want to get his books audited. Point number 1, point number 2 and point number 3 all will get ignored. No disallowances happening based on that. I will directly take my turnover and I will compute the book profits. Now, what is my turnover here? My turnover is 2.8 crores. In that 2.8 crores, 8 lakhs is received by cash. Yes, and 2.5 crores is received by permissible modes. Now 2.5 crores alone is received by permissible modes, which means technically 30 lakhs is not received by permissible modes, where 30 lakhs, 8 lakhs is received by cash, the balance is not even received of. So I would say 2.5 crores is the number which is taxable at 6%. Yes, so 2.5 crores will be taxable at 6% and 30 lakhs will be taxable at 8%. Therefore, the answer should come as 17 lakh 40,000, which is option number A. Yes, please pay attention to the fact, people, that extra 10 lakhs which is received by cross check and everything was only for the purpose of MCQ number B and not for MCQ number E. You have to read the question very carefully, and therefore I would do it that way. So that is option number A in question number E. That's all, people. This is what your PGVP questions look like. Some interesting questions, definitely. Some places even I went wrong, and therefore I had to look at the options as well. So yes, I would request every one of you to please pay attention to all the MCQs which is given in the PGBP chapter. For those people who have been making mistakes and have not got this MCQs right, I would make a sincere request that go to your concept guides, go to whatever material you're using, and please make note of those adjustments that yes, I have made this mistake when I was reading it earlier. When I do it in my exams, I will not make that mistake. That is one small request which I always make to everyone, because today you may be feeling bad about not answering that question right, but if you end up forgetting it before your exams, the reason is not really solved. So therefore, please make note of all those adjustments which you are going wrong for, so that next time you pay special attention to those adjustments and you don't end up making that mistake in your exams. Awesome. With that, people, we're done with the MCQs on PGBP as well. We have just some couple more chapters left, and we will be quickly closing those chapters as well. So yes, please watch out for this channel. You should be getting all those videos as well as soon as possible. Until the next video, we will have a great learning ahead, people. Have some good time spent on your reading, not just DT, not just IDT, but your other subjects as well. Prepare very well for your upcoming exams, because yes, you deserve to become the CA you are eligible for. A little bit of discipline from your side, a little bit of effort from our side. We will do it together and we'll definitely clear through. Yes, so spend some time and let's do it well. Happy learning to all of you. I will see you all with the next video very soon. Until then, take care. Bye. Hey boys, welcome back to the MCQ series. Today we are discussing the chapter called as capital gains, chapter number 6 of the MCQ guide. One of the most important chapters when it comes to your current exam, at least for May 25, September 25 and Jan 2026. The major amendments are there in capital gains, and therefore a good set of questions can come from ICAI's perspective. Let's look at what questions ICAI has drafted and then we'll take it from there. Yes, we're looking at the question number 1 of your MCQ guide, chapter number 6, capital gains. Question number 1. It says a building was acquired in 1995 for 20 lakh rupees and was sold for 80 lakh rupees on September 2024. People, when it comes to capital gains question, this year at least you need to ensure that you always check for the dates. In this current scenario, the sale has happened on 1st September 24, which means it's happened after 23rd July. The new provisions will apply accordingly. The fair market value of the building on 1st April 2001 is given as 25 lakhs. The stamp value on that date is given as 22 lakhs. They're asking you to determine the capital gains. Now, one thing which you need to keep in mind, people, the current important amendment which is there in capital gains comes and says that if you sell an asset after 23rd July, indexation benefits have been denied to you. But if it is a tax computation question, then you will have to check for indexation also to check where the tax is lower. In a question like this, where they only ask you for capital gains, you will follow only the new rules, people. You will not check for the old rules because the question only wants the income. If the question asks for tax, is when you need to trigger your mind and you need to come and say, yes, I have to check for the tax as per old provisions as well. This is a new provisions question, and therefore, does indexation hold any relevance to me? No. No indexation relevance to me. I don't care about the indexation. Quickly looking at the facts, people, the question says my sale value is 80 lakh rupees. So I'm going to take my sale value as 80 lakhs. In that 80 lakhs, I have to now reduce something. I need to reduce my cost of acquisition. But if you notice, asset is acquired before 2001, the provisions simply come and say when an asset is acquired before 2001, you need to take the FMV or STV, whichever is lower, and compare it with the actual cost, whichever is higher. Checking the FMB, people, 25 lakhs, SDV is 22 lakhs, whichever is lower becomes 22 lakhs. Comparing it with the cost of acquisition of 20 lakhs, whichever is higher becomes 22 lakhs, and therefore my revised cost of acquisition is 22 lakhs, giving me an answer of 58 lakhs. Option number A is the right answer. Yes, option number A becomes my right answer. That is the simplest question. No challenges here, people, is what I'm assuming. I hope you don't have any challenges in this part. Yes, let's move on forward. Question number 2. Question number 2 says, Mr. A is age 45 years and has sold an agricultural land for 52 lakhs on 4th October 2024, which is acquired at a cost of 49.25 lakhs on 13th September 23, situated at 7 kilometers from the jurisdiction of municipality and has a population size of 4 lakh rupees. Now, people, when it comes to agricultural land, you need to first check whether it's rural land or urban land. If it has to be an urban land requires says that if you're going to go beyond 6 kilometers up to 8 kilometers, you need to have a population size of 10 lakhs to call it as an urban land. If it is below 10 lakhs, then the land becomes a rural land, and therefore it will be an agricultural income. Yes, in this case, they're coming and saying the population size is only 4 lakh rupees, 4 lakhs, and therefore this is an urban land, which means this is not a capital asset for the purpose of capital gains. They've also sold another agricultural land for 53 lakhs on 12th December 24, which was acquired at a price of 46 lakhs on 15th February 23, situated at 1.5 kilometers and having a population size of 12,000. Now, people, if you're going beyond your municipality range, if you're going beyond your municipality range, for the first 2 kilometers, the population size should be within 10,000. If it is more than 10,000, it becomes an urban land. This is a 12,000 population size, which means the second land is an urban land and therefore is fully taxable. Yes, so the second land is what I'll be considering as a taxable component. Now, the sale has happened on 12th December 24, which is after 23rd July. New rules will apply. Purchase happened on 15th February 23. Now, people, for 15th February 23, for a land to become a long term, it needs to hold for at least 24 months. 15th February 23, 24 months will become 15th February 25. I have sold the land on 12th December 24, which means this is a short term asset. Yes, keeping that short term asset in mind, people, my sale value is 53 lakhs, my cost of acquisition is 46 lakhs, which means it becomes a 7 lakhs ka short term capital gains. Option number B becomes the right answer. Yes, please note carefully, the first land is a rural land, the second land is an urban land, so I'm only taxing the second land. Are we clear? Sweet. Move on forward. Question number 3 says, Mr. Ram is an Indian resident and has purchased a residential property at Gwalior on 28th May 1999. Now, people, 1999 automatically means asset is purchased before 2001 and the purchase has happened on 28.5 lakhs. The fair market value and stamp duty values are given to you, 33.5 and 32.4. I told you, people, whichever is lower and compare with whichever is higher. Whichever is lower becomes 32.4 and whichever is higher becomes 28.5. So, I will take the answer as 28.5. That is my answer. Yes, so my cost of acquisition becomes 28.5 here. Don't know what the issue is. Anyway. On 5th February 2012, Ram has entered into an agreement with Byomkesh for the sale of the property for 74 lakhs and has received an advance of 3.9 lakhs. However, Byomkesh did not pay the balance amount. Ram has forfeited the advance. What would be the indexed cost of acquisition of Ram if he sells the property on 23rd May 2024? People, when it comes to indexation rules with advance forfeiture, the rules of advance forfeiture is that if the forfeiture happens before 2014, you will reduce it from the cost of acquisition before doing indexation itself. Yes, so I need to first factor that into mind, people. Let's keep that understanding in mind. Now, I have to take that into consideration, people. My 74 lakhs is ignorant because that's not a relevant information. My cost of acquisition will become 32.4 lakhs. Yes, 32.4 lakhs becomes my cost of acquisition. In that, if you notice, my advance amount is 3.9 lakhs, so I reverse that. My net cost of acquisition is 28.5. On this, I have to do indexation, people. Indexation for the current year will be 363 divided by 100 will give you the answer. Therefore, 103.455 is the answer. Option number D is the right answer. Yes, option number D will become your right answer. This is easy question, people. The only challenge here, if you notice that the indexation rates were not given to you, is it a possibility that they will not give you indexation rates in exam? No, they will give you the indexation rates in exam, people. So you don't need to remember any indexation rate for your exam and go completely fine for that. Next, question number 4 says, under section 54 EC, capital gains on transfer of land and building has been requested are exempted and invested in the bonds of NHA and RECL or other notified bonds within 6 months of what? Income tax is, it is 6 months from the date of transfer, people. Yes, so therefore it is option number A. Option number A is the right answer. It is from the date of transfer. This is a simple theoretical question. Question number 5. It says 24-25 Arun has transferred the following long-term assets. I have a residential property, 6 crores cost of acquisition. Transfer date is 25th November, which means this is after 23rd July. Next one is jewelry, which is 3 crores and 2 crores, and 5th January 25. This is also after 23rd July. Mr. Arun has bought a new residential house property on 1st April 23 for 1 crore and on 28th February deposited 3 crores in capital gains account savings scheme. On 1st May 2025, Arun has withdrawn 3 crores from the capital gains account savings scheme and has acquired a residential property worth 2.5 crores. What would be the capital gains in the hands of Arun if the expenses in connection with the transfer is 2 lakh rupees, but this one is for jewelry. Yes, this is what the question is. Now, this one is an interesting and a tricky question, people. So let's pay attention to this. First of all, I need to compute my capital gains. So let's compute my capital gains here. In the first scenario, my residential house property sold for 8 crores, got for 6 crores. Date of transfer is 25th November. Therefore, this is a long-term asset. Yes, I am assuming this is a long-term asset, people, because the question itself comes and clarifies this is a long-term asset. Correct? So I'm keeping that in mind and I'm factoring my things on the right side. I am telling my house property, my full value of consideration is how much? 8 crores, is it? Yes, my full value of consideration is 8 crores. My cost of acquisition is 6 crores, giving me a resultant capital gain of 2 crores. Now, this would be under section 112. Correct. Moving on to jewelry, people. Under jewelry as well, what is happening? I have purchased this asset for 3. I have sold this asset for 3 crores. I have purchased this asset for 2 crores, giving me a resultant capital gain of 1 CR. Now, this will also go under section 112. Interesting thing here is, people, after that the person has decided to buy a residential house property on 1st April 23. Now, if you notice this carefully, the provisions of income tax come and say that when you're buying a residential house property, you can buy it 1 year before or 2 years after. Correct? Yes. So let's factor that into consideration, people. 1 year before and 2 years after, which means I sold these properties on November 24 and Jan 25. 1 year before for 25th November 24 would become 25th November 23, which means this asset was purchased way before 23 also. Way before 23 also, which means this is not an eligible deduction. Correct? Yes. Notice carefully, people, you need to be doing it 1 year before and 2 years after. Now, 1 year before from 25th November 24 is 25th November 2023. This is a purchase made on 1st April 23, which is even before 1 year, and therefore this cannot be claimed as an exemption. Next, on 28th February 25, the person deposited 3 crores. Now, if you notice, people, 25th November kapro 20th February, if I deposit, this is still valid. Yes, capital gains account scheme is a valid mod. But the problem is, people, before my return filing itself, I have withdrawn the 3 crores. So, Appu, does the 3 crores hold any relevance? No. Income tax comes and says on the due date of filing of return, there should be some money in the capital gains account savings scheme. So, which means 3 crores I deposited, 3 crores I withdrew, nothing is there in my capital gains account savings scheme. Therefore, neither the 3 crores is relevant nor the withdrawal of 3 crores is relevant. What is relevant? I have purchased a residential house property worth 2.5 crores. Now, this becomes a relevant answer. Now, with this 2.5 crores, people, I have two options. Understand carefully, I have a residential house property. If I buy a second residential house property, I get an exemption under 54. So, therefore, the first order of priority, I will first claim something under section 54 for worth 2 crores. And therefore, my house property becomes 0. My house property becomes 0. Coming to the balance 50 lakhs which I have, people, can I use it for my jewelry? Yes. You have a section called as 54F. 54F comes and says that when you're selling any other long-term capital asset and investing in a house property, you can claim an exemption there also. Yes. So 54F is the exemption which I'll claim. But to claim 54F exemption, people, there is a certain rule. The rule says that you have to invest the net consideration in order to get the exemption. You cannot invest your capital gains unlike 54. So, which means if I had invested 3 crores, I would have got an exemption of 1 crore. Here is a case where I've only invested 50 lakhs. So, I need to know what is the resultant exemption which I will grant. Yes, my resultant exemption will be what, people? I'll get 1.5 divided by 3, which is 0.5. Yes, so, yes, 1.5 divided by 3. So, the answer is 0.5. No, something is wrong. Oh, sorry. It is 1 crore into 0.5 divided by 3. Yes, I am getting the exemption as, how much is this? 116 lakhs, is it? Okay, let me do it in full numbers itself. This is kind of confusing. 1 lakh, 10 lakh, 1 crore into divided by, so it is 50 lakhs divided by 3. I get the exemption as 16,66,667. Yes, so my exemption quantum is 16,66,667. Now, if that is my exemption, people, how much is my taxable capital gain is what I need to check. So, 16 lakh minus 1 crore is what I will take as an amount. And therefore, my resultant capital gain comes to and yes, 16,66,667. My resultant gain becomes 83,33,333. 2 crores, 2.5 crores is what I have. I invested 50. Oh, okay. One second. You have a expenses in connection also. Yes, people, I think that's where the mistake is. So you have a expenses on connection also, which is 2 lakh rupees, which means you have to net the consideration. So 2.98 crores is what you have. Correct. So 2.98 crores is what you have. Now you have to make an investment of 0.5. So if you invest 2.98 crores, I'll give you an exemption of 1 crore. No, how much is my exemption? I'll get an exemption of 0.98 crores. Yes, I'll get an exemption of 0.98 crores. Now, if I invest that is what I get. So how much will I get if I invest only 0.5 crores? That is what we need to do. So therefore, I'm doing 0.5 into 0.98 divided by 2.98. My exemption number comes to 0.164429. Yes, so I get it as 0.164429. Let's say, so 16,295,000 is what I can write it as. Correct. So 98 lakhs minus 1644295 is what I have. 8155,705. Yes, option number B makes the sense. So option number B is the right answer. Yes, so this is what it is. I think the one mistake which I made is I ignored this part of the connection of expenses. That alone has to be taken into consideration. Other than that, the answer is right. Yes, so this is a good question, people, where you need to understand that just because you have two different capital gains, it is not a requirement that you have to have houses separately. A single house can also be invested by using both the assets. That is also completely permitted in income tax. And therefore, in order of priority, I first gave 54 exemption because that's where I'll get the most exemption. And then I gave jewelry as an exemption. That is also the answer. Yes, question number 6. Question number 6 says Mr. Vishal and Mr. Guha sold their residential house properties in Pune for 3 crores and 4 crore respectively in April 2024. Now people, this is a sale made in April 24, which means this is before 23rd July. Let's keep that in mind. The house property was purchased by them 25 months back. People, both houses were purchased 25 months back, which automatically means the houses are long-term capital assets. The index cost of acquisitions are given to you. Good for you. Already given index cost of acquisitions. 1 crore and 1.75 crores is given to you, which means if I have to compute this, people, Vishal will have a capital gain of 3 minus 1, which is 2 crores. And who is the other person? Guha. Guha will have a capital gain of 4 minus 1.75 crores, which will become 2.25 crores. Correct? Let's keep that in mind. Mr. Vishal has purchased 2 residential house properties, one in Delhi and one in Agra, for 70 and 80 lakhs respectively in May 2024. On the same date, Guha has also purchased 2 residential house properties, one in Mumbai and the other in Pune, for 80 and 75 lakhs respectively. Both of them invested 30 lakhs in NHAI bonds and 30 lakhs in RECL bonds on June 2024. What is the income taxable under the head capital gains for Vishal and Guha? Now, this one is something interesting, people. If you notice the section of 54, section 54 basically comes and says that when a person is wanting to buy a house property, he can sell one house property and only buy one house property. However, if your capital gains is less than or equal to 2 crores, you are eligible to buy 2 house properties once in your lifetime. Notice for Vishal, people, Vishal's capital gain is exactly 2 crores, which means Vishal can buy 2 house properties as well. There will be no restriction on it. Keeping that in mind, if you notice Vishal has actually bought a house property of 70 and 80, which is becoming 150. So in the 2 crores, 1.5 crores is allowed as an exemption for me. Coming to when it comes to 54 EC, the person has invested 30 lakhs in NHA and 30 lakhs in RECL. 60 lakhs is the total amount of investment, people, but 54 EC restricts you to claim only 50 lakhs as an exemption. So 0.5 is what I further reduce, and therefore the answer becomes 0. So for Vishal, there will be no income tax payable for capital gains because everything is exempted from taxes. Coming to Guha. The problem with Guha is that Guha has a capital gains of 2.25 crores. With Guha having a capital gain of 2.25 crores, they can only invest in one house property. You cannot invest in 2 house properties because the capital gain has exceeded 2 crores. With that condition, people, I will choose the house where I'm getting the most exemption. So which means if I look at Guha has purchased for 80 and 75. I will claim the 80 lakhs as an exemption. So therefore 2.25 minus 0.8 will give me 1.45. Same people for Guha is also invested in 30 and 30, which means Guha can claim an additional 0.5 exemption for 54 EC, giving me a taxable capital gain of 95 lakhs. So which means the answer becomes nil and 95 lakhs respectively. This is what the answer is. Yes, the interesting question, people. Interesting question. You need to pay attention to the exemption rules for this. Good. Question number 7. Mr. A has purchased equity shares of listed company on 1st May 2024 through recognized stock exchange. He will sell the said shares after holding them for 8 months on BSE. Mr. A is predicting that he will make a profit of 1,30,000 by selling the equity shares and further is of the view that the said profit is exempt from income tax. Determine whether Mr. A's view is correct in light of the tax implications that shall arise in the hands of transfer of said equity shares. Now people, this is a listed company shares, which means technically this is 112A. The holding of period is given as 18 months, which is more than 12 months. So therefore 112A will come into picture. Now, is the profit exempt from tax is the question. The answer is partially no. If you notice, 1,30,000 is the profit which he's made. The current year amendments permits you to claim an exemption of 1.25 lakhs. So 1.25 lakhs is what I'll claim as an exemption. Balance will become taxable. Look at it. It says Mr. A's view is correct. No. Mr. A's view is incorrect. The resultant capital gains would be chargeable in the hands at the rate of 20%. No. People, I'm buying it on 1st May 2024. If I'm going to sell after 18 months, that is going to be post 23rd July, which means it is going to be at the rate of 12.5%. Third, Mr. A's view is incorrect. The resultant gains would be short-term capital gains. No. Fourth one, Mr. A's view is partially correct. Resultant gains would be long-term capital gain exempt to 1.25 lakhs. Long-term capital gain in excess of 1.25 lakhs would be taxable at 12.5. Yes. This is what the right answer is. Yes, so this is a good question which tests on your amendment. It also tests on the fact that yes, you have to have a period of holding and what is the assets which you can claim as exemptions. Great. Question number 8. Now we are starting with case scenario questions, people. I think I fairly have only one case scenario question, so an easy question should be there. Let's check the question. It says, Mr. Rajiv is an Indian resident and has purchased a residential house property at Gwalior on 28th May 1999 for 28.5 lakhs. People, the facts are repeating itself. We are before 2001. We will take the indexed cost of acquisition. Sorry, we'll take the FMV or STV, whichever is lower, compare with the cost, whichever is higher. Fair market values are given to you 33.5, 32.4. I am going to take 32.4 as my cost of acquisition as it is. On 25th March 2014, Rajiv has entered into an agreement for sale of the property for 74 and has taken an amount of advance of 3.9. Now people, same question has got repeated, but this is a case scenario question. The difference here is what we have to explore on. Understand, this is again 25th March 2014. Anything after 1st April alone will be taxable under IFRS. Before 1st April will still be considered as reduction from cost is what we need to keep in mind. Mr. Virat has not paid the advance. Rajiv has forfeited advance. Yes, forfeiture of advance. 15th April 24 is given, people. This is before 23rd July, so old rules will apply. Rajiv has sold the property for 2.1 crores when the stamp duty of the property is 2.33 crores. Now people, this is where the next part of the question comes. If you notice, when it comes to full value of consideration also the same rules will apply. When it comes to full value of consideration, section 50C comes and says you need to take the actual sale value or the stamp duty value, whichever is higher. However, always check for 110% as a condition. Now, if I take 2.1 crores and I add another 10% on this, the number comes as 2.31. Here it is 2.33, which means 2.33 is what will prevail, people. 2.1 cannot be taken into consideration. I need to take my capital gains as 2.33 crores for the purpose of sale value. Indexation benefits are given to you, which is good enough. What shall be the indexed cost of acquisition of Rajiv's house property at Gwalior for computation of capital gains? Very simple, people. I'm going to take what? I'm going to take my cost of acquisition as 32.4. I'm going to reduce 3.9 as my cost of acquisition. Multiply this with 363 and divide it by 100. The answer should come as 103.455, which means option number B is the right answer. Yes, so B is what I'm going to take as the right answer. Good. What is the amount of capital gains in the hands of Rajiv for the sale consideration? Now, people, when it comes to sale consideration, we need to compute the answer. Now, I know what my full value of consideration is going to be. My full value of consideration in this question is going to be 2.33 crores. Yes, it's going to be 2.33 crores. I just found out what is my indexed cost of acquisition, people. My indexed cost of acquisition, as we found out, is 1 crore 3 lakhs 3 lakhs 455. Yes, so it's 103,45500. Let's reduce this and check. What should I be reducing? Yes, I will be reducing 233. Therefore, the capital gains should come as 129,54500. Therefore, answer number C is the right answer. Option number C is the right answer. I will take it as 129,54500. Yes, easy question. Question number C. What is the amount required to be deducted as TDS by Suraj under 194 IA? People, 194 IA provisions come and say you need to deduct TDS at the rate of 1% on the sale value or the actual STV, whichever is higher. Yes. Now the sale value is 2.31, the STV is 2.33. Therefore, I'll have to take 2.33. On that 1% will take place, and therefore the answer becomes 233,000. Option number A is the right answer. Yes. Do not mistakenly take option number B. Option number B will not be the right answer. It is option number A. Yes. Also, do not mistake yourself for 23,000 people. You may get confused with the percentages. With the percentages, you just need to be careful. It is 2,33,000. It's 1% and not 0.1%. That is what this is. Yes. Great. This is what your questions on capital gains look like, people. Now, ideally speaking, there is a lot of good questions which can come in capital gains, and this is not covering it. The reason is because those questions have already been parked in the comprehensive question list. So as we do comprehensive questions, people, you'll get a fair understanding of what capital gains related questions will come. So yes, please wait until the comprehensive videos. You will get the better understanding of capital gains. But from a standalone perspective, capital gains chapter, easy questions. This is what the questions look like. Great. Yes. Thank everyone for watching this video. I hope this video was useful for all of you. We're going to come back with further videos discussing the balance chapters. We are almost halfway through, people. So therefore, just a handful of chapters pending for us. Let's do it together and let's complete this very nicely. Yes. So let's wait for the next video. Have a great learning until such time, people. Take care. Bye. Hey warriors. I hope you're all doing well. So yes, let's continue with our MCQ series. We are today discussing chapter number 7, the income from other sources. A fairly small chapter, people. I think we have a couple of MCQs, not much here. We have almost about, we almost have about 7 to 8 MCQs. So let's complete this quickly. I don't think you should have much challenges here. Let's look at the questions. The question says, during the previous year 24-25, Mrs. Kallis, whose age 65 years, has received 10,50,000 as family pension. She wants to spend 26,000 to get such income towards documentation and processing charges. She does not have any other income. Assuming she pays tax under default tax regime, what would be her total income chargeable to tax? People, family pension related exams, the provisions come and say that when a person opts for default tax regime, the person will be eligible for a deduction of 1/3 of the family pension or 25,000 rupees under default tax regime, whichever is lower. Expenses other than this can never be claimed as a deduction. So therefore, the 26,000 can get ignored. Looking at 10,50,000, let's check what is 1/3 of this. So 10,50,000 divided by 3 will give me 3,50,000. 3,50,000 or 25,000, whichever is lower will be taken as a deduction, and therefore it is I will take 10,50,000 minus 25,000 as the answer. Therefore 10,25,000 becomes the right answer. So option number D is the right answer. Option number D is the right answer. Yes. Question number 2. Mr. X is age 61 years, has earned a dividend of 12 lakh rupees from ABC Limited in 24-25. Interest on loan taken for the purpose of the investment is 3 lakh rupees. Income which is to be included is asked. People, dividend provisions come and say that when it comes to your dividend income, you can only claim interest as in deduction, but to the extent of 20% of the dividend income. My 12 lakh rupees ka 20% will become 2,40,000 rupees, and 3 lakh is given to you, so which means I can maximum claim only 2,40,000. So therefore 12 lakh rupees minus 2,40,000 will give me the right answer. The answer comes to 9,60,000. Therefore, option number B is the right answer. Yes, easy, quick, easy questions. Next, Mr. Kashyap has acquired a building from his friend on 10th October 2024 for 15 lakh rupees. The stamp value of the property is 16,20,000 rupees. They want to know what is the income chargeable to tax in the hands of Mr. Kashyap. People, when it comes to gift of immovable properties, there are 2 conditions to be satisfied. Condition number 1, that the sale consideration difference between STV and the sale consideration should be more than 50,000, and STV should be more than 110% of the consideration in order to apply the gift provisions. Now, in this case, 16,20,000 minus 15 lakhs will give you 1,20,000, so that is still more than 50,000. But if I do 110% of consideration, 15 lakhs, if I do 110%, I get the answer as 16,50,000. Now, I was permitted to take a gift up to 16,50,000. The SDV is only 16,20,000 here, which means do you have a gift in this question? The answer is no. There is no gift provisions in this, and therefore the answer is option number C. The answer is option number C. Easy question. Question number 4. Mr. Vikas is receiving a gold ring worth 60,000 rupees on the occasion of his daughter's wedding. People, Vikas is receiving a gift on the occasion of his daughter's wedding from his best friend, Mr. Vishnu. Definitely not an exemption, because you should be gift given on your wedding. Mr. Vishnu is also gifted a gold chain to Kavya, the daughter of Mr. Vikas, 80,000 on the occasion, which means Kavya is the daughter who's getting married and she has received a gift. That would be exempted from tax. What would be the gift taxable in the hands of Mr. Vikas and Mr. Kavya? Yes, the gift of gold ring and gold chain is taxable. No. Such gifts are not taxable. No. The value of gold ring given is taxable in the hands of Mr. Vikas, but the gold chain is not taxable in the hands of Kavya. This is the right answer. Yes, notice the gift provisions, people. For the gift provisions to apply, the person who's getting married alone can get the gifts. Anyone else should not be receiving any gifts, and that would be fully taxable. So therefore, option C makes the most sense. Next, Mr. Mayank has received a sum of 75,000 rupees on 24 October 2024 from his friend on the occasion of his marriage anniversary. What would be the taxability of the said sum in the hands of Mr. Mayank? So Mayank is receiving 75,000 from his friend on the occasion of his marriage anniversary. People, marriage is exempted. Marriage anniversary is not exempted. Second, the person giving the gift is his friend. Therefore, fully taxable. You cannot treat it as an exemption. This is fully taxable because the amount has exceeded 50,000 rupees. Next, Mr. Vikas is transferring 600 unlisted shares of XYZ Private Limited to ABC Private Limited on 15th December 24 for 3,50,000 when the market value is 5,15,000. The indexed cost of acquisition on this date is 4,25,000. They want you to find out the income which is chargeable to tax in the hands of Mr. Vikas and ABC Limited in respect of the above transactions. People, because they're asking for both things, you need to step yourself into the person's shoes to understand what is happening. If I am Mr. Vikas is transferring some shares, which means Mr. Vikas is under capital gains. Now, when Mr. Vikas is transferring shares for 3,50,000 when the market is for 5,15,000, there is a specific provision under Income Tax Act. The provisions of Income Tax comes and says when you transfer any unlisted or unquoted equity shares, you need to transfer it at FMV mandatory, section 50 CA. Yes, because you have not transferred it at 5,15,000, I will assume the full value of consideration is 5,15,000. With my full value of consideration becoming 5,15,000, if I reduce the cost of acquisition, which is 4,25,000, I get a taxable capital gains of 90,000 rupees. Where do I have 90? I have 90 in option A and option C, which means I can straightforward come and say B and D is wrong. Next, looking at the other person who is receiving the shares is received by ABC Private Limited. Now, ABC Private Limited has received shares of 5,15,000 for worth of 3,50,000, which means the gift element will be taxable for this person. So, 5,15,000 minus 3,50,000 would be the taxable income for ABC Private Limited, which is 1,65,000. 1,65,000 shows in option number C, and therefore option number C becomes the right answer. Yes, a quick easy question. Question number 7. In case of a member of parliament, daily allowance is exempt but constituency allowance is taxable. No. Constituency allowance is received as applicable rules is exempt but daily allowance is taxable. No. Both daily allowance and constituency allowance are taxable. No. Both daily allowance and constituency allowances are exempt. The answer is yes. Yes, when it comes to member of parliament, these both are exempt. The only problem in this question is this question does not mention that you are opting for DTR or ATR. People, if you are opting for DTR, this is not exempt. In DTR provisions, this will become fully taxable. It is only exempt under ATR provisions. Alternate tax regime is only what can claim this as exemption. In the lack of information, I am assuming they are opting for ATR. Next, look at the case scenario question. The case scenario question comes and says, there is a woman called Mr. Akshaya, there is a person called Mr. Akshaya Biani who is celebrating his 26th birthday on 15th May 24 and has arranged a grand party at Radisson Blu Hotel. People, birthday, no exemptions. On this occasion, he invited his friend, his blood relatives, his distant relatives to attend the party. Okay, so some relatives are coming, some non-relatives are coming. The ceremony was so grand that the feast was also very spectacular. Irrelevant information. All the arrangements and decorations were absolutely wonderful. Okay. At the end of the party, Akshaya has received the following gifts and flower bouquets as his gift. He has received a gift from his mother, 22,000 worth gold chain. The purchase was made for 37,822. People, gift received from mother fully exempt. I am not taxing this number. Next, gift received from father, 22 gold bracelet purchased the same day for 56,075. Not taxable. Gift received from wife, 4 gold rings. She purchased these rings on 15th May 23 for 35,000 each. Fair market value on 15th May was 37,429. Not taxable because wife is giving the gift. Sister has given a painting. The painting is made by her. Fair market value is 45. Sister is also a relative, not taxable. Next, father's brother. People, my father's brother is covered as a relative. That is also exempt from taxes. Closest cousin, mother's sister's son, daughter. People, mother's sister is a relative, but mother's sister's son and daughters are not relative. This is fully taxable. This is fully taxable. I cannot treat it as an exemption. This becomes fully taxable. What am I taxing it? But wait. Although this person is not a relative, the person has gifted a I-20 car. People, an I-20 car is not a specified asset, and therefore this also becomes exempt as an income. Next, friends and other distant relative giving a cash of 1,51,000. This is taxable. This is fully taxable because this is a cash received from friends. Cash exceeding 50,000 becomes fully taxable, which means if I look at the statement, in the statement everything is exempt except for the cash element. Mr. Akshay desires to set up a new manufacturing unit with his friend in partnership on 1st December 24. Okay. For making the investment, he sold the following jewelry which he has received on his 26th birthday. He sold the jewelry which he received from mother's gifted gold chain for 40 to 150. People, mother's gold chain has been sold and therefore invested in the business. I see no problem here. Next, I have also sold father's gifted gold bracelet 60,180. No problem here. Father's brother's gifted gold chain for 2600. People, father's brothers is also an exempted component. Again, invested will not be a problem. His wife gave him 1 lakh rupees as a gift so that he could invest sufficient money in the unit. People, here I have a problem. Wife has given 1 lakh rupees as a gift. This 1 lakh rupees which is given by the wife would be treated as clubbing of income provisions. Yes, clubbing of income rules will apply here. The only challenge is that he is investing all these things on 26th birthday, which is on May. People, clubbing rules will only apply when the money is invested on the first day of the previous year. On the first day of the previous year, the asset has not, it should be part of your opening capital. I'm so sorry. So what is happening? They're deciding to open a manufacturing unit and therefore the opening capital will have 1 lakh rupees. Yes, people, the opening capital will have 1 lakh rupees and therefore this will still be a clubbing of income provisions. Clubbing of income provisions will apply. Next, on 1st December 24, he invested 6 lakh rupees, including the amount received from the sale of above gifts and amount received from his wife, and invested 4 lakh rupees in the firm. So he has invested 6 lakh rupees in which his wife's gift is also covered, and he has also got 4 lakh rupees from his firms, from his friend, which means in that 6 lakh rupees, people, 1 lakh rupees worth of the investment will be clubbed in the hands of the wife. Let's keep that in mind. On 1st February 25, his wife has again gifted him 1 lakh rupees as gift to invest in such money in the firm, and apart from that, he also invested 50,000 more from his individual saving. People, this 1 lakh and 50,000 has no relevance for clubbing provisions because clubbing will only apply for the opening capitals. On this day, his friend has also invested 1 lakh in the firm. Again, not relevant information. Since the firm is a manufacturing unit and it's at an initial stage, the firm required sufficient funds, so Mr. Akshay sold his wife's gifted gold rings for 40,250 each as on 31st March 25 and has deployed the funds as on the capital of 1st April 25. People, this is again a clubbing provisions. Because provisions of clubbing come and say whatever gift has been received from wife, if you take that gift and you earn any income out of it, that will also be taxable in the hands of wife and not in my hands. Clubbing provisions will apply here as well. But again, this investment is made on 1st April 25, which is part of next financial year, not part of current financial year, not part of opening capital. Let's keep that thought in mind. Based on the facts of the information given above, choose the most appropriate options. What is the amount of capital gains taxable in the hands of Mr. Akshaya for 24-25? For 24-25, what exactly is the person selling? The person is selling, for making the investment, he sold the following assets. So he has sold the following assets, people. First, I have sold 40,150. I have sold 60,180. I have sold 20,600. Let's take these capital gains first. People, because these amounts are not taxable under IFRS, the cost of acquisition in the hands of the person will be cost to the previous owner. So let's keep that in mind, which means for the purpose of mother's gold chain, I will take 42,150 minus the cost of acquisition by mother is 37,822. Therefore, the answer becomes 4328. I put this in M plus. Coming to father's gift. Father's gift is 6180 minus father's gift is 56,075. And therefore, father's income is 4105. That is also M plus. Third, 20,600 is the gift of father's brothers, and that father's brother was purchased for 18,200. Therefore, the gift is M plus 2,400 rupees. MRC becomes 10,833. Okay. Next, what else has he sold? On 1st December, he invested 6 lakh rupees, including the amount received from the sale of above gifts, which is already taken, invested 1 lakh. On 1st February, wife gave 1 lakh rupees, not covered. Then, manufacturing unit, initial stage, he has also sold the gift of gold rings, people. Now, wife's gold rings would be a capital gains, but the problem is it will be taxable in the hands of wife and not in the hands of the husband because clubbing provisions will apply, which means my answer will remain 10,833, which is option number A. Yes, so this is option number A is the right answer. Option number A is the right answer. Now, if you notice, people, if you had taken the wife's gold rings as a taxable component, the 4250, then you will find that also as an option. Please don't take that as an option. Please don't take that as an option. Next, what is the amount of gift not considered as income under section 56(2)(10)? People, what and all are the gifts which I have received? One, I have received a gift of 37,822 plus 56,075 plus I have received 4 gifts. The fair market value, she purchased the rings for 35,500. The fair market value is 37,429. So 37,429 is what the next gift is. So I will take, let me put this number till now. So it is 93,897 plus the fair market value of the gifts, people, which is 37,429 into 4, is it? How many gifts are there? Yes, 4 gold rings, and therefore 149716. Next, I have received a painting worth 45,000 as well. Yes, so 149716 plus 45,000 plus 93,897 plus father's brother gift of 18,200 plus I have received a car of 4,10,000. What else? I have also received from wife 1 lakh rupees plus wife again gave him another 1 lakh rupees plus, yeah, I think that's it. So the number should come as 916813. Yes, option number C becomes the right answer. Option number C becomes the right answer. The one thing which I probably want you all to pay attention, people, is on the point of wife. On the point of wife, notice carefully, the question comes and says she purchased the rings for 35,500 each but gave it as fair market value of 37,429. The one mistake which most of the students may end up making is that they may take for the purpose of gift 35,500 into 4. No, please understand, the question is asking what is the amount of gift not taxable, which means they want you to first tell you what the gift is and then tell what is not taxable. In this case, my gift is 37,429 worth of fair market value of the asset, people, and not 35,500. So that is one thing which you probably will make a mistake on. So please pay attention to that. Please pay attention to that. The answer is 916813. Next, what is the gift amount taxable in the hands of Mr. Akshay? People, there is only one gift which is taxable in the hands of Mr. Akshay, which is 1,51,000. That is option number A. Easy question. Next, is any amount taxable in the hands of Akshaya's wife in respect of sale of jewelry by Mr. Akshaya? If yes, what will be the amount taxable in the hands of wife? People, what is the amount taxable in the hands of wife has been requested. If you look at the wife's asset, what is a wife? Wife purchased it for 35,500 each. So 35,500 into 4 is what the wife purchased the assets for, which means 1,42,000 is what the wife purchased it for. The husband has sold it for 4250. Yes, so 4250 is what the husband purchased it for. So therefore he sold it for 1,61,000. If I take this both, I get the answer as 19,000 rupees. 19,000 rupees is the short-term capital gain which will become taxable in the hands of wife. While yes, this is a gift related question, there was a clubbing hint on this also, people, which you had to pay attention on. Luckily in this question they did not ask you on the firm's profit and firm's investment, the company's profit and the company's investment, so you're technically safer on this. But yes, this is what the question looks like. Yes, a fairly nice, a beautiful question which you all have to pay attention to, people, because this was a good question which could have been tested in exam as well. Yes, but yes, other than that, IF was fairly an easy chapter, nothing complicated about this chapter. A person can easily solve these questions, should not be a rocket science. That's it, people, for today's video. I hope you all enjoyed the video and you got clarity on whatever questions you were stuck on. We will come back with further videos on the remaining chapters as soon as possible so that you can all enjoy these videos and understand what is happening in the syllabus. Thank you all. Have a great learning ahead. I will see you all soon with upcoming videos. Until then, take care. Bye-bye. Hey boys, welcome back to the MCQ series. We are today discussing chapter number 8, your clubbing of income chapter. For some reason, it looks like this is one of the ICS favorite chapters. Notice, no, we are almost having about so many 4 pages of MCQs. Capital gains also did not have so much of MCQs, and clubbing of income has so much. But I fairly am sure, people, this is going to be easy because we know this chapter is one of the most important ones. I have put it in category A, and I'm sure you all have also read this chapter. So let's quickly look into this MCQs. Let's try to understand what ICA wants to test you on this. Question number 1. It says Mr. Arvind is gifting a house property to his wife, Mrs. Meena, a flat to his daughter-in-law, Mrs. Sita, Both of the properties are let out. Which of the following statements is correct? Now people notice carefully, when a property like a house is let out, there are two conditions to be checked. One is from a clubbing perspective and one is from a deemed ownership perspective. When a property is let out to either your spouse or it is let out to your minor child, then deemed ownership provisions will apply and clubbing will not apply. So keep that one thought in mind, people. If you notice, Arvind is gifting a property to his wife, Mrs. Meena, so therefore that is a deemed ownership concept. Whereas when it comes to his daughter-in-law, Mrs. Sita, that is not a deemed ownership concept. That would fall into your clubbing provisions chapter. So let's keep that thought in mind. First one, income from both properties is included by virtue of section 64. No. Income from property gifted to wife alone is 64. No. Mr. Arvind is a deemed owner for both Meena and Sita. No. Arvind is a deemed owner for property gifted to Mrs. Meena. Yes. Income from property gifted to Sita will be included in 64. Yes, this is the right answer. Yes, so this is one mistake which most of the students end up making, people, and this is a critical mistake. If you notice carefully, when it comes to deemed ownership concept would come and say this will be taken as per HP chapter, right? Whereas when it comes to clubbing chapter may give you additional benefits. For example, a minor child may get 1500 worth of exemption if you put it under clubbing, but that will not be permitted if you call it a deemed ownership concept. So you have to be very, very attentive on that fact alone. Yes, so pay attention to that fact. Next. Mrs. Deepika, wife of Mr. Santosh, started a business of trading in beauty products on 15th July 24. She invested 5 lakh rupees in the business on 15th July 24 out of the gift received from her husband Santosh. She invested 4 lakh rupees from her own savings also on the same day. She has earned a profit of 9 lakh rupees from the business on 24/25. What would be the statements which is right? It says what is the statement to be right. Now if you understand, people, clubbing provisions come and say that when a spouse takes up a business and invests the opening capital in the business from the other spouse's money, then the profit has to be equally allocated in capital ratio. This is only applicable if it is a part of the opening capital. Luckily this is the case where the question is coming and saying that the business itself is started on 15th July and the money which is coming for the first time will be called as opening capital. Had the question come and said the business is there from 1st April and now in 15th July I'm investing money, I would have not clubbed anything, people, because that is a middle of the year investment. Since the business itself is starting right now and the capital investment is happening for the first time, it will be called as opening capital. Now how much profit have I earned? I've earned a profit of 9 lakh rupees, people. This 9 lakh rupees will have to be allocated between Santosh and the spouse. She has invested 4 lakh rupees, Santosh has invested 5 lakh rupees, which means wife will get 4 lakh of the profit and husband will get 5 lakh worth of the profit. That is what the answer is. So share of profit of 9 lakhs for Deepika? No. Share of profit of 5 lakhs is for Santosh and profit of 4 lakhs is for Deepika? Yes, this is the right answer. So option B becomes the right answer. Clear? Yes, the one small mistake which most of the people end up doing is that when they say opening capital, they assume that opening capital means any middle investments will not be taken. No, people. Opening capital means money which is invested for the first time in the start of the year or during the year also. So opening capital has an understanding to that effect. Please pay attention to that. Next. Arav is gifting a house property valued at 50 lakhs to his wife Geeta, who in turn has gifted the same to her daughter-in-law Deepa. The house was let out at 20,000 rupees per month throughout the year. Compute the income of property and in whose hands will it be taxable? People, the provisions come and say that when a person gives any property directly or indirectly to the son's wife, then it will be clubbed in the hands of the person. This is not a deemed ownership concept because son's wife is involved here. So therefore, this will be taxable in the hands of Arav, but it will be based on clubbing rules. Yes, keeping clubbing rules in mind, people, I have to take this into consideration. House was let out for 20,000 into 12 will become 2,40,000. I don't see anywhere that they've told in the middle of the year, which means 2,40,000 is the complete trend. Remove 30% standard deduction, the answer becomes 1,68,000. 1,68,000 is going to be taxable in the hands of Mr. Arav. Yes, so this is what the answer is. Please do not make a mistake of taking up option A as the answer. You have to grant a 30% deduction because anyway it's an income from house property. 30% deduction always remains. Next, Mrs. Shivani, who is the wife of Mr. Anurag, is a partner in a firm. Her capital contribution is 5 lakhs in the firm as on 1st April 24, which includes 3.5 lakhs contributed out of the gift earned from Anurag. The firm has paid an interest on capital of 50,000 rupees and a share of profit of 60,000 during the year. Now here is where most of the people end up going wrong, people. Sometime back we were just discussing about the fact that when it comes to a business starting by using spouse's money, you will start doing clubbing provisions. But understand, clubbing provisions will only trigger when the income is taxable in the first instance. Notice this carefully, the person is receiving two quantums. One is 50,000 worth of interest and one is 60,000 worth of profit. Now, share of profit from a partnership firm, I'm sure you're all aware, is completely exempt from tax. So, which means even though the 60,000 will be clubbed in the hands of the person, it does not matter because it is exempt from tax. So, I should ideally speaking not be looking at the 60,000 itself. That is not even my concern area. My concern area is starting only with the 50,000 rupees. Now, looking at the 50,000 rupees, what is happening? The total capital contribution of the firm is 5 lakhs, in which 3.5 lakhs is a gift received from Anurag, which means I will properly appropriate accordingly. Yes, so what is going to happen? I'm going to say out of that 50,000 rupees, the 50,000 rupees pertains to 5 lakh rupees. So, I need to know how much is pertaining to 3.5 lakhs, which is gifted from Anurag. Yes, so if 50,000 rupees is 5 lakh rupees, 3.5 lakhs will be 35,000. So 35,000 will be taxable for Anurag, 15,000 will be taxable for Shivani. That is what the answer should be. Share of profit is exempt, yes. Interest on capital is taxable for Shivani, no. Share of profit is exempt, but interest of 39,000, some random number, no. Share of profit is exempt, but interest of 35,000 for Anurag and 15,000 for Shivani, yes. This looks like the right answer, and therefore option number C should be triggered. Yes, so option C becomes the right answer. If you notice option D, it says share of profit to the extent of 42,000 is also taxable. No, people, share of profit cannot be taxable. That will be exempt from tax. Question number 5. It says on 20th October 24, Priya, minor child, gets a gift of 20 lakh rupees from her father's friend. So, minor child is getting a gift of 20 lakhs from her father's friend. Yes, not a relative, therefore fully taxable. On the same day, the amount is deposited as fixed deposit in Priya's bank account. On the said deposit, interest of 13,000 was earned during the financial year 24-25. In whose hands will the income of Priya be taxable? Also compute the amount of income that shall be taxable if both the parents are paying tax under default tax regime. Now, people, the question is coming and saying there is some money. There is some money which is to be taxed. Now, who is going to be taxed for it? It is very simple. It is only going to be taxable in the hands of parent whose income is higher. It is neither father nor the mother. It is the income of the person in whose hands the income is higher. Now, in this case, they have not mentioned whose income is higher. So, therefore, the option should ideally mention it. But before that, people, let's try to understand what to be taxed. I am going to be taxing what? I am going to be taxing the whole 20 lakh rupees plus the 13,000 rupees as well, because when it comes to minor child, accretion is also taxable. However, because this is income of minor child, you will get an exemption of 1,500 because you are claiming default tax regime. Yes. Now, the problem is, people, the question comes and says, one second. The question says if both the parents are paying default tax regime. Okay. Now, people, if the question says that both the parents are paying default tax regime, then I don't have an option. In that case, I will not be granting the 1,500 worth of exemption, which means the whole 20 lakhs plus 13,000 will become taxable. Option 1 says 20, 11, 500, no. Option 2 says 20, 13 in the hands of father, no. Option 3 says 20, 11, no. Option 4 says 20, 13 in the hands of Priya's father or mother whose income is higher. Yes, option D is the right answer. Yes, my default tax regime is what I need to keep in consideration, people, because both the parents are choosing default tax regime. I have no other option but to ignore the 1,500 worth of exemption. That will be fully taxable. Yes, so that alone is something which you had to keep in mind. So keep attentive to that extent. Next, question number 6. It says, Mr. Vishal has started a proprietary business on 1st April 23 with a capital of 5 lakh rupees. Okay. The person has incurred a 1 lakh rupees ka loss during 23-24. People, no facts given. The assumption is this 1 lakh rupees is fully pertaining to Vishal. So, Vishal will take the hit on this, which means his capital contribution is going to come down. His 5 lakh rupees of capital reduced 1 lakh of loss. Capital is now becoming 4 lakh rupees. To overcome a financial position, his wife Kamini, a chartered accountant, has given him a gift of 4 lakh rupees on 1st April 2024. People, the money has come from Kamini on 1st April 24, which means it's going to be part of my opening capital. So now if you notice, Vishal is going to have a 4 lakh worth of opening capital. Kamini has also deposited 4 lakh, and therefore that becomes 1:1 ratio. He has earned a profit of 2 lakh rupees during the year 24-25. What is the amount to be clubbed in the hands of Mrs. Kamini? Very simple. Whatever 2 lakhs is there, 1:1 ratio. Therefore, the answer becomes 1 lakh rupees. Answer is option number B. Yes, this one was an easy question. Question number 7. Mr. Raj is making a gift of 25,000 to his wife, Mrs. Rama on 27th March 2024. Previous year, people. Yes, Mrs. Rama on 1st April 24 has invested 75,000, 25,000 of gift and 50,000 of her own in a partnership firm, on which her total capital contribution is given. During the year 31st March, she has earned an interest of 12,000 rupees and a salary of 1,20,000 from the firm, both of which are approved by the partnership deed. What shall be the amount which will be forming part of Mr. Raj? Now notice people, here is a tricky case where earlier we spoke about share of profit. This one is a salary question. Now if you understand carefully people, salary is never given based on capital. Salary is given based on your hard work. Because the wife has earned the salary and no information is given that she is technically qualified or not, I would assume that she is technically qualified for the salary and therefore that will be fully taxable in her own hands. The husband cannot be taken a share for this because salary is based on her efforts, not because of husband's salary. So first option is people, for the 12,000, for the 1,20,000 worth of salary, that will be fully taxable in the hands of the wife only. Coming to the 12,000 worth of interest, the 12,000 worth of interest will have to be allocated between 1:2 ratio. Yes, because 12,000, 25,000 is given by the husband and 50,000 is from her contribution. So which means 12,000 divided by 3 into 2, 8,000 will be taxable for the wife and 4,000 will be taxable for the husband. Now the question is asking what shall be the amount of income taxable for husband. So husband will only be taxable for 4,000 rupees. Therefore that should be option number, husband will be taxable for how much? Husband will be taxable for the less of the portion, right? So it is going to be minus 4,000 rupees. Yes, and therefore the answer should be yes, so 12,000 rupees. In that my contribution is 75,000. Husband has invested how much? Husband is given 25,000. So it is 25,000 into 12,000 rupees divided by 75,000. The answer should come as 4,000 rupees. I think the option is option B, people. This one is wrong. This is not option A. This is option B. There is a mistake from my end. Yes, so please correct this one. The answer should be option B. It's not option A. Definitely is not option A. You don't see an option A anywhere. I can't make out how you can get an option A as well. Yes, because for you to get an option A, you should have a 1/4 ratio. Yes, 1/4 is not going to come out anywhere. So therefore it is going to be, yes, it's going to be that only. I'm just going to check this once again. So 12,000 divided by 75,000 into 25,000 is going to be 4,000. Yes, option number B is the right answer, people. Please change this off. This is not option A. Yes, this is option number B. Yes, this is option number B. Good enough. Let's move forward. It says Pankaj has gifted an amount of 3 lakh rupees to his wife Pinky and 2 lakh rupees to his daughter Rinki on age 20 years on 1st April 2020. People, daughter has become a major and therefore no clubbing rules will apply here. Both Pinky and Rinki invested the amounts of the same date in Government of India's bonds, 11 taxable bonds. Interest is accrued every year and is reinvested in the same bonds. Determine what will be the income taxable on 25-26 in the hands of Pankaj. That is what the question is coming and saying. Now people, for Pankaj, please note carefully that Rinki is going to be 20 years. So therefore Rinki's income is not going to be taxable ever. We're only going to be focusing on wife's income. Now wife has invested 3 lakh rupees and the investment is getting a 11% taxable bond. The interest accrues every year and is reinvested, people. The point which you need to keep in mind is that when it comes to husband, they're not asking for Pankaj, they're asking for Pinky, is it? Yes, so they're asking for Pinky, people, which means we'll have to compute this carefully. Yes, what is going to happen is that if you notice carefully, the husband is going to give 3 lakh rupees. Now in this 3 lakh rupees, the first year I'm going to fetch an interest of 11%, which means the number becomes 33,000. Correct? Yes. Now if you understand this carefully, people, this 33,000 is going to be taxable in the hands of Mr. Pankaj for 2020. For 2020. Next year, what is going to happen? This 3 lakh is going to fetch you an interest of 33,000. And this 33,000 is also going to be invested for an interest rate of 11%. Therefore, the answer becomes 3630. 3630. Agreed, not agreed? Yes. So if you notice this carefully, people, what is going to happen? The year 2 in 2021, I am assuming. Yes, so this is April 2020. So which means if I start from the top, people, if I start from the top, my 3 lakh rupees of investment is going to fetch 11% interest. So the number becomes 3,33,000 in 2021. Again, another 11% will become 369630 in 2022. Again 11% will become 410,289.3 in 2023, and another 11% will become 455,421 in 2024. Now in this, people, what is going to happen? 3 lakhs worth of investment is not going to be taxable. One second, I made a mistake here. So I'm going to take 3 lakhs plus 11% will give me the interest for 2021, plus 11% will give me interest for 2021-22, plus 11% will give me 22-23, plus 11% will give me 23-24, into 11% will give me the interest of that year. Yes, so 50,096 is the interest which Mrs. Pinky is going to earn that year. In this 50,000, people, if you notice, the original 3 lakh rupees, whatever interest is earned, will be taxable in the hands of Pankaj. Only accredited income has to be removed. So which means if I reduce 33,000 here, the answer should come as 17096, and that should be my answer. That should be my answer, which is not the case here, is it? Yes, let's check this once again. So I have 3 lakhs plus 11% is going to be taxable. So therefore that will become 2021, plus 11% is again going to be taxable. So that's 21-22, plus 11% is taxable. So 22-23, plus 11% is taxable. So 23-24, into 11% is 24-25. I reduce 33,000 in this, right? Yes, I reduce 33,000. I should get as 17096. Alright, I got the problem here in the question, people. This one is unfortunately not 1st April 2020. This is 1st April 2021. Yes, so that alone you need to change. This is 1st April 2021. Now, if you do this carefully with me, people, what is going to happen if the investment has happened on 1st April 2021? I take 3 lakhs on 1st April 21, add 11% for 21-22. Yes, then add 11% for 22-23, add another 11% for 23-24. Now I am in 24-25, so I don't want the accumulated amount, I want the interest amount. So I multiply with 11% on this, I get the answer as 45131.8. In this, the interest of Pankaj is going to be 33,000 because that's what his original investment is, and therefore the number becomes 1213.8, which is nothing but 12132. Yes, so this is what the right answer is. Option number B makes sense, which means you have to change this, people. It is not 1st April 2020, it is 1st April 2021. So please make that change. Next, Ram is owning 515% debentures of R Industries Limited of 500 rupees each. So he's having 500 each. Okay. Annual interest of 37,500 was payable on these debentures for 24-25. He transfers the interest income to his friend Shyam without transferring the ownership of these debentures. While filing the return of income, Shyam has shown 37,500 as his income from debentures. As a tax advisor of Shyam, do you agree to this statement? Now, people, this is the classic first rule of clubbing, that when you're transferring any income without transferring the corresponding asset, the income will be taxable in the original owner's hands, which means Shyam does not have to offer this income. Ram is the original taxable person for this income. So answer is going to be no. So first one says yes, so no. Second one says no, since Ram has not transferred the debentures to Shyam, interest income is not taxable in the hands of Shyam, it will be included in the hands of Ram. Yes, B looks right. B is the right answer. Yes, C says yes, so I'm going to ignore that off. D says no, since Shyam should have shown the interest income as interest received from Ram. No, there is no such concept like that, people. Clubbing provisions will apply accordingly. Yes, so B is the right answer. Question number 10. It says, Mrs. Bhavna is wife of Mr. Sonu and is a partner in a firm. Her capital contribution is 10 lakh rupees to the firm as on 31st March 2024, past assessment year. Included 6 lakhs contribution of gift from Sonu. So which means 6 lakhs is husband's contribution and 4 lakhs is her contribution. On 1st April 2024, she further invested 2 lakhs out of the gift received from Sonu. So Sonu is going to increase his investment. Sonu is going to make it 8 lakhs. The firm has paid an interest on capital of 1,20,000 and a share of profit of 1 lakh during the 24-25. Share of profit becomes exempt from tax. We already discussed this. Interest on capital is what we'll need to apportion accordingly. The entire interest can be allowed as deduction in the hands of the firm. What would be the statement? People, share of profit is going to be exempt. Looking at 1,20,000. 1,20,000 is going to be split on what ratio, people? You have 6 plus 2 here, 8. Yes, so it is 8 plus 4, which is 2:1 ratio. So 1,20,000 will get split as 2:1 ratio. So 1,20,000 divided by 3 into 2 will go to Shyam. Will go to husband. Will go to husband. Husband's is Sonu. So Sonu will get 80,000 rupees. Yes, husband will get 80,000 rupees and the 40,000 rupees will be in the hands of Bhavna. Yes, so the first one says share of profit is exempt. Yes, interest on capital is for the Bhavna. No. Second one says share of profit is exempt. 80,000 is for Sonu and 40,000 is for Bhavna. Yes, this is the right answer. So option number B is the right answer. We will take this into consideration. Yes, I think the questions are repeating itself, people, with different facts. Next, on 20th October 2024, P, who is minor child, gets a gift of 20 lakhs from a father's friend. On the same day, the amount is deposited as fixed deposit in P, whose bank. On the said deposit 30. I think this question is repeated, people. Yes, we saw the question just now with a different name, I guess. We saw Pia, now it's Pihu. So I think this is an easy answer, people. We've already done it. The question says default tax regime, so I'm taking it as option number D. I'm not discussing this question. Next, Mr. A is a member of his father, Mr. C's HUF, has converted his individual property into property of the HUF. If he converted the property subsequently partitioned among the members of the HUF, the income derived from such property as is received by Mrs. A. Now, people, partition of HUF clubbing provisions come and say that when a person gives an asset and later on the HUF is partitioned, whatever money is received by the wife will be taxable in the hands of husband. So Mrs. A will be clubbed in the hands of the husband. Therefore, the answer should become option number D. Yes, so option D is the right answer. Simple question. Great. We're moving on to case scenarios, people. Let's understand the case scenarios. Let's see what the question says. It says Mr. A has transferred a house property to his wife on 24/25 for inadequate consideration. People, transfer to spouse is a deemed ownership concept. She received a rent of 2 lakh rupees from letting out the property and has spent 4,800 as municipal taxes, deposited the same with the bank and has earned in 15,000 rupees worth of interest. Yes. Now what is going to happen? I'm going to take the house property first. Question says the income of the rent and interest will be chargeable to tax in the hands of whom? Now people, accretion is always taxable in the hands of the second person. It is not going to be taxable in the hands of original owner. So looking at the first person, people, what I'm going to do, 2 lakhs is my total rent. In that 4,800 is municipal taxes minus 30% standard deduction becomes 136,640. Deemed ownership concept will apply. So this 136,640 is going to be taxable in the hands of Mr. A, whereas the interest of 15,000 rupees will be taxable in the hands of wife. Yes, so the answer should be Mr. A 13640 and A 15,000. Option number D makes the right answer. Yes, so I take option number D as the right answer. This one was easy. Question number B. If Mrs. A invests the said amount in a business and has incurred a loss of 20,000 and she has income from other business of 4 lakh rupees, the income from the rent and the business will be chargeable to tax in whose hands? Now people, this rent is again an accretion. We have already discussed about accretion, so you cannot do anything about it. Accretion is going to be taxable in the hands of the second person only. Yes, so the whole what will happen if A is investing the rent amount and has incurred a loss of 20,000, this loss of 20,000 goes to Mrs. A. She has an income from other business of 4 lakhs, so which means I'll do a cross set off. So 3,80,000 will become the answer. Yes. What will be the income of the business and rent? Now rent is going to continue to be chargeable to tax in the hands of Mr. A only, people. No change in the rent answer. So therefore either option A looks like the right answer. Yes, option A says that I will still tax the rent in the hands of Mr. A. So therefore that is what becomes the right answer. 3.8 lakhs will become the taxable income in the hands of wife because no clubbing provisions will apply there. Third, if Mr. A transfers the above property for inadequate consideration with an agreement to live apart. Now people comes the problem. When the agreement to live apart takes place into consideration, deemed ownership will not apply and will be taxable in the hands of the subsequent owner, which means Mrs. A is going to be taxable for the incomes. In that case, what is going to happen? Mr. A will become nil. Answer is yes. Mrs. A will become 13640 for HP and 15,000 for IFRS. Yes, A looks like the right answer. I'm assuming they're not talking about question number B here, people. Question number B and C are independent scenarios is what I'm assuming, and therefore A becomes the right answer because D cannot be the right answer because there is an agreement to live apart. So there is no other alternatives here. Question number 14. It says Rajesh has gifted 15 lakh rupees to his wife Ravi on her birthday on 23rd February 2024. Ravi has lent 6 lakh rupees out of the gifted amount to Karuna on 1st April 24 for 6 months, on which she received an interest of 30,000. The said amount of 30,000 was thus invested in the shares of a listed company on 18th October 24, which was sold for 66,000 on 25th March. Securities transaction tax was paid on purchase and sale both. Balance amount of gift was invested on 1st April as capital by Ravi in a new business and has suffered a loss of 22,000 in the business in 24-25. Ravi is working in a private company as sales executive at a salary of 62,000 per month. She paid 3,500 rupees to her tuition fees for her daughter Ria studying in St. Thomas School, Mumbai. Rajesh is working with an MNC on a monthly salary of 64,000. He has gifted 1,25,000 to Ria. Ria is the minor daughter on her 13th birthday. The amount is deposited as 2 years term deposit with SBI Bank in her name, on which interest of 11,500 is earned during the year. Both Rajesh and Ravi want to pay tax under default tax regime. Yes, a lengthy question, people, but let's understand what the question requirements are. First one, in whose hands is the interest income received from Karuna and interest on fixed deposits in the hands of Ria will be taxable. Now people, when you look at Karuna, Karuna is getting money what? Karuna is getting 6 lakh rupees from Ravi from the first level of money which is given by Rajesh. So this money will be fully taxable in the hands of Rajesh. Yes, so Rajesh will take the hit on the Karuna's income. Now coming to the interest on fixed deposit by Ria, what is happening in Ria's case? Where is this Ria coming from? Yes, Ria is getting 1,25,000 on her birthday. The amount is deposited as 2 years term deposit with SBI in her name, on which interest of 11,500 is earned. People, Ria is a minor daughter. As a minor daughter, the income will not be taxable just like that in the hands of Rajesh or Ravi. It will be taxable in the hands of parent whose income is higher. So we'll need to find out whose income is higher. On the high level, people, if you come and ask me, noticing Ravi's income, Ravi is getting a salary of 62,000 per month and Rajesh is getting a salary of 64,000. So we'll need to still check on this. We cannot confirm this right now, which means this question goes on hold. This question goes on hold. Let's understand this. Next one, in whose hands loss from business and capital gains would be included for 25-26, assuming that the capital invested was entirely out of the funds gifted. Now people, when it comes to the loss from business, where is the loss from business coming from? She is getting a loss from business of the amount which was given by Rajesh, which means this 22,000 worth of loss will fully go to Rajesh. So that is what the answer would be. Coming to the capital gains, people, the capital gain says that they are getting a capital gains out of the interest income which they got from Karuna. So the said sum of 30,000 was invested in the listed company and they earned a capital gains, which means this income is going to be taxable in the hands of the wife Ravi and not in the hands of Rajesh, because this is second level income. Accretion of income will be taxable in the hands of wife and not in the hands of husband. So that is what we have to confirm. Both loss from business would be for Rajesh? No. Both loss from business would be from Ravi? No. Loss from business is for Rajesh and capital gains is for Ravi? Yes, this is the right answer. So C is the right answer here. C is the right answer here. Next, what would be the total income of Ravi and what would be the total income of Rajesh? People, to do this is what we need to compute the question. So let's put out the facts. Let's understand what is happening. I have two people. One is called as Rajesh. One is called as Ravi. Now looking at Rajesh, people, Rajesh is first getting a salary here. Rajesh is getting a salary of 62,000 into 12. No, Ravi is getting 62,000. Rajesh is getting 64,000. So if I'm taking Rajesh, 64,000 into 12 is the answer, but because it is salary, people, I'll get a standard deduction. So 75,000 is the standard deduction I'll get. So 6,93,000 for Rajesh. Coming to Ravi, 62,000 is her salary, into 12 minus 75,000, the number becomes 6,69,000. Correct? Yes, let's move on forward. Now let's look at the facts one by one, people. First one is that amount of gift of Karuna. Now Karuna gift has been taxed in the hands of Rajesh, so therefore I'm putting it as Karuna. Karuna is taxable in the hands of Rajesh. Next, there is a 30,000 of investment, 18th October 24, sold for 25th March 25. This is a short-term capital gains, 111A, people. Securities transaction tax is also paid off. Yes, so this is going to be taxable for Ravi. Yes, so how much is it? 66,000 is it? Yes, 66 minus 30, so therefore 36,000 becomes taxable for Ravi. Next, the balance amount was gifted as capital by Rajesh in the new business. The business has suffered a loss of 22,000. 22,000 of loss will go into Rajesh, people. Yes, now this is a PGBP loss. Normally a PGBP loss cannot be set off against salaries, but luckily I have IFOS income, so therefore I am going to set this off. There is no problem here in the set off part. What else? She has paid 3,500 towards tuition fees of her daughter studying in St. Thomas School, Mumbai. People, I don't care. Normally tuition fees is what I would have claimed as ATC deduction, but the question comes and says that the person is opting for default tax regime, and therefore this is not a relevant information. I don't care about this information. Next, Rajesh is working with MNC, 64,000. We have already taken that. Gifted 1,25,000. We have to take that. Amount is deposit for 2 years deposit, on which 11,500 is earned. Now people, this is what my facts is, so I can total the numbers and I can tell you where the total income is looking like. My total income for Rajesh is looking like 6,93,000 plus 30,000 minus 22,000. So therefore Rajesh gets 7,01,000 as his income. coming to Ravi. Ravi is 6,69,000 plus 36,000. Therefore, Ravi gets 7,05,000. People with this, now I know Ravi is having the higher income. With Ravi having the higher income, Ravi will be eligible. Ravi will be liable for the clubbing of the sons, the daughters or sons, whoever it is, Ria's income. So therefore, 11,500 will be taxable for Ria. Will be taxable for Ravi from Ria's income. So which means I can confirm the point of A also, people. Both income for Rajesh, no. Both income for Ravi, no. Interest income from Karuna for Ravi, and interest on 2 years deposit for Rajesh, no. Interest income from Karuna to be included for Rajesh, yes. Interest on 2 years to be included in the hands of Ravi. Ravi becomes the right answer. So therefore, option number D is the right answer. Yes, option D is my right answer. With this, people, I also now know my total income. So my total incomes are going to be what? My total incomes are going to be 7,01,000, and my total income here is going to be 7,05,000 plus 11,500. Therefore, 7,16,500. Yes. So for Ravi, it's going to be 7,16,500, which is option number A, and for Rajesh, it's going to be 7,01,000, which is option number D. That's it, people. I think that's what your set of chapter, your clubbing chapter looks like. I think clubbing questions were interesting, but some questions got repeated. Nevertheless, we have discussed clubbing also carefully, people. One of the most important chapters, if you ask me, from a clubbing provisions. And honestly, if you come and ask my suggestion, I don't recommend clubbing coming in as MCQ questions. Clubbing as MCQs normally are very tricky, people, because you can have issues like this. Yes. So these kind of issues is what I normally like to avoid when it comes to clubbing, and therefore clubbing is best asked in the 6-mark question rather than asked in a MCQ question. But nevertheless, since we've already discussed it right now, I think you're fairly equipped with clubbing provisions also. If you have any doubts, feel free to drop in a comment and we can discuss about this. But other than that, yes, let's close with clubbing, people. We're moving on forward. We have a couple of chapters alone pending. So let's quickly do that in the upcoming videos. Please watch out for the upcoming videos and we'll close this MCQ guide series together. Yes, thank you everyone. Have a great learning. We'll see you all in the next videos. Take care. Bye-bye. Hey boys, welcome back. So yes, let's continue with our discussion on chapter number 9. We are today discussing the MCQ guide series of set off and carry forward of losses. Yes, I think the fairly questions in this are very, very easy. There is not much to be discussing. So therefore, let's quickly close this off. We should be able to close this in a matter of 10 minutes. Yes, let's do it off. Question number 1. It says A Limited has unabsorbed depreciation of 4,50,000 for previous year 24-25. Okay, this can be carried forward for what? People, unabsorbed depreciation rule says what? You can carry forward for infinite years, and in the future years also you can set off in the same terms as how PGBP can be set off in the current year. Yes, so can be carried forward for a maximum period of 8 years? No. Can be carried forward for indefinite period, set off against business income? No. Can be set off against indefinite and set off against any head of income? No. Can be set off against any head of income other than salaries is the right answer. So this becomes option number D. Easy question. Next, Mr. Raj has incurred short-term capital loss of 10,000 rupees on sale of shares through the National Stock Exchange. People, have a short-term capital loss. Short-term capital loss rules basically come and say that when you have a short-term capital loss, you can set off against any capital gains. Yes. So this can be set off against what? Can be set off only against short-term capital gains? No. Can be set off against both short-term and long-term capital gains? Yes. This becomes the right answer. Can be set off against any head of income is not the answer. Cannot be allowed to be set off is also not the answer. Option B becomes the right answer. Yes, great. Question number 3. Mr. X has brought forward loss of house property of 3,10,000 for 24-25 while filing return of income under the normal provisions of 25-26. Up to what extent he can set off these brought forward losses against house property? People, understand there is a restriction of rupees 2 lakhs only in the latest year in which the loss happens. If the loss is getting carried forward in the future years, there is no restriction because you're anyway going to set off only against HP income. So can I have a restriction on this? Answer is no. I don't have a restriction. I can set off the whole 3,10,000 worth of losses in the future years. Notice, for HP, you can only set off against other heads of income up to a maximum of 2 lakhs, but that only applies in the year in which you make the loss. This is a future carry forward year and therefore there is no such restriction. Question number 4. It says Mr. Rohan has incurred a loss of 3 lakh rupees in 24-25 for retail trade business. Against which of the following incomes during the same year can he set off during the same year is what is asked, people. Yes, focus the fact that they are asking for the same year. In the current year, what is happening? He has a loss of 3 lakh rupees in retail trade business. Now, retail trade business is a normal business. So, any normal business loss can be set off against what? It can be set off against normal business income, any other head of income other than salaries, and then you can carry forward for setting off against business incomes for 8 years. Can I set off against 1 lakh for wholesale clay business? Yes. Can I set off against long-term capital gains on sale of land? Yes. Can I set off against speculative business income? Also answer is yes, and therefore answer becomes option number D. Yes, yes, this is where most of the people end up going wrong, people, because what you will imagine is it says speculative business loss, speculative business income. You will say, no, how can you set off against speculative business income? Understand, people, the restriction is on speculative business loss. It is not on PGBP loss. PGBP loss can be set off against any income. Speculative business loss has a restriction to set off against other heads of income. So please bear mind in that. Yes, question number 5. Mr. Ravi has incurred a loss of 4 lakh rupees in 24-25 in leather business. Against which of the following incomes earned in the same year can he set off such losses? People, 4 lakhs worth of losses in leather business, normal business loss. Profit of 1 lakh from apparel business is my current PGBP income. Long-term capital gains of 2 lakhs from sale of jewelry is also my current year income. Salary income of 1 lakh rupees. People, you know carefully that salary income you cannot set off. So which means you have profit and you have long-term capital gains. Now in the profit and the long-term capital gains, what is the order of priority? We have always discussed that the order of priority is always do intra-head first. Between the heads happen first and then you go to the next head of incomes. So the answer would be option 1, option 2 and then no option 3. Let's check. It says first set off with option 2. No, this is not the right answer. Next it says first set off from option 1, then 2 and 3. No, not the right answer. First set off against option 1, then go to option 3. No. Then it says 1 to 2 remaining loss has to be carried forward. Answer is yes. Answer is yes, because you cannot set off against salaries. Whatever excess you have, you can carry forward. Yes, simple question. Question number 6. It says Virat is running a business of manufacturing of shoes since 22-23. During the previous year 22-23 and 23-24, Virat has incurred a business loss. He also has an unabsorbed depreciation. For the 24-25, he has earned a business profit of 3 lakh rupees. Considering he may or may not have sufficient business income to set off his earlier losses and unabsorbed depreciation, what is the order of set off? Now people, here is where the logic comes of how do you do it better. Yes, you need to understand carefully that when it comes to business loss, when you carry forward, there is a restriction of 8 years. But when it comes to unabsorbed depreciation, there is no such restriction. And therefore, a person in a right mindset would first like to set off all his business losses and then take his unabsorbed depreciation into picture. So let's keep that thought in mind. Now, in business losses also, people, there are 22-23 and 23-24. So if you understand carefully, 22-23 will go for 8 years and 23-24 will go for 8 years from 23-24, which means the order of priority should be to first set off the 22-23 business loss, then set off 23-24 business loss, and then check for unabsorbed depreciation no matter how old that is. Keep that thought in mind. It says first adjustment of loss for 22-23, yes, then loss of 23-24, then unabsorbed depreciation. People, this itself becomes the right answer. I don't need to go forward. Yes, I don't need to go forward. This becomes the right answer. The next one says first set of 23-24, definitely not happening. Then says first set of unabsorbed depreciation, no. Then it says first set of unabsorbed depreciation, no. People, we are setting off the normal 22-23 business loss first, then normal 23-24 business loss, and then we are going for unabsorbed depreciations. Clear? Yes, sweet. Question number 7. Question number 7 says, during the assessment year 25-26, Mr. Kabir has a loss of 6 lakh rupees from the head income from house property, loss of 5 lakh rupees from business incomes, and 3 lakh rupees from long-term capital gains. The person has filed his return of income for 25-26 on 31st December 25. Determine the total income of Kabir for 25-26 and the amount of loss which he can carry forward. People, one thing which I am noticing is the person is filing his return of income late. Yes, because he is filing his return of income late, you need to come and tell him what to do. Determine the total income of Kabir for 25-26 and the amount of loss that can be carried forward in the manner most beneficial to him. First of all, you need to keep in mind, people, is that when a return is filed late, any losses other than HP and unabsorbed depreciation will not be carried forward. So which means one thing I know is my loss of business and my loss of long-term capital gains is gone. My loss of business and my loss of capital gains is gone. The only left off loss for me is HP loss. Now, in this HP loss also, people, the problem here is in this question, they have not come and mentioned what regime are you choosing, which means you may either choose DTR or you may choose ATR. Now, why am I referring this, people? Because when it comes to DTR or default tax regime, the rules of default tax regime come and say that HP losses should only be set off in the current year. Any HP losses which does not be set off cannot be carried forward. Yes, and therefore there is a particular problem here. If the person goes for DTR, then HP loss is also lapsed, but if he chooses for ATR, then he can still carry forward the losses. So which means we'll have to go by options to check what is the right answer. Let's go by options. Total income is nil and loss of 4 lakh rupees can be carried forward? No. Total income is 1 lakh, loss of 4 lakhs can be carried forward? No. 1 second, people, let me check. Loss is 6 lakh rupees, loss of 5 lakh rupees, and 3 lakh is long-term capital gains. Okay, so 3 lakhs is an income, people. Okay, this is what I am seeing, right? No, am I seeing 3 lakh ka income? It says during the assessment year 25-26, Kabir has a loss of 6 lakh rupees from HP, loss of 5 lakh rupees from PGBP, and income of 3 lakh rupees from long term capital gains. Yes, that is what is happening. Yes, so you have a long term capital gains. This is what is happening, people. So therefore, what is going to happen is that you are going to look at that carefully. So first case is total income of nil. No, because the loss of 4 lakh rupees is being carried forward, and loss of 4 lakh rupees is carried forward for business. I cannot carry forward business loss, so therefore that is wrong. Next one says total income is 1 lakh rupees, loss of 4 lakh rupees will be carried forward. Now, ideally, if you're going for ATR, people, this is what would have been the right answer. I would say this is the right answer if you're opting for ATR provisions. Yes, because in ATR provisions, what will happen? You can set off against other heads to the less of 2 lakh rupees, and then balance will get carried forward. So that would be the right answer if you're choosing for ATR. Third one says total income is nil and no loss will be allowed to be carried forward. Now, people, if you're going for DTR rules will basically come and say that you DTR rules will basically come and say that you cannot set off against any other income, which means if you're not able to set off against any other head of income, HP loss will not be able to set off anywhere, and then that will be permanently lapsed. So that would have been the right answer for option number C. But then the weird thing is, why are they saying total income is nil here? Oh, they're saying total income is nil because what will happen is business loss can still be set off against long-term capital gains in the current year, right or not? Yes. So you will be able to set off a business loss against your long-term capital gains, which means 5 lakhs will get set off against 3 lakh rupees. Left off is nothing. Left off is nothing because the 2 lakhs worth of business loss will not be carried forward. So I will set off the 5 lakhs against 3 lakhs. The remaining 2 lakhs will lapse off. The HP loss cannot be set off against anything under DTR regime. So which means total income will become nil. No loss will be carried forward. This will happen in case of DTR. This will happen in case of DTR. And the last one says total income is nil, loss of 6 lakhs will be carried forward. No, I cannot carry forward any such losses of HP. Yes, which means people, option number B relies to ATR and option number C relies to DTR. Now, if you notice the answer they given us option number C. This is something which I've been telling in multiple occasions, people, in many of the videos which I've shot in the earlier past also, that when it comes to returns which are filed late, unless the question comes and clearly mentions that you have to go for ATR, the understanding is you are only going for DTR. The reason is because when you are not filing a return on time, you have not sufficiently filled your forms. If you have not sufficiently filled your forms, you are not permitted to go for ATR because it is required that you have to fill your forms before the due date of return filing in order to opt for ATR regime. Because you have not filled your forms on time, you cannot go for ATR, you can only go for DTR. That is why option number C becomes the right answer. That is why option number C becomes the right answer. Now here is the catch point. Even though the question comes and says you have to do it in the manner most beneficial to him, there is only one option left, which is DTR, because I have not filed my returns on time. So there is no such beneficial option for you as such, people, because DTR is the only option for you. Yes, that is why option number C becomes the right answer. Please mark this one as an important question. This is what has been, this is what got tested in September 24 multiple times, and since then has not been tested. So upcoming exams can have a huge probability on this. ICAI is loving to test all these adjustments, so please pay attention. Great. Question number 8, people. It says, according to section number 80, no loss which has been determined in pursuance of a return filed in accordance with 139.3 can be carried forward. People, 139.3 is nothing but belated return. Yes, so 139.3 is called as belated return. In simple words, you have filed your return late. Keeping that thought in mind, people, what is going to happen is the question. The question says the exception to this rule are what? If you have filed your return late, what and all can you not carry forward? What and all can you carry forward? You can only carry forward HP loss. You can only carry forward unabsorbed depreciation. Yes, so can you carry forward specified business? No. Can you carry forward capital gains? No. Can you carry forward HP loss and unabsorbed depreciation? Yes. You can make this carry forward. Option number D does not make sense because it's a speculative business. That is also not happening. Easy. Great. Question number 9, people. It says, during the assessment year 24-25, your previous assessment year, Mr. A, exercising the option of shifting out of default tax regime opted under 115 BAC 1A, alternate regime is going for, has a loss of 8 lakh rupees under the head house property, which he could not set off against any other head of income as per the provisions of section 71. The due date of filing of return of income in case of Mr. A has already expired, and Mr. A has forgot to file his return within the said due date. However, Mr. A has filed his belated return for assessment year 24-25. Now, filing his return of income in 25-26, Mr. A wishes to set off such HP losses for 24-25. His income for the house property computed in 24-25 is 5 lakh rupees and interest on bank deposit is 1 lakh rupee. Same question is repeating itself, people. The difference is that now they're saying past year I did not file my return on time, but I still have a HP loss which I'm proposing to carry forward. Now, this could have been done only because you're opting for ATR, people. The question itself clearly comes and says that the person is opting for ATR. Here you don't come and tell me, no, Rahul, the return is filed late, so it should become DTR. No. When the question explicitly mentions that they're going for DTR, it means they're going for DTR. Can they carry forward? Yes, they can carry forward. With the carry forward rules coming into picture, people, I have 8 lakhs worth of HP losses. I have 5 lakhs worth of HP income. Can I set off? Yes. No restriction on 2 lakhs because it is intra-head adjustment. So this full 5 lakh rupees will get adjusted off. Now I have interest on bank deposit. Can I set off against 1 lakh rupee? No, I cannot set off against 1 lakh rupee because this is part of IFOS. It is not part of HP, which means my final answer will be my current year income will be 1 lakh rupee, and I will carry forward the balance HP losses of 3 lakh rupees after setting off against 5 lakh rupees. That is what should be the right answer. So first one says no, Mr. A cannot claim set off of 8 lakhs. No. Second one says yes, Mr. A can claim set off of 2 lakh rupees. People, no such restriction. Third, yes, Mr. A can claim a set off of 2 lakh rupees. Again, no such restriction. Fourth says Mr. A can claim set off of 5 lakh rupees for 25-26 as income for 5 lakh rupees from HP property. Balance loss of 3 lakhs will be carried forward. Yes, this becomes the right answer. This becomes my right answer. So option number D is the right answer. Yes, this one was fairly an easy one, people. Yes, if you have paid attention to your provisions properly, you should be able to answer this question. Yes, working pen. Good enough. Question number 10. Look at question number 10, people. This looks like a full-fledged question, so let's pay attention to it. It says, the details of loss and income of Mr. Kumar is given to you. Now, people, when it comes to HP related questions in a full-fledged manner itself, I have come and told you, always when you get a question like this, forget all the incomes. Start from the loss perspective, because loss will give you more better understandings. So I'm going to ignore all my incomes and I'm going to take from loss and I'm going to see what the answer comes to. Pay attention. First one says income from salary computed, ignored. Next says loss from self-occupied property, 95,000. People, this is a loss from HP, so I'm going to hold back on this. First of all, let's look at the question. The question says, what shall be the gross total income of Mr. Kumar for 25-26, assuming he exercises the option of shifting out of default regime, meaning the person is going for ATR, HP losses is permitted to me. So I have a loss from SOP, which I can use. Then I have a loss from LOP also. So this is 2 losses which I have. Then I have specified business loss of 2,80,000. People, specified business losses can only be set off against specified business income. Do I see any specified business income in this question? No, which means this is going to get carry forward. This is going to get carry forward. Next, I have loss from medical business. People, my normal business loss. So this is perfectly fine. I can keep this. Then I have a long-term capital gains of 1,60,000. Okay. And I have an income from other sources of 80,000. Let's take it one by one, people. The first one on the top, I have an HP loss. If you notice, I have 2 HP losses, one from SOP and one from LOP. At the end of the day, there is no HP income, and therefore I can use this losses. In the matter of priority, people, I always say HP losses is best to set off against salaries first, because salaries is the only one which has no set off other than HPs for you. Yes, and therefore I would set off HP against salaries to the extent of rupees 2 lakhs. 2 lakhs will get adjusted there, balance will get carried forward. So if I'm noticing this, people, 2,25,000 is my losses plus 90,000 is my losses. So 3,15,000 is my losses, in which 2 lakhs I am setting off, and therefore 1,15,000 I'm going to carry forward. Yes, now although this question is not asking me for the carry forward and all, I'm doing it as a full-fledged question so that you're able to practice it along with me. Now, what is left of, people? Salaries is now eliminated, and salaries now become taxable for 3,20,000. Agreed? Yes. Next, move forward. I have a loss from specified business, which I told I'm carrying forward. I have a medical business loss, people. Medical business loss can be set off against any head other than salaries. So salaries I'm already adjusted off. I am left off with this loss. I can set this off against either capital gains or IFOS. Matter of priority, you can do anything you want, people. Let me set off against capital gains. If I'm setting this off against capital gains, this is eliminated off, and my capital gains now becomes 40,000 rupees. After that, I have only income from other sources, no other restrictions, no other set-offs permitted, and therefore this becomes full 80,000 rupees, and therefore my answer should be 4,40,000. Yes, my answer should be 4,40,000. 3,20,000 plus 40 plus 80 will become 4,40,000, which is option number A. Yes, so which means if you know how to use your losses properly, people, you'll be able to always get the right answer. So please pay attention to that part of it. Great. MTP number 3 question, last question for your last question for your chapter. It says, Mr. Arpan, age 35 years, is submitting the following particulars for computing his total income. Again, people, I'm looking at the question. The question says, compute the total income of Arpan for 25-26 and the amount of loss that I can carry forward for subsequent years under normal provisions of the Act. Normal provisions in all practical sense would mean you're using ATR provisions, people. ATR provisions, income from salary is given to you. I'm going to ignore it. Loss from let out properties 2,20,000. ATR provisions will permit you to set off this against salaries to the extent of rupees 2 lakhs. So I'm going to use this. I'm going to set off against rupees 2 lakhs, which means my taxable salary is going to be 2 lakh rupees. My taxable salary is going to be 2 lakh rupees. My carry forward loss, people, here is going to be 20,000 rupees because I am not able to set this off. I'm not able to set this off. Next, it says brought forward loss from let out property in 24-25. People, past year HP losses cannot be set off against any other head of income other than HP. Current year I'm seeing no HP income and therefore this gets fully carried forward. So 2,30,000 of HP loss will get fully carried forward. Now, here comes the $1 million question. Rahul, I have HP losses of 24-25. I have current year HP loss also. Can I first set off 24-25 and then do the current year HP loss? No. People, rules are very clear. First, always intra-head, then always inter-head, and then you bring the past year losses. So, unless you have completed all the adjustments of current year, past year will not be used off. Past year will not be used off. So, 24-25 will remain as it is. You cannot use that first. You have to use the HP loss first. Next, I have a business loss of 1 lakh rupee. I have a bank interest of 80,000. Now, people, business loss can be set off against bank interest, but not against salary. So, therefore, no problem. I can set this off here. I will have a carry forward of 20,000 rupees in my business, and my HP, my IFOS becomes 0. With my IFOS becoming 0, there is only one income which is taxable for me, which is rupees 2 lakhs. So, 2 lakhs becomes my taxable income in the current year. Great. Option number A says total income of 2 lakhs will be there. Loss from house property will be 2,50,000. Yes. Business loss will be 20,000, which will be carry forward. Yes. Option A becomes the right answer. Option A becomes the right answer. I don't need to go forward because the next one says 1,60,000, the next one says 4 lakhs, and the next one says nil. None of these is right answer. Option A becomes the right answer. Yes, yes. So HP people, when it comes to losses, people, the one important critical part is to do these kind of full-fledged questions, because here is where you're able to use your head carefully. If you're able to solve these complex questions, technically the HP loss does not have, the losses chapter does not have much to be discussed upon. Yes, so please pay attention to these kind of questions, people, because here is where the whole change happens. The thumb rule which is always there when it comes to losses is always look from the loss perspective. If you look from the loss perspective properly, you will always get the right answer. Do not jump the gun and start looking from income perspective. You will 99% end up going wrong there. Are we clear? Yes, awesome. This was all that was there for losses chapter, people. I don't think I have anything much to discuss in chapter number 9. I think this was. Yes, we are almost nearing the closure. 9 is done. So we have 10, 11, 12. That's all. After that, we have comprehensive questions. So therefore, there is not much to be discussing upon. I'll be quickly closing the balance chapters as well, people. I hope you're already enjoying what is happening in the MCQ guide, and this is already giving you insights on how ICAI is testing you in exams. So yes, please pay attention to this MCQ guide while you're also doing your concept guide, your cheat sheets, your solutions guys, and everything else. Yes, I'm pretty sure September exams and the upcoming January exams will be really nice if you pay this little bit of an attention and little bit of a discipline in your studies. So please continue all your preparations accordingly, people. Let me come back very soon with the balance videos, and we will close everything off as much as possible. Thank you, everyone. Have a very nice day. We will see you all in the next videos. Until then, take care. Bye. Hey boys, welcome back to the MCQ series. Today we're discussing chapter number 10, deductions, chapter 6 deductions, one of the most important chapters when it comes to your total income questions, your MCQ questions as well. ICAI makes really good questions when it comes to your MCQ series, at least when it comes to chapter 6 deductions. I've compiled them all and I've brought it up to you today. Let's discuss these questions. Let's see what kind of questions ICAI has been testing you in the past and how you can prepare for your upcoming exams. Yes, great. Let's start. Question number 1 of chapter 6 deductions basically says, an individual has paid life insurance premium of rupees 25,000 during the previous year for a policy of rupees 1 lakh which was taken on 1st April 2019. If he pays tax under default tax regime, what can he do? People, it's very simple. The moment you're going for default tax regime, I'm not even reading the rules. The rules of default tax regime say that when it comes to chapter 6 reductions, the whole chapter 6 reductions except for 80JJAA, 80CCD subsection 2 part of employer's contribution and 80CCH part 2, which is part of government's contribution, is only allowed as deduction. Everything else is denied as a deduction. 80C becomes straightforward denied as a deduction. You cannot claim it as a deduction. Yes, you cannot claim it as a deduction. So option number A is the right answer here. Option number A is the right answer here. Fairly simple, straightforward question. I hope these kind of questions come in exam. Makes it life easier. Yes, great. Mr. Srivatsav, age 72 years. People 72 years, automatically the person becomes a senior citizen. Has paid medical insurance premium of rupees 52,000 by check and 4,000 rupees by cash during May 2024 under a medical insurance scheme of General Insurance Corporation. Now, people, if you notice, when it comes to 80D, the rules come and say that when it comes to 80D, only preventive health checkup can be paid by cash. Any other items being paid by cash will not be allowed as deduction, which means this 4,000 rupees gets denied outright. Yes, so 4,000 rupees gets denied outright. You can't claim this as a deduction. That leaves you with only 52,000 rupees. Now, as a senior citizen, you are eligible to claim only a maximum of 50,000 rupees. So that itself was fairly sufficient. We could have gone with that. Thus, above sum was paid for insurance of his own health. Great enough. If you exercise the option of shifting out of default tax regime, what would be entitled for? People, alternate regime gives you 80D benefits. 4,000 is ignored, 52,000 is taken. In that 52,000, I can only claim 50,000. Therefore, the answer becomes option number B. Therefore, the answer becomes option number B. Fairly an easy question, people. Imagine even if a case you would have ignored that 4,000 rupees and taken it as a deduction, you would be aware about the fact that you can only claim 50,000 as a maximum deduction. So, nevertheless, you would have got the right answer. But here is ICA's trick to play. Assuming that 52,000 was only like 38,000, you might have made a mistake. You cannot do that. You cannot do that. So, please pay attention to the fact that only cash in preventive health checkup is permitted as a deduction. Cash any other ways is not allowed as deduction. Question number 3. It says Rohit is a resident Indian and has incurred 15,000 rupees for medical treatment of his dependent brother, who is a person with severe disability. People, severe disability means more than 80% and has deposited 20,000 rupees with LIC for his maintenance. Now, people, if you have a severe disability maintenance and you're depositing even 1 rupee for the purpose of the disabled person, you are eligible to claim 75,000 rupees if it's a normal disability and 1,25,000 rupees in case of severe disability as a flat deduction. Yes, if you notice, it says Rohit shifts out a default tax regime. I only have one thing. I can straightforward claim my full 1,25,000 as deduction because the person has gone for severe disability. Yes, easy question. Question number 4. Question number 4 says gross total income of Arpita is given as 6 lakh rupees. The person has taken a loan for 7,20,000 in 21-22 for bank for pursuing her MBA course in IIM Kolkata. On 2nd April 2024, she paid the first installment of loan of 45,000 and interest of 65,000. You're required to compute a total income if she exercises the option of shifting out of default tax regime. People, this is educational loan taken. ATE comes into picture. ATE rules basically come and say that when it comes to educational institution, you can only claim the interest component as a deduction. You cannot claim any other item as deduction. The principal payment is not allowed as deduction. In my case, my interest is 65,000 people. So 65,000 is what I'll claim as deduction. So 6,50,000 minus 65,000 is my deduction, and therefore the answer becomes 5,85,000. That is what the right answer is. That is what the right answer is. What exactly is the issue here? I'm sorry. 6 lakhs minus 65,000. The answer should come 5 lakh. Oh, sorry. Yeah, my calculation error. Therefore, it is 5,35,000. Yes, 5,35,000 is the answer. Take 6 lakhs, remove the 65,000. That is what the answer would go. Next, Mr. Shiva has made a donation of 50,000 to PM Cares Fund. People, PM Cares Fund is eligible for category number A, which is 100% deduction without any qualifying limits. 20,000 to PM Drought Relief Fund, that is eligible for category B, which is 50% without any qualifying limits. The person has also made a cash donation of 10,000 rupees to Public Charitable Trust, category number T, 50% with qualifying limits. If Shiva has exercised the option of shifting out of default tax regime, what can he be claiming as a deduction? Now, people, PM Cares Fund gets full 50,000 rupees. 20,000 becomes restricted to 10,000 rupees. The 10,000 rupees of cash donation has been made, people. Cash donation is not allowed as deduction. So, which means this becomes 0. This becomes 0. You cannot make any cash donations more than 2,000 rupees. You've made 10,000 rupees worth of cash donation. This is straightforward out as 0. You cannot claim it as a deduction itself. So this is gone. Then if Shiva has exercised the option of shifting out of default regime, what will be the answer? So it is 50 plus 10, 60,000. Therefore option C becomes the right answer. Option C becomes the right answer. Yes, yes, yes. Here, this was an interesting question, people. An easy question. You could have not made a mistake except for the fact that you would have ignored the cash part of it. So please pay attention to the fact that cash cannot be claimed as a deduction. Next, question number 6 says, Ramesh is paying a rent of 5,000 rupees per month. His total income is 2,80,000. That is gross total income as reduced by chapter 6A except for 80GG. He's also in receipt of HRA people. If he exercises the option of shifting out of default tax regime, what would be eligible to claim for? People, 80GG rules has multiple restrictions. One of the restrictions is that you should not be receiving HRA ever. If you're receiving HRA, then 80GG deduction itself is denied to you, which means option D becomes the right answer here. Option D becomes the right answer here. You could not have claimed anything under 80GG when you're already claiming HRA deductions. Yes. Question number 7. It says, Mr. Krishna is a resident Indian and is aged 61 years. 61 years, okay. The person is maintaining a savings account with Cooperative Land Development Bank and has earned 20,000 rupees as interest on savings account for 24-25. Mr. Krishna is also maintaining a fixed deposit and a recurring deposit with Money Bank, non-banking finance company, and has earned 25,000 and 10,000 rupees respectively. As interest on deposit and recurring deposit. What would be the deduction allowable to Mr. Krishna if he exercises the option of shifting out of default tax regime? Yes, now people, this is talking about section 80 TTB. This is talking about section 80 TTB. 80 TTB comes and says that when a senior citizen is having any kind of interest from savings or interest from FTs or interest from RDs, you can claim that deduction up to 50,000 rupees. However, please notice that this section says that you can only claim interest on scheduled bank interests. You can only claim interest from scheduled bank or post office savings. In this question, if I notice, I am getting an interest from Cooperative Land Development Bank, which is right. That can be claimed as a deduction, no issues here. But the next 25,000 and 10,000 rupees, which I'm getting, people, is coming from something called as non-banking finance company, which is an NBFCs. Can you claim any deduction of interest from NBFCs? No. You cannot claim any deductions, which means 25,000 is getting ignored, 10,000 is getting ignored. I am only left with 20,000 worth of interest. I was eligible up to 50,000, but I've only earned 20,000 rupees worth of interest, so I can only claim 20,000 rupees as deduction. Therefore, it becomes option number C. Therefore, it becomes option number C. Yes, yes, clear, sweet. Question number 8. It says, Mr. Suhan is aged 35 years and is a non-resident earning in dividend income of 12,50,000 from an Indian company, which was declared on 30th September 24 and credited to his bank account on 5th October 24 in France, and an interest and savings of 15,000 rupees from State Bank of India for 24-25. People, I am a non-resident. A non-resident has received a dividend income of 12,50,000 from an Indian company. The moment any income is coming from an Indian company, that is already deemed to accrue or arise in India. It doesn't matter that the money is credited in France directly, that is of no relevance, which means 12,50,000 is going to become taxable in India. Next comes the 15,000 rupees, which is interest on savings account. For this, people, I can claim a deduction of 80 TTA. Yes, so an 80 TTA deduction can be claimed. Assuming that he has no other income, what will be the amount of income chargeable to tax in his hands if he exercises the option of shifting out of default regime? I will simply take the 12,50,000. I will add the 15,000 worth of interest, and I will claim 10,000 worth of deduction. The answer should be 12,55,000. That is option number D. That is option number D. This one was easy question, people. Here is a small hint. If you notice, in this options, you did not even have an option without 12,50,000 is the case. Without 12,50,000 as the case, because even if it is 15,000 rupees, you would have claimed only 10,000 rupees, so 5,000 rupees would have still remained, which means any case you would indirectly itself know that 12,50,000 should have been taxable. The only thing which you probably will end up making a mistake is, people, you may have forgotten to claim the 80 TTA, which ideally you should not do, because interest on savings is a common deduction. So interest on savings worth of 10,000 of deduction is an important deduction which you need to keep in mind. So option D is the only right answer which you can get in this. Clear? Sweet. Question number 9. Question number 9 basically says, Mr. Arpit is an employee of MNO Limited and has contributed 1,61,280 towards NPS, and similar amount has been contributed by his employer. Employer is also contributing, employee is also contributing. His basic salary is 80,000 and his dearness allowance 40% of which is forming part of retirement benefits. He's also paid 55,000 towards life insurance premium for himself, his wife, and medical insurance premium of 35,000 towards cross check for his mother being a senior citizen. How much deduction available under chapter 6A while computing total income of Arpit if he exercises the option of shifting out of default regime? Now this will need a computation, people. So let's first put out what exactly is happening here. This person has received multiple components. I am first of all going to ignore the 80 CCD, people. Let's complete the balance of. So I have an 80C. This person has got an 80C deduction of what? He's paid a life insurance premium of 55,000 for his wife and himself. So therefore 55,000 worth of deduction, 80C eligible. Agreed? Yes. And then I'm moving to something called as 80 CCD. In 80 CCD, people, I have multiple deductions. Deduction number 1 for myself. In that self also, people, there is a flat 50,000 worth of deduction for any contribution you make on your behalf without any restriction. Let's look at the balance. What exactly have I contributed? I've contributed 1,61,280 for the total contribution. Now in this, I am coming and saying I can only claim 10% of my basic salary plus DNS allowance as a deduction. So if you notice, people, my salary is 80,000 rupees per month. Yes, so I have 80,000 rupees per month. So into 12 will give me my answer as 9,60,000 plus another 40% is the number. So therefore I get 9,60,000. So 80,000 into 12 is giving me 9,60,000 plus 40% of deduction. I get 13,44,000. In this 13,44,000, I can maximum claim a deduction of 10%, which is 1,34,400. Now, if you notice, I have contributed 1,61,280, but in that 1,61,280, 50,000 is already claimed as deduction. So, which means I am left with only 1,11,280. Now, I was eligible to claim 1,11,280 and I have claimed I have eligibility of 1,34,400. So, can I claim the whole 1,34,400? Yes. I can claim the whole 1,34,400. Yes or no? Yes or no? No. Here is where you'll end up making a mistake, people. Section 80 CCE now comes into picture. Section 80 CCE basically comes and says for 80C, 80 CCC and 80 CCD subsection 1, which is the self contribution of 10%, there can be a maximum restriction of only 1,50,000. If you notice, I've already claimed in 80C 55,000, which means this will now get restricted to 95,000. This will now get restricted to 95,000 because overall itself I can only claim 1,50,000 as a deduction. Are you with me till here? Yes or no? Yes, this is what will happen. Now comes the next part of employer's contribution. Now, employer's contribution, people, has no restriction except for one, that you can claim only 10% of the contribution as deduction. So 10% of the salary which I have, 10% of salary has become 1,34,400. Employer has contributed 1,61,280. So I will claim the whole 1,34,400 as a deduction. 1,34,400 as a deduction, which means what do I have right now with me? I have an 80 CCE of 1,50,000, self contribution of 50,000 and an employer contribution of 1,34,400. What else has this person done? This person has also made a medical insurance premium of 35,000 by cross check for his mother. People, mother who is a senior citizen, cross check payment, you can claim up to 50,000 rupees. He has paid only 35,000 rupees, so I can claim the whole 35,000 as a deduction. Yes, so this whole 35,000 also becomes eligible for deduction. So therefore, I have 4 deductions. Do I have any interest in this question? No, I don't have any interest in this question, which means this becomes my right answer. And therefore, I'll take the number as it is. So it is 1,50,000 plus 50, 2 lakhs plus 1,34,400 plus 35,000 as my answer. So it is 2 lakhs plus 1,34,400 plus 35,000 as the answer, which becomes 3,69,400 rupees. 3,69,400 is my answer. That is option number B. That is option number B. Yes, an interesting question, people. The only thing which you could have probably gone wrong is the fact that when it comes to employees' contribution, you should have added that to your ATC to check for an overall limit of 1,50,000. Keep that one thought in mind. Question number 10. It says Roshni Limited has 2 units, one in SEZ and another unit is in DTA. People were looking at 10 AA as a deduction. The unit set up in SEZ and has started manufacturing from 12th May 2015 and the unit in DTA has started manufacturing from 15th June 2018. People, I am not bothered about DTA. I am only bothered about SEZ. SEZ has started in 2015, so which means I'll take 15, 16, 16, 17, 17, 18, 18, 19, 19, 20, 20, 21, 21, 22, 22, 23, 23, 24, 24, 25 is my 10th year of operations. I am at 50% deduction. The total turnover of Roshni Limited and unit in DTA is given as 12 crore 50 lakhs and 4 crore 50 lakhs. People, notice carefully. I have given you the data for Roshni Limited and I have given you the data for DTA. SEZ is nothing but the total minus this number. Yes, so they're trying to confuse you with saying that I am not giving you SEZ data. People, you can find it out. The total entities data is given to you, the Roshni Limited's data is given and the DTA Limited data is given. If you remove both, you'll get the SEZ data. In simple words, 12 crore 50 minus 4 crore 50 will be 8 lakh rupees. So 8 lakh rupees becomes your total turnover. Yes, so I can come and say my TTO is rupees 8 crores. is rupees 8 crores. Then export sales is given for SEZ and DTA. Now people have SEZ given directly to you. So I've given directly SEZ to you, which is 3.5 crores. Correct? Yes, great. The net profit also is given for SEZ directly, which is 95 lakhs. So 95 lakhs is my net profit of SEZ unit. Quite. What else is there? Out of the export sales of 3.5 crores, 2 crores has been received in convertible foreign exchange by 30th September. Now people, because only 2 crores has been received by convertible exchange, I can only take that into consideration, which means 2 crores becomes my export turnover as an answer. Yes. What is the Roshni Limited eligible for deduction for? What is the formula, people? The formula is net profit into ETO by TTO. But because this person is doing after 5 years of operation, you will only get 50% as a deduction, which means I'll take 95 into 2 divided by 8 into 50%. The answer becomes 11.875. 11.875 becomes the answer, which is option number C. Fairly an easy question, people. The only thing you need to keep in mind is total turnover is not given in SEZ terms, it is given in Roshni Limited terms. That is the only difference which you have. Great. Question number 11 says, Mr. X has 2 units, one in SEZ, the other unit is in DTA. The unit was set up in SEZ in 2016. Again, people, it is 2016, which means this is 9th year of operations, and therefore I'll still be eligible only 50%. Total turnover of DTA is given to you as 3.25 crores. Total unit of X is given as 8.5 crores. So now they've done the same thing, people. Numbers have changed. X is given to you and DTA is given to you. If I have to understand this, 850 minus 325. So my total turnover in my SEZ is given as 5.25 crores. Yes, so my export turnover is 5.25 crores. Let's look at the balance. My export sales is given to, no, sorry, my total turnover is 5.25 crores. Yeah. So my total turnover is 5.25 crores. My export turnover is given to you as what? Export turnover is 3.5 crores directly given to you. So I can directly take the export turnover as it is. My net profit is given to you as 80 lakhs. What else? Proceeds from the sales export is given to you as 2.5 crores. Again, people, ETO will get converted off, so it becomes 2.5 crores now. Assuming that Mr. X would file his return on or before 31st October 2025. People, why is this given to you? The rules of SEZ come and say that you have to file your return on time. Failure to file your return on time would make this ineligible completely. Yes, because if a person has filed the return on 31st October, he has done everything appropriately. There is all returns filed on time, and therefore I am eligible for this deduction is what they're clarifying. The person has shifted out of default tax regime. They want the deduction. Very simple, people. Take the 80 multiplied with 2.5 divided by 5.25 into 50% will give me the answer. Therefore, it is 19.0476. Yes, it is 19.0476, which is option number B. This is option number B. Yes, fairly an easy question, people. Nothing complicated about this question. Right? Yes, we have question number 12, we have question number 13, we have question number 14, case scenario questions, people. Let's look at case scenario questions. Let's see if you're able to understand this. Case scenario number 12 says, Mr. Sambhav is 48 years and is furnishing the following particulars in respect of an industrial undertaking which is established in SEZ in March 2018. People, March 2018 means 17, 18, 18, 19, 19, 20, 20, 21, 21, 22, 23, 24, 24, 25. I am in 7th year of operations. It has began manufacturing in only April 2018. This is not relevant. In SEZ, the date on which you are setting up is the date from which you can start claiming deduction. If you have delayed manufacturing, that is your headache, not my headache. Keeping that in mind, my total sales in the current year is 85 lakhs, in which the export sales is 45 lakhs, and the proceeds have been received in India by 30th September, so fully eligible for deduction. Domestic sales is 40 lakhs. My profit from the undertaking is 20 lakhs. People, am I bothered about the domestic sales? No, I'm bothered about the export sales. I'm bothered about the total sales. I'm bothered about my profit. Export sales of 24-25 also includes a insurance of 5 lakh rupees for delivery of goods, people. This 5 lakh rupees has now become relevant because we have discussed it in classes also. When you have any expenses which is paid out of export turnover, you will not just reduce it from ETO, you will also reduce it from TTO. So the 5 lakh rupees will get removed from export sales also, will be removed from the total sales also. He has then received a rent of 30,000 per month from a commercial let-out property to Mr. Akash, a salaried individual, and has earned an interest on savings bank account of 15,000 and interest of post office savings account of 7,000 rupees. The person is shifting out of default tax regime. In the following cases, the first question they're asking is compute the export turnover and total turnover for the purpose of computing deduction. People, my export turnover will be 45 lakhs. My total turnover will be what? No, sorry, my export turnover is going to be 45 lakhs minus the 5 lakhs people, which is 40 lakhs. My total turnover also will be 85 lakhs minus the 5 lakhs, therefore 80 lakhs. So I'll get 40 lakhs and 80 lakhs is the answer. Yes, so therefore that becomes option number C, option number B. Therefore, that becomes option number B. Next, compute the amount of deduction which is available to Mr. Sambhav for 10AA. Very simple. I have the profit, so I can take the profit as 20 lakhs into 40 is what I found, divided by 80 is what I found, into 50% will be my answer. Therefore, the answer is 5 lakhs. Therefore, the answer is 5 lakhs. Therefore, the answer is option number D. Option number D. This one was very easy, people. Next, compute the total income of Sambhav. Now here is where you have to pay attention to, people. Sambhav's total income has been requested, so we need to put out the facts. Let's put out the facts one by one. First exactly is my profit from undertaking. Yes, so first will be my business profit, which is rupees 20 lakhs. Which is rupees 20 lakhs. What else have I earned? The person has earned some HP income, people. What is the HP income he has earned? He has earned a HP income of rupees 30,000 rupees, which is given to a salaried individual. Now it will be 30,000 into 12 will give me 3,60,000 as my NAV. In that I will claim 30% standard deduction. Therefore, the number becomes 2.52 lakhs. Yes, please pay attention to the fact that 30% standard deduction has to be granted when it comes to HP. Next, I have interest on savings account, which is 15,000 rupees. I have post office savings of 7,000. People, interest on post office savings will get a 3,500 flat deduction, and therefore another 3,500 can only be taxed. Yes, so 3,500 will be granted as deduction when it comes to your IFOS chapter itself. The balance we can claim under chapter 6A. So first let's total this off, people. It is 20 lakh rupees plus 2,52,000 plus 15,000 rupees plus 3,500 rupees. My number comes as 22,70,500. In this, now I'm going to claim my 10AA deduction. So my 10AA deduction will be rupees 5 lakhs. Yes, what else do I have? I have HP rent, people. HP rent has no deductions in chapter 6A, so I'm ignoring that. Coming to my interest on savings and post office, together you can claim a maximum deduction of 10,000 rupees. 15,000 plus 3,500 is 18,500. I can claim a 10,000 worth of deduction in this. Yes, so this becomes 80 TTA. Let me check the age also once again carefully. Yes, it's 48 years. He's not a senior citizen, so this becomes my final answer. Yes, so if I check this number and I remove 5 lakh rupees minus 10,000 rupees, I get the number as 17,60,500, and therefore that it becomes option number A. That becomes option number A. Yes, this one was fairly simpler, people. If you knew the provisions properly, you should have got this answer very, very easily. Yes, nothing complicated about option number A. Clear? Great. Question number 13. This question says, Mr. Suraj says 48 years and has given you the following particulars in respect of industrial undertaking for 2018. It began manufacturing in 2018. I am noticing this question looks the same. Oh yeah. Is the numbers also the same? 85, 45, 40. 20 numbers are the same. I have 5 lakhs of delivery, 25,000 of rent out property, 12,500. Yes, people, the question is the same. I'm going to ignore this question. Question number 13 is completely ignored off. Looking at question number 14. Question number 14 says, Mrs. Ritu is a retired government employee. She was born on 1st April 1942. People, 1942 means current year when she completes her age. We are in 2025, right? Yes, so 2025 minus 1942 will give her 80 years plus ages. Will give her an 80 years plus age, which means she is a super senior citizen. She is residing in Delhi. She stayed with her elder son, Mr. Nakul, from May 24 to 15th October 24, who is residing in Australia, which means she was outside India. She stayed in India for 361 days in the last 4 preceding previous years. Now, people, this person is a government employee. She is residing in Delhi, which means second condition will also be satisfied. She is not leaving India for any employment or other reasons, which means I will be a resident and an ordinary resident. During the previous year 24-25, the pension of 7,15,461 is credited to her account by State Bank of India, Uttamanagar branch, Delhi, after deducting tax at source of 14,565, which means this is my net income and this is my TDS. Adding these two will give me my gross income. She then received interest of 4,532 from a savings bank account with SBI. People, received interest of 4,352 can also mean that this is net of TDS. So let's keep that in mind. She also received an interest of 67,500 net of TDS on fixed deposits with Canara Bank in the month of April 2024. Okay, now this makes it clear, people, because when it comes to savings account is not liable for TDS, whereas when it comes to FD is liable for TDS, and 67,500 is net of TDS. She received an interest of 67,500 in the month of April 2024, which is also good enough. She has purchased 2 life insurance policies for her son Yuvan and married the daughter Mrs. Kajal, the details of which are given to you. You have the details of children given to you. The first policy was purchased in 2020, second policy is purchased in 2020. Premium payments have happened on 23rd October 24 and 25th September 24. Current previous year, no problem. Sum assured is given as 9,84,655 and 2 lakh rupees. Now people, because the policies is taken after 2012, you can only pay 10% as premium. So let's check. 9,84,000, 10% of premium would have become 98,465. This person has paid 1 lakh rupees, so I'm going to make a restriction on this. Next, 2 lakh rupees, you could have paid a premium of 10%, which is 20,000 rupees. It is within the limit, so I can claim the whole 17,000 as it is. Yes, so this is eligible for deduction. Next, she's taken a medical insurance premium for herself, for which she has paid an amount of 35,000 rupees towards health insurance by account paycheck. People, this is a super senior citizen, can claim 50,000 worth of deduction. Incurred check of 7,500 towards preventive health checkup, maximum deduction becomes 5,000 rupees. And her husband in cash, no restrictions on cash, you can claim preventive health checkup for a maximum of 5,000 rupees in cash. She has also incurred medical expenditure of 25,000 in cash for the month of 2025 for husband. People, this will not be allowed as deduction because the payment has happened in cash. In the month of March 25, she incurred medical expenditure of 10,500 rupees for herself, which is paid by account paycheck. Now, notice this carefully, people. This is medical expenditure incurred for herself. 80D rules is where the most challenge will happen. People will make a mistake here. Because the woman already has an insurance, can she also claim the medical expenditure? No. This is not allowed as deduction. This is not allowed as deduction. You can only claim a deduction of medical expenditure if you don't have any insurances. She has given a wristwatch of 10,000 rupees on her husband's 85th birthday. Her husband is resident in India for the previous year 24-25. People, she giving a wristwatch of 10,000 rupees. Oh, she has been given a wristwatch. Okay, sorry. She has been given a wristwatch of 10,000 rupees on her husband's 85th birthday. Who has given this wristwatch? Okay, I am assuming that this is given by husband. Okay, let me make an assumption that it is given by husband, therefore it is exempt from tax. Nevertheless, people, even if it was not given by husband, do you think it matters? No. This is a wristwatch. A wristwatch has a specific exemption, people. This is not a specified movable asset. With this not being a specified movable asset, this is anyway not going to be taxable in IFRS. So ideally, if you come and ask me, I would not be bothered about who gave it, but it's always good to know. It's always good to know. Her husband is resident in India is what the question comes and says. Good enough for him. Based on the facts given in the following cases, you are required to choose the most appropriate option. First of all, what would be the amount of deduction available under Chapter 6A to Mrs. Ritu? People, I think this can be answered straightforward. Let's look at this. I am having a pension, so no Chapter 6A for it. I am having interest on savings account. Can I claim a Chapter 6A? Yes, I can claim a Chapter 6A. Now, people, Chapter 6A deduction for a super senior citizen will be for both FD and in savings. If you notice, FD itself has gone more than 67,500 rupees, which means I am getting my TTA fully as a deduction. So I am eligible for 80 TTB of rupees 50,000 rupees straightforward. Agreed? Next, what is happening to the insurances? You have insurance of life. So therefore, for the first one, I'll be able to claim 98,465. Is it? 98,465 is what I can claim. 4865 is what I can claim. 65.5 you can round off also, people. That is completely fine. And second one, you can claim a deduction of rupees 17,000. Yes. So if I take these two into consideration, what do I get? 98,465 plus 17,000. Number becomes 115,465. 465. This is my 80C. Coming to 80D. I have a premium of rupees 35,000 which I can claim as deduction. I have a preventive health checkup of rupees 5,000 which I can claim as deduction. I think anything else is getting ignored off. Yes, so 35,000 plus 5,000 becomes 40,000 rupees. So 40,000 is what I can claim as deduction. Agreed. So if I take those into consideration, plus 40,000 plus 50,000, number becomes 2,05,465. Yes, so 2,05,465, or if you round off, it becomes 2,05,466, and therefore option number A is the right answer. Option number A is the right answer. Agreed? Agreed? Yes, simple, straightforward question. The next part is where you have to pay attention to, people. Question number 2 says they want the GTI. Now, people, if you want the GTI, you need to be very, very carefully putting out the facts to get the right answer. Let's put out the facts very, very carefully. The first fact is that I am having something called as a pension income. I'm having something called as pension income. Now, for those who have done TDS properly, you would know that just because you have a net of TDS does not mean that the TDS is not an income to you. You will have to add it to your amount received in order to get your final answer. And therefore, I will take that number fully into consideration, people. So it is 715,461. 715,461 plus 14565 is my right answer. Yes. So therefore, my pension total becomes 7,30,026 rupees. 7,30,026 is my answer. Next, people, I've received an interest on savings. I'm going to take the savings as it is. So that for that becomes 4352. 4352. Coming to my FD. FD says this is net of TDS, which means the number which I have 67,500 is after deducting a TDS of 10%. How do I gross up, people? I'll take 67,500 divided by 90% as my right answer. And therefore that becomes 75,000. Yes, so this is savings, this is FD, this is how it looks like. What else do I have? Is there anything else do I have? No, I have not received anything else. Wristwatch will become exempt from tax, so I'm ignoring that as a fact. 75,000 is my number, plus 4352 plus 730,026 is my answer. Therefore, my total income is 8,09,378. Yes, my GTI should be 8,09,378, which is option number. Oh. Why does it say 759? Let me check this once again. So I have 715,461. 715,461 plus 14565 becomes 7,30,026. Yes, this is one of the numbers. Then I have 4352 as one number. Then I have 67,500 divided by 90%, 75,000 is one number. MRC will give me 8,09,378. That is what the right answer should be. Have I done something else? Oh, okay, I got this. People, one mistake which we should have not been made, and this is a silly mistake from my side as well. This is eligible for a 50,000 rupee standard deduction. Yes, it's a salary income, people. Yes, it's a salary income. It's eligible for 50,000 standard deduction. I'm not sure how I missed this out, but nevertheless, 50,000 worth of standard deduction, and therefore the number becomes 7,59,378. Yes, option number C makes the right sense. Yes, it's me who normally comes and always keeps telling you people to not miss out standard deduction. It's a mistake from my side this time. Nevertheless, what would be the total income of Mrs. Ritu if she pays taxes under 115 BAC? People, this person is now moving to 115 BAC. That is where the change happens. Now, if you're going for 115 BAC, couple of changes which will happen, people, is that this 50,000 will now become 75,000. Yes, if it becomes 75,000. Next thing, when it comes to chapter 6A, TTB also cannot be claimed, D can also be claimed, ATC cannot be claimed, which means nothing else is left. So I'm taking the number which I had earlier and I will just add a 75,000 on it. So it is 7,30,026 minus 75,000 worth of deduction, my plus 4352 plus 75,000 is my answer, and therefore I should get it as 734,378. Yes, so 734,378 will come because the question is asking for total income. I will round off to the nearest 10, and therefore it becomes 734,380. 734,380. Please pay attention to the fact that the question asked you to pay tax under 115 BAC. Yes, this is where the change happens, and therefore you will ignore all your chapter 6A as a deduction. Yes, so good question for you to keep in mind, people. The standard deduction is where the critical part is. So please pay attention to that. Yes, awesome. I think with this, people, we're also done with what is called a chapter 6A deductions. There is nothing else left. We have chapter number 11, payment of taxes left, and we have, I think, yes, chapter number 12, return filing chapter. And then we'll be moving on to comprehensive questions. Yes, so 11, 12 left, and then we'll be moving on to comprehensive questions. So there is not much left. We will quickly be closing all these chapters in the upcoming videos as well. So yes, please watch out for the videos. And if you have any doubts apart from this, please feel free to reach out on my WhatsApp number, which is already given in the description box, or drop in a comment and we can check on the comments as well. Yes, until the next video, people, have a great learning. Thank you, everyone. Have a nice day. Take care. Bye-bye. Hey, warriors. Welcome back to the series on the MCQ guide. In today's video, we will be discussing about chapter number 11, which talks about your payment of taxes and TDS together. Yes, a fairly good chapter, people, because a lot of provisions come from this for your exams as well. So doing your MCQs would also inherently help you with your question number 2B or your MCQ questions as well in your exam. So therefore, please pay attention to this chapter. A very, very interesting chapter, and the questions are also really good. Let's pay attention to the chapter. Let's see what we can get out of this chapter. We're looking at question number 1 and forward. Question number 1 says, Mr. Prakash is employed with XYZ Limited from 5 November 2019. He resigned on 31st March 2025 and wants to withdraw the accumulated balance of employer's contribution in EPF account of rupees 55,000. The tax deducted on such withdrawal will be what? People, this is a withdrawal which is happening from PF account. It's not happening from the company. Because it is not happening from the company, there is no rules of salaries applied here. There is a separate section called 192A which will apply in this case. And therefore, is option number A is the right answer? No. Option number B is also not the right answer. Now, 192A provisions come and talk about a TDS rate of 10%. So, 55,000 into 10% will give you 5,500. Therefore, the answer becomes option number D. Option number D. Yes. Next. Mr. T is an Indian citizen and resident of India and has earned an income of 4,500 rupees from an Indian company which was declared on 1st October 2024 and was paid in cash to Mr. T. The person has received cash payments to Mr. T. Okay. What are the tax implications in respect of dividends in the hands of company and Mr. T? People, when it comes to section 194, the provisions of dividends on TDS, the rule comes and says that you will not be liable to do TDS if the limit is not crossing 5,000 rupees. But there is an exception to the rule. The exception to the rule comes and says this rule will only apply when the dividends are paid by other than cash modes. Here is a case where the payment is made by cash, hard cash, and therefore dividend is applicable for TDS from rupee 1. That is what the rule is. Such dividend is taxable in the hands of Mr. T, an Indian company, and required to deduct at 5%. No, there is no 5% rule on this. Such dividend is taxable in the hands of Mr. T, an Indian company, is required to deduct at 10%. Yes, this is the right answer. This is the right answer. Such dividend is taxable in the hands of Mr. T. However, Indian company is not required to deduct since the amount is not exceeding 5,000. No, the cash has made the trouble here. Since such dividend is exempt in the hands of Mr. T. No, there is no such exemption for Mr. T and all. Next, question number 3. A firm pays salary and interest on capital to its resident partners. The salary and interest paid is within the limits of section 40p. Which of the following statements are true? Which of the following statements are true? People, because you're doing assessment year 25-26, financial year 24-25, the provisions of section 194T are not notified for you. Because 194T are not notified for you, no other section of TDS will also apply in this, and therefore the answer would be option D. The answer would be option D. Neither 194A nor 192 covers this provisions, and therefore 194T will come into picture, but that is only from next assessment year. For you, the answer is option number D. No TDS is applicable. Question number 4. Mr. X is a resident and is due to receive 5 lakh rupees on 31st March 25 towards maturity proceeds of LIC taken on 1st April 21 for the sum assured of 5 lakh rupees. People, when the sum assured is 5 lakh rupees, your premium should not exceed 10% of the number, and the annual premium is 1 lakh 50. The moment the premium exceeded 10%, the policy has now become taxable and is liable for TDS. Mr. Z, a resident, is due to receive 99,000 rupees on 10th October 24 towards maturity proceeds of LIC on 10th October 2015, where the sum assured is 90,000 rupees and the premium paid is 10,000 rupees. People, again, when the sum assured is 90,000 rupees, the premium paid is 10,000. The premium paid should be 10%, which is 9,000 rupees. So this policy is also ideally taxable. However, the provisions of your TDS come and clarify that when it comes to withdrawal from maturity of life insurance proceeds, the TDS is only applicable if the money received is 1 lakh rupees and more. If the money received is 1 lakh rupees and more. And therefore, to that extent, while Mr. Z's policy is taxable, this policy is not liable for TDS. While Mr. Z's policy is taxable, this policy is not liable for TDS. So I am only looking at the policy which Mr. X has taken. Now, Mr. X has taken a policy of rupees 5 lakhs and paid a premium of 1 lakh 50. This premium has been paid by him for 1st April 21 to 31st March 22, 1st April 22 to 31st March 23, 1st April 23 to 31st March 24, and 1st April 24 to 31st March 24. So 21, 22, 22, 23, 23, 24, 24, 25. So 4 policy premiums I have paid, which means 1,50,000 into 4 will be my answer. And therefore 6 lakh rupees is what I have received. 6 lakh rupees is what I have received. Now on the 6 lakh rupees, I am liable for TDS, which means tax is required to be deducted on income comprised in maturity proceeds of X and Y. No, you cannot take it on Z. You cannot take it on Z. Tax is required to be deducted on income comprised in maturity proceeds of Mr. X. Yes, this gives me the right answer. This gives me the right answer. So this is the right answer, people. Tax is required to be deducted only on Z? No. No tax is required to be deducted? No. Option number B is the right answer. Although people, if you come and ask me honestly speaking, I have paid a policy premium of 1,50,000. Now 1,50,000 for 4 years ideally becomes 6 lakh rupees, which is kind of weird. Because 21, 22, 22, 23, 23, 24, 24, 25 will become 4 years. Now the sum assured itself is 5 lakh rupees. Why would a person pay a premium of 1,50,000? The question inherently has a mistake. Why am I telling you this? Because people, when it comes to this section, the section also comes and clarifies the TDS will only apply on the profit element. Profit element meaning the sum assured, the sum received minus the premium paid. Now my sum received is 6 lakh rupees. My premium paid is also 6 lakh rupees. The tax deduction becomes 0 technically, which means I would say option D can also be the right answer by terms of numbers. In terms of wordings, option B makes the most sense. So therefore, there is inherently some mistake in the question, but let's assume the things. Next, Mr. X is a resident Indian and has won 10,000 rupees in lottery. Which of the following statement is true? People, when it comes to resident, the only TDS provisions is applied on the tax number as it is. Surcharge and cess are not included in the answer. Yes, and therefore that is to be kept in mind. However, notice carefully that the payment is only 10,000 rupees. The provisions of section 194B comes and clarifies that TDS will only apply when the limit crosses 10,000 rupees. Here the number is exactly 10,000 rupees and therefore TDS will not apply. Therefore, the answer is option number C. The answer is option number C. Next, while deciding the liability of an individual to deduct tax on payment of fees of professional services, which of the following is immaterial? When you're doing TDS under 194J, what are the following details you will not look for? Amount paid to professional, definitely to be looked for people because threshold is to be checked. Turnover of FI immediately preceding the financial year in which payment is made, yes, because this is 194J, threshold limit has to be checked for the last financial year for the purpose of hijacker. Turnover of the current year in which the payment is made, no, there is no such rule that you have to check for the current year's turnover. Fourth, amount of fees professional services paid, yes, option A and option D makes the same thing. Yes, option A and option D are the duplicate of each other, which means C is the right answer. Question number 7. Mr. X is paying fees for professional services of 40,000 rupees to Mr. Y, who is engaged only in the business of operation of call center. People, when it comes to operational of call center and if the threshold of 30,000 is breached, the limit TDS rate is 2% and therefore the answer is option C. The answer is option C. Next, Mr. P is a professional who is responsible for paying a sum of 2 lakh rupees as rent for the use of building to Mr. Harshit, a resident for the month of February 2025. The gross receipts of P from April to March of 24 is 55 lakh rupees. April to February 25 is 45 lakh rupees. Whether Mr. P is required to deduct TDS on these payments of 2 lakh rupees. People, this is section 194I. 194I forms part of hijacker rules and hijacker rule comes and says this will only be liable if the professional receipts exceed 50 lakh rupees in the preceding previous year. In the preceding previous year, my turnover gross receipts is 55 lakh rupees and therefore is TDS applicable? Yes. However, the problem is when it comes to 194I, 194I has a threshold limit of 2,40,000 rupees. This payment made is 2 lakh rupees and therefore to that extent I am not liable for TDS. I am not liable for TDS and therefore 2 lakh rupees will make me inherently not liable for TDS. Therefore, the answer becomes option number D. The answer becomes option number D. Next, Mr. Ram is acquiring a house property at Chennai for Mr. Satyam, a resident, for a consideration of 85 lakh rupees. On the same day, Mr. Ram has made 2 separate transactions, thereby acquiring an urban plot in Gwalior from Mr. Vipun, a resident, for the sum of 50 lakh rupees and a rural agricultural land for the sum of 75 lakh rupees. Which of the following statement is correct, assuming the consideration amounts aforementioned mentioned includes all charges incidental to the transfer of immovable properties as included and there is no difference between the stamp duty value and actual consideration? People, we are in section 194IA. Section 194IA comes and says that when you are planning to buy an immovable property, if the consideration value exceeds 50 lakh rupees, you will be liable for TDS. However, this will not apply on rural agricultural land because that is anyway exempt from taxes. To that understanding, people, the 85 lakh rupees worth of asset is liable for TDS at the rate of 1%. The urban plot of Gwalior of 50 lakh rupees will not be liable because the threshold is not breached and the 75 lakh rupees will also not be liable because it's a rural agricultural land. Therefore, the answer becomes option... No, one second, I'm so sorry. Oh, okay. This is 194 IA, people. I'm so sorry. 194 IA has a threshold limit of less than 50 lakhs, which means 50 lakhs and above is also liable for TDS. Exact 50 lakhs is also liable for TDS, people. The threshold is less than 50 lakhs and therefore for that 50 lakhs worth of urban plot also TDS will be applicable, which means the answer is option number C. The answer is option number C because the first one says no TDS, which is not the case. The second one says TDS on all payments, which is not the case. Rural agricultural land is exempt and therefore option C becomes the right answer. Yes. Question number 10. Mr. A has 2 bank accounts which is maintained with ICICI Bank and HDFC Bank from 1st April 24 to 31st March 25. Mr. A has withdrawn from the following amounts as cash from both the banks, where HDFC he has withdrawn 50 lakh rupees, ICICI Bank he has withdrawn 1.2 crores. What shall be the amount of tax to be deducted on 194N for HDFC and ICICI Bank while making payments in cash to Mr. A, assuming Mr. A has filed his return of income for all the years? People, if a person is good and is filing all his return for the past 3 assessment years, he will be liable for TDS only after 1 crore rupees. In the case of HDFC Bank, my TDS, my withdrawal is only 50 lakh rupees and therefore TDS will not apply. Whereas in the case of ICICI Bank, I have withdrawn 1.2 crores. So on the extra 20 lakh rupees, I will deduct TDS at the rate of 2%. At the rate of 2% will give me 40,000 rupees, and therefore the answer is option number B. The answer is option number B. Easy question. Yes. Next. Mr. Arora is making the following cash withdrawals during financial year 24-25. You have multiple banks here, people. I have Canara Bank, I have Repco Bank, I have SBI also in this. Which of the following banks are required to deduct TDS at source on cash withdrawals made by Arora if he is regularly filing a return of income? People, when it comes to 194N, let's understand one thing, that you have to check it per bank. Yes, so let me check Canara Bank first. If I'm checking Canara Bank, 70 lakhs and 50 lakhs becomes 1.2 crores. 1.2 crores meaning for the 1 crore he will not be liable for TDS. For the 20 lakhs he will be liable for TDS at the rate of 2%, which means answer is 40,000. So Canara Bank is deducting TDS. Canara Bank will be liable for TDS. Coming to Repco Bank. Repco Bank shows 60 plus 10, so 70 plus 10, 90 and another 15, which means 1 crore 5 lakhs. In 1 crore 5 lakhs, people, Repco also will become liable for TDS because 1 crore has breached. Coming to SBI, SBI says 10, 75 and 15. 75 plus 15 will give me 90, 90 plus 10 becomes 1 crore, exactly 1 crore not liable for TDS. Therefore, the answer becomes Canara Bank and Repco Bank. Therefore, the answer is option number C. Option number C. Good question. Question number 12. Mr. Vyas is age 80 and is a retired government employee. On 1st April 24, he has received maturity amount of his LIC policy amounting to 3,50,000. The policy was taken by Mr. Vyas on 1st April 2016, on which the sum assured was 3 lakh rupees and the annual premium is 40,000. People, the person is taking the policy on 1st April 2016 at a sum assured of 3 lakh rupees, which means he can only pay a premium up to 10% of the sum assured, which is 30,000 rupees. Person has paid 40,000 rupees, which means the problem is that he is liable for TDS. Because the policy is taxable. His other income comprises of a pension income of 85,000 rupees. Mr. Vyas has furnished a declaration in Form 15H for non-deduction of tax to insurance company stating that his net tax liability is nil. You are required to comment on the following answer. First one, the declaration made by Mr. Vyas is wrong and the insurance company has to deduct tax. No. The claim made by Vyas is right and the insurance company is not liable to deduct TDS. Yes. People, section 197A comes into picture. 197A comes and says that when a senior citizen comes and says that he is not liable to TDS, he can submit a form 15H. The moment he submits a form 15H, TDS will not apply in this case. Yes. So that is what the right answer would be. Question number 13. Mr. Sunil took an education loan of 8 lakh rupees on 1st July 24 from State Bank of India for his son's MBA for University of Oxford, UK, and remitted the same amount to the same bank, which is an authorized dealer under liberalized remittance scheme. Okay. He further remitted 2 lakh rupees on 15th October 24 to his son for his personal expenditure out of his personal savings through Bank of India, Mumbai, which is also an authorized dealer under LRS. Mr. Sunil also remitted 6 lakh rupees out of his personal savings through LRS to Union Bank of India for his sister's medical treatment in London. Mr. Sunil has furnished an undertaking containing the details of earlier remittances to Bank of India and Union Bank of India, which means, people, all the banks are aware about each other's transaction. In which case, now you will not check it per bank, you will check it all banks together. What is the amount of tax to be collected by Mr. Sunil and amount respectance? Now, people, for this to be done, first of all, we need to put the timeline properly. Let's look at the timeline and tell me which one is happening first. First transaction is happening on 1st July, then it is happening on 15th October, and then it's happening on 28th March. Why am I putting a timeline, people? Because the income tax rule comes and says for TCS, unless it is an overseas tour package, for the first 7 lakh rupees, there is no TCS applicable. Which means, in the first instance, when I'm paying 8 lakh rupees, for the first 7 lakh rupees, no TCS will apply. The balance 1 lakh rupee will be liable for a TCS at the rate of 0.5% because this is an educational loan. Yes, when it comes to an educational loan, people, the rule comes and says you are liable for a TCS at the rate of 0.5%. So I will take 0.5% of rupees 1 lakh in the first instance. Next, coming to the second one, he has remitted 2 lakh rupees to his son for personal expenditure. People, when it's for personal expenditure and no random reasons, 2 lakh rupees will be liable for TDS at the rate of 20%. Yes, next one comes your 6 lakh rupees, which is given to your sister for the purpose of medical treatment. People, 6 lakh rupees for medical treatment will be liable for 5%, which means this is what the answer should look like. Yes, TCS at the rate of 0.5% on 1 lakh. Yes, 5% on 2 lakhs. No, that is not right. 0.5 percentage on 1 lakh, yes. 20 percentage on 2 lakhs, yes. And 5 percentage on 6 lakh, yes. Option B is the right answer. Option B is the right answer. This is what I will take as a right answer. Yes, yes, sweet. Question number 14. Mr. Raj is a non-resident and age 65 years. People, now I am a non-resident earning rental income of 40,000 per month for a property located in Delhi. He is also residing in Canada. Apart from rental income, he does not have any other income from source. Is he liable to pay advance tax is the question. People, if you have to pay advance tax, the rule of advance tax is that you should be a person who has a tax liability exceeding 10,000 rupees. Exceeding 10,000 rupees. Let's understand that carefully first. Now, if the person has a rental income of 40,000 rupees, what is going to happen? 40,000 rupees is my rental income, into 12 becomes 4,80,000 rupees, minus 30% standard deduction. Therefore, the number becomes 3,36,000. Now, the person is paying tax under default tax regime. Because the person is paying tax under default tax regime, for the first 3 lakhs, he will not be liable for tax, which means for the balance 36,000, he'll be liable for tax at the rate of 5%. Now, on that 5%, he'll also be liable for a 4% cess, which means the answer comes to 1870. 1870 is the answer. Now, 1870, is he going to be liable for advance tax? The answer would become no. The answer would become no, because his tax liability is less than 10,000 rupees. Now, it doesn't matter that the person is a non-resident and is not eligible for rebate, because at the end of the day, the number should be 10,000, and therefore he is still liable to pay taxes. Sorry, he is not liable to pay advance taxes. Question number 15. The benefit of payment of advance tax in one installment on or before 15 March is given to what? People, if you want to pay only on the last installment, you have to opt for presumptive taxation of business or profession. That is what the rule is. Only 44AD? No. 44AD and 44AE? No. People, 44AE is transport operator. That is not the case. 44AD and 44ADA, answer is yes. Option number B is the right answer. Option number B is the right answer. Yes. Next. An interior decorator declares profit from profession under presumptive taxation under 44ADA. Okay. He liable to pay advance tax on or before 15th March. People, this is the right answer directly. Because the moment I am opting for professional income, professional presumptive, I am only liable for advance tax on the last quarter. Next, Mr. Jha, an employee of FX Limited, has attained 60 years of age on 15th May 2024. He is a resident in India during 24-25 and has earned a salary income of 5 lakh rupees computed. During the year, he has earned 7 lakh rupees from winnings of lottery. Okay, what shall be his advance tax liability for 25-26 if all tax deductible at source has been duly deducted and amount to the credit of central government has been paid, assuming that he paid tax under default tax regime? Now, people, if it is going to be a case of TDS deductions, notice carefully that the person is a resident. Because the person is a resident, the rule will come and say that he will deduct 30% TDS on the winnings, and he would have already deducted slab rate TDS on the salary income. Yes, so salary income would have been liable for TDS. However, the problem is that the person is opting for default tax regime. So, in the default tax regime, we'll have to compute it accordingly. Yes, what is the question asking for? The question is asking for what is his tax liability. So, let's understand what is his tax liability, people. When it comes to his tax liability, his salary would have already been deducted at TDS with cess also and surcharge also, which means to that extent, I don't even have an advance tax liability. The advance tax liability is predominantly going to come on the the advance tax liability is predominantly going to come on the lottery income. So, let's look at the lottery income. In the lottery income, people, how much I am earning? My lottery income is 7 lakh rupees, on which 30% TDS is already gone. So, 7 lakh rupees pay, if I compute the tax, 7 lakh rupees pay, if I compute the tax, that is 30% tax plus a 4% cess, the number becomes 2,18,400. But in that 2,18,400 people, the person would have already paid TDS of 2,10,000, which means 8,400 is what my total 8,400 is my total tax liability payable. In my 8,400 of total tax liability payable, people, the 8,400 has become less than 10,000 rupees. Because it has become less than 10,000 rupees, you are not liable for advance tax, and therefore the answer becomes option number D. The answer becomes option number D. That is what the right answer would be. Yes, this is a very, very beautiful question, people, which you should mark as important and read from exam perspective also. Notice carefully that when TDS is deducted on the salary, the whole TDS is deducted with cess. But when it comes to lottery, you are only deducting TDS on the 30% number, which means the cess is something which you have still not deducted TDS on, and that is what you are liable for TDS on. That is what you should be considered for advance tax liability. Question number 18. Mr. Rudra is engaged in the business of trading since 2018. The previous year 23-24 turnover is 6 crores. People, the turnover is 6 crores, which means I am liable for hijacker. But I will not be liable for 194Q. His minor daughter's marriage is fixed in December 24. Not relevant. He has planned destination wedding in Goa for his minor daughter. Not relevant. For the wedding, he withdrew 40 lakh rupees in cash from the month of September 24 and 65 lakh rupees cash in the month of October 24 from Hamara Paisa Bank. People, this is section 194N. You have withdrawn cash from a bank more than 1 crore rupees. He booked 30 rooms for 5 days for the accommodation of his relatives in Rahul Hotel and paid 40,000 rupees in cash as advance and the balance by account pay check. People, the person has taken a property on accommodation rent. Now, the understanding here is that because TDS is deducted under section, because the turnover has exceeded 6 crore rupees, you will be liable for section 194I. Section 194I would come and say you have to do TDS if the number exceeds 2,40,000 rupees. So, let's check what is happening. He has booked 30 rooms for 5 days for the accommodation for his relatives in Raho Hotel and has paid 40,000 in cash in advance and balance by account paycheck. They have not mentioned what is the total rent. He has taken a catering services from Tasty Caterers, a sole proprietor, for wedding of which he has paid 10,20,000 on 15th October 24. Now, people, catering services are under 194C. There is only one problem here. 194C specifically comes and says that I will only apply this section of 194C when I am doing it for official purposes. This is a personal wedding, a personal reason wedding, and therefore this is not liable for 194C. I'll have to check for 194M. 194M rule comes and says you will only apply 194M when the total threshold exceeds 50 lakh rupees. So just by looking at 10 lakh 20, I would say TDS is not applicable. For her wedding, he gifted his daughter a house property purchased from SK Builders on 10th October 24 by account pay check for 15 lakh rupees. The stamp duty value on the property is 16 lakh rupees and the date of transfer to minor daughter is 20 lakhs. Where exact? Oh, okay. The child is a minor daughter. Okay, sorry. Yeah. So the date of transfer to the minor daughter is 20 lakh rupees. So which means they're coming and saying the SDV is taken as 20 lakh rupees for the date of transfer. Now people, because this person is transferring it for a consideration less than 50 lakh rupees or SDV less than 15 lakh rupees, section 194 IA will not apply. That is for sure. Next, Mr. Rudra paid 45,000 rupees in cash and the balance in check to travel agent for the return ticket of some of his relatives to US. He regularly files his return of income. The person has paid some cash of 45,000 rupees for a travel agent for the purpose of making payments of his relatives. Okay. Based on the following facts, you are required to choose the most appropriate option. What is the amount of tax to be deducted by Hamara Paisa Bank? People, Hamara Paisa Bank, 65 plus 40 becomes 1 crore 5 lakhs, which means on the 5 lakhs, I will be liable for TDS at the rate of 2% because the person is filing his returns properly. Therefore, the answer becomes 10,000 rupees. This one was easy. What is the amount of TDS to be deducted by Rudra Limited on the payment made to Tasty Caterers? People, the Tasty Caterers, like I said, is going to be catering services. 194C should have applied, but because you're doing it for personal reasons, 194M will apply. 194M will only apply when the threshold is crossed 50 lakh rupees. This threshold is not crossing 50 lakh rupees. Therefore, there is no TDS to be applied in this case. The answer becomes option number D. Next, what shall be the amount taxable in whose hands in respect of the purchase of immovable property by Mr. Rudra from SK Builders and the gift of the same to his daughter? People, the person has purchased this property from SK Builders on 10th October 24 by account pay check for 15 lakh rupees. The stamp duty value of the property is 16 lakh rupees and on the date of transfer to minor daughter it is 20 lakh rupees. People, when I purchase, first of all, who am I? I am Mr. Rudra. Rudra is purchasing it for 15 lakh rupees, whereas he has taken the stamp duty value for 16 lakh rupees. Now people, 15 lakh rupees and 16 lakh rupees, technically what is happening, there should be a gift element. There should be a gift element, but the problem is this is within 110% of consideration. If you look at 15 lakh rupees and 16 lakh rupees, this is on the date of consideration. Yes. Also, you will not consider the stamp duty value on the rate of 20 lakh people. The reason is because you have made an advance payment, that too by permissible modes. Notice the question. The question comes and says he has gifted his daughter purchased from SK Limited by account pay check for 15 lakh rupees. Now 15 lakh rupees when I purchased that day, it was 16 lakh rupees and therefore that is the consideration. Because that is the consideration, my stamp duty value is going to be 16 lakh rupees. My purchase value is 15 lakh rupees. I am not crossing the 110% cut threshold and therefore IFOS will not apply to me, which means Rudra is not liable for IFOS. Now, coming to minor daughter, is minor daughter going to be liable for it? No, because Rudra is not liable, minor daughter is also not liable. So therefore, the answer should be nothing here. The answer should be nothing here. Nothing is taxable in the hands of Rudra and minor daughter should be the right answer. What is option D? Option D says nothing is taxable in the hands of Rudra, but 20 lakhs is taxable in the hands of minor daughter. Definitely not, people. It's my own daughter. It's my own daughter. With Rudra's own daughter, you are not liable for gift provisions. Gift provisions become exempt because this is a relative provisions. So therefore, option number D makes the most sense. I'm not sure why did they give so much stories to you, because technically they've not done a single rupee of TDS on this. Yes, a simple straightforward case scenario question, people. It was a very easy question which you could have easily answered it from your end as well. This is all that is there in TDS, people. I hope this was interesting for you. Some question which I would really want you to mark as important is question number 17. Question number 17 is definitely a good question which you should mark as important and you should be reading for your exams. Then comes your question number 13, your TCS related provisions. This is very, very important for the current year's attempt. Then you have to look at question of 12. Just for your reference, people, section 197 you should look into, and check for question number 10 also. Check for question number 10 also, which talks about your 194N provisions. What else can you look for? Yes, you should be definitely looking at question number 9. This is a repeated question. ICAI has asked this at multiple occasions. 194IA related questions are very, very often tested, especially because this year 194IA has an amendment as well. So please focus on question number 9 as well. That is something which you should be paying attention to. I think apart from that, people, every other question looks fairly easier. So therefore, these are the only questions which I will request you to focus the day before your exams as well. That's it, people, for today's video. We have some more chapters left. I think we are at chapter number 11. So 2 more chapters for us to go, the return filing chapter and a comprehensive question chapter. We will quickly close those chapters as well so that you have everything in your hand for you to complete the MCQ guide as soon as possible. Let me come up with the upcoming videos as soon as possible and we close it with that. Until then, people, have a great learning ahead. And if you have any doubts and any confusions, please drop in a comment box or reach out to me on my WhatsApp number, which is given in the description box. You are free to do that and I will help you in whatever extent possible. Have a great learning ahead, people. I'll come up with the next videos very, very soon so that you can complete the syllabus. Until then, take care. Bye bye. Hey boys, welcome back to the videos on the MCQ solutions which we are discussing from our MCQ guide. In today's video, we will be discussing chapter number 12, the return filing chapter. Again, a smaller chapter for you to quickly cover and quickly solve for the purpose of your exams. Now, this chapter is something which I want you to pay special attention to, people, because return filing as such comes for a 4-mark theory question, and therefore MCQs can also be a good source of you to cover your whole chapter so that you can easily score that 4 marks theory from your exam perspective. Let's look at the questions very, very quickly and solve all the questions and take away from there. Yes, question number 1, the recent MTP number 2, May 2025 question. It says Arun's gross total income of previous year 24-25 has been given as 2,45,000. He exercised the option of shifting out of default regime under section 115 BAC. People, the moment you are shifting out of default tax regime, your basic exemption limit becomes 2,50,000. He deposits 45,000 in PPF and has paid an electricity bill of 1.2 lakhs in previous year 24-25. Which of the following statements is right? Notice carefully, people, when it comes to return filing chapter comes and says that you will be liable to file a return of income if your gross total income, ignoring all chapter 6A reductions, is more than basic exemption limit. If I'm noticing 2,45,000 is my gross total income without even considering my PPF ka deduction, and therefore I am still not liable to file a return of income. However, there is a subsequent provision. The subsequent provision comes and says when a person pays electricity expenses more than 1 lakh rupees in a year, he is still liable to file a return. In this case, I have paid electricity bills of 1.2 lakhs and therefore my return filing condition becomes mandatory. Option number A, Mr. Arun is not required to file a return of income. No. Option number B, Mr. Arun is not required to file a return of income. No. Option C, Mr. Arun is not required to file a return of income. No. Option number D, Mr. Arun is required to file a return of income since his electricity bill exceeds 1 lakh rupees. Answer is yes. Option number D is the right answer. Yes, easy question. Next, Mr. Kumar, age 62 years, which means senior citizen, resident and ordinarily resident, is retired employee with a monthly pension of 22,000 rupees. People, a monthly pension of 22,000 rupees means he's taxable under salary income. Yes, a 22,000 rupees of monthly pension into 12 will give me a total salary of 2,64,000. But then I am also eligible for a standard deduction depending on what regime I'm choosing for. So let's read the information. He has no other source of income. Okay, enough. He has a house property in Bathinda and his only son is living in London and has a house over there. People, the son has a house in London. His son met with an accident and died and thereby leaving the house at London in the name of Mr. Kumar. So son has died and therefore the property has been passed on to Mr. Kumar. Mr. Kumar seeks your advice as to whether he is required to file his return of income. People, is he required to file a return of income? The answer is yes. Although the basic exemption limit has not been satisfied because of his salary income, please note that the provisions come and say when you're an ROR. When you're an ROR having either a foreign bank account signing authority or having assets located outside India, you are required to file a return of income mandatory. In this case, since the son has died and the asset has come in the name of Mr. Kumar, he has now become the owner of a foreign asset and therefore return filing becomes mandatory regardless of your income slabs. Therefore, the answer becomes yes. Yes, he is mandatory required to file his return of income as he is a resident and ordinary resident and has located assets outside India. This is the right answer. This is the right answer. There is no issues here. Yes. Look at option number B. No. Option number C says yes, he is required to file his return of income as his income exceeds basic exemption. No, people. 22,000 into 12 will not give me 2 lakh that much. Yes, you're not having that much incomes. Next. Which of the following returns can be revised under 139.5? Can a return of income be revised under 139.1? Be revised under 139.5? Yes. A belated return? Yes. A return of loss? Yes, definitely yes. All the 3 returns can be revised, which means the answer should become option number D. Option number D is the right answer. Next, question number 4. Mr. Dinesh is a resident in India, has a gross total income of 2,30,000 comprising of interest on savings account and rental income during the previous year 24-25. The person has incurred expenditure worth 2 lakh rupees for his son for a study tour to Europe, whether he requires to file a return of income. People, this is a case where again the basic exemption limit has not been exhausted because the number is only 2,30,000. But travel expenses come and say that if you have incurred more than 2 lakh rupees for travel expenses, then you will be liable for filing the return of income if the travel is taken place outside India. In this case, the expense is exactly 2 lakh rupees. When the expense is exactly 2 lakh rupees, is he required to file a return of income? Answer is no, which means I can ignore A, B and C. The answer becomes option number D. Yes, pay attention to the fact that 2 lakh rupees is the cutoff point, which means after 2 lakh rupees only you need to file a return of income. Up to 2 lakh rupees, you are not required to file a return of income. Next, Mr. X is a working partner and Mr. Y is a non-working partner of XYZ partnership firm. XYZ partnership firm is subject to tax audit under section 44AB. What is the due date of filing of return of income for X and Y? People, when the partnership firm is liable for tax audit report, the whole list of the partners will be liable for only one due date, which is the October due date. You do not care whether the partner is working partner or a sleeping partner. It doesn't matter. All partners are liable for the same due date, which means the answer becomes 31st October, which is option number B. These are all good theory questions, people, which you can quickly practice. Then question number 6. ISKCON Inc., a foreign company and a non-resident in India for 25-26, is engaged in the business of trading tube lights outside India. People, there is a person, foreign company guy, who's trading tube lights outside India. The principal officer of the company has approached you to enlighten him the provisions regarding Income Tax Act pertaining to the person who's required to verify the return of income in case of ISKCON Inc. People, there is an ISKCON Inc. who's engaged in business of trading outside India, which means he doesn't have any income in India. I don't see a reason for him to file return of incomes in India, but nevertheless, advise him as to which of the following statements are correct, assuming that the company has a managing director. The return of income in respect of ISKCON Inc. can be verified by the managing director. Yes, definitely true. The return of income in case of ISKCON Inc. can be verified by any director irrespective of availability of otherwise of the managing director. No, that is not the case, people. You have to have a managing director to be signing the return. If only the managing director is not available, then only other directors can do it, which means it's not an option, it's just an alternative. Point number 3. The return of income in case of ISKCON Inc. may be verified by any person who holds a valid power of attorney for such company to do so, irrespective of the availability or otherwise of the managing director. This is right, people. When it comes to a foreign company alone, there is a special guideline which comes and says that you can also get it verified by a person holding a power of attorney, which means option 1 and option 3 makes the right sense, and therefore that is option number C. Next, question number 7. Mr. Pawan is engaged in the business of roasting and grinding coffee beans. People, 2 words. During financial year 24-25, his total income is 4.5 lakhs. Okay. Mr. Pawan filed his return of income for 25-26 on 3rd December 2025. What shall be the fees payable by him for the return of income in respect of such cases? People, when the total income is 4.5 lakh rupees, which is less than 5 lakh rupees, you're only liable for a late filing fee of 1000 rupees. You cannot get a late filing fee of 5000 rupees because my total income is less than 5 lakh rupees. If the total income goes more than 5 lakh rupees, then I'll be liable for a 5000 rupees late filing fee. Because this case is that, I will take the answer as option number B. Now, I'm not really sure why did they use the word not exceeding 1000 rupees, because the answer is 1000 rupees. The answer is flat 1000 rupees. I don't see what not exceeding 1000 rupees means. When a person uses the word not exceeding 1000 rupees, which means the answer can be anywhere between 0 to 1000. That is not the case. You are mandatory liable for a flat 1000 rupees. So this option number B is ideally wrong, but nevertheless. Question number 8. Mr. Z, a salaried individual, has a total income of 8 lakh rupees for 25-26. He furnishes the return of income for 25-26 on 20th August 25. What shall be his late filing fee? People, this person is a salaried individual. Salaried individuals are liable for a due date of 31st July. Now, this person has a total income of 8 lakh rupees, which has crossed 5 lakh rupees. Therefore, he doesn't have an option but to pay 5000 rupees as late filing fee. Therefore, the answer becomes option number B. Yes, the answer becomes option number B. Question number 9. An individual client has consulted you on the matter of PAN. He is carrying on the business of purchase and sale of electronic appliances. His turnover is 3 lakhs and the profit is 75,000 for the previous year 24-25. He has asked you to provide him the threshold of turnover, if any, exceeding, for which he has to apply for PAN number. People, in PAN cases, they have come and clarified that the turnover should be 5 lakh rupees in order to apply for a PAN number. And therefore that is what the rules would be. No rocket science. This is given in your study material as it is. Next, in which of the following transactions quoting of PAN is mandatory by the person? Yes, case of opening a bank account, opening a basic saving account with the bank, no, quoting of PAN is not required. Applying for a bank for an issue of credit card, yes, issuing credit card requires a PAN card, mandatory. Payment of 40,000 rupees to a mutual fund for purchase of his units. No, 40,000 is not the limit, people. You have a limit of 1 lakh rupees. Cash deposit at the post office of 1 lakh rupees during the day. No, you don't have. No, sorry, it's 1 lakh rupees, right? Yes, if it's 1 lakh rupees, you are liable for getting a PAN number there also. A fixed deposit of 30,000 rupees with NBFC registered with RBI, aggregating the total deposit to 3 lakh 50. No, people, NBFC and all is not covered in the quoting of PAN conditions. Sale of shares of an unlisted company for an amount of 60,000 rupees. No, we only have that provision for sale of listed shares. We don't have it for unlisted shares, which means I see the option as 2 and the option as 4, which means the answer becomes option number A. The answer becomes option number A. And that's it, people. Yes, easy return filing chapter questions, nothing complicated about this. I think this was a very, very good chapter for you to understand what your theory questions look like for 4 marks. Yes, and therefore please pay attention to it. Now, if you ask me, I would say all questions in this are easy questions, so therefore you should practice all these questions the day before exams as well. But there is one thing which is missing in this and I want you to pay attention to, is something called as updated returns. Updated return questions are not part of this, so therefore I want you to practice on updated return questions as well. While yes, updated return questions are being discussed in this MCQ guide as well. We'll find it in other chapters because it was part of a comprehensive case scenario question and therefore it was not covered here. But yes, an updated return question is also something which you should be paying attention to, so please look at updated return questions as well. Are you clear? Awesome. With that understanding, people, I think I want to conclude this video. This was a very, very short, simple video for 10 minutes. We will discuss the balance 1 chapter left of comprehensive questions, the detailed chapter, people, which will take me a good amount of time to cover. So maybe let me see if I can cover everything in one sitting, or I'll try to cover it in multiple videos. Yes, let me see what I can do on that. But yes, only one chapter left for you to cover in MCQ guide. I hope you are all preparing the MCQ guide the similar manner as what I am. Please cover the MCQ guide before you go for your exams. This will be a good book for you to practice for your exams. Let me end on that note, people. I hope you all have a great learning. I will come up soon with the upcoming videos on the comprehensive questions, and we will close with this on the series of MCQ guides. Until then, people, keep learning and stay safe. Thank you. Bye bye.